Hello, good afternoon, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to the final revision series. And in today's marathon, we will cover all the important static concepts that you need to read, understand, and use it to answer the questions which will be asked in the upcoming prelims examination. Now, before I start the discussion, a very important announcement. Those who want to download the PPT that I'm using today, do not panic, do not worry. It will be available in my Telegram channel. This is the QR code of my Telegram channel. Scan it and basically join the channel and download the PPT. Second important point, our offer is going to end today. That's what I've been told. The courses are available at a price of 17,999, and if you use the code IAS English, you will get an extension of up to 12 months. Those who are interested, do check out the details by clicking on the link provided in the description below. Now, let me start the discussion. Before I start, please do let me know in the chat section. Am I audible and visible for everyone? Do let me know. Am I audible and visible for everyone? Great. And the whole discussion that I'll be taking up today, listen to me carefully. I'll be discussing using the mind map. All the chapters which are needed for the GS paper 3 Indian economy, all of this, I'll be discussing that through the mind map. Please download these mind maps, use it for very quick revision even before the prelims examination as well. Okay, the first chapter, first topic that I'll discuss is essentially the topic of banking. Lot of questions have been asked in the prelims examination on this chapter. Now, what are the important points? First one, the concept of money. What do you mean by money? A lot of you will basically agree with me when I show you this. This is money. This is essentially a 100 rupees currency note. You might have 50 rupee currency note. You might have a 200 rupee currency note. You might have a 10 rupee coin, 5 rupee coin. All of this is money. But what do you mean by money? Money is a medium of exchange. Remember this. Money is a medium of exchange. That is essentially you will use the money to purchase goods and services in the market. You'll use the money to settle transactions in the market, etc. So, money in a nutshell is a medium of exchange. Today, whatever money you might have a currency note or a currency coin. All of this money is called as fiat money. Remember this. All of this money that you have right now is called as fiat money. Now, before I discuss what is the concept of a fiat money and other types of money, first and foremost, the definition, we have taken care of it. Second one, why is there a demand for money in the first place? Why do you require money? Why do I require money? Let's understand these basics as well. Listen to me very carefully. Question can be asked under the concept of a demand for money as well as the functions of money. Demand as well as functions. Listen to me carefully. Why do we need money? Three reasons. One is called as a transaction motive. Second one is called as a precautionary motive. And the third one is called as a speculative motive. What is the meaning of a transaction motive? I want to purchase something in the market. It could be a good, it could be a service. Now, whenever you want to purchase, you will have to make payment. Right? This particular requirement of a making a payment, the mode of making a payment, you need something to make payment, essentially exchange the good or service with. That is the reason we will keep money. That is called as transaction motive. Be very careful because I know a lot of you will be okay with the first and second. That is a transaction as well as precautionary. Lot of you will have regarding the third one, speculative. Let's start. Second one now, precautionary. What is the meaning of the term precautionary motive of having money? You must have seen in your households, lot of cash will be kept. Lot of cash. And if you ask your parents, they will simply tell you there might be some emergency. There might be certain emergency. Let's say after 1 week, you might require to make huge amount of payment for certain reason. There might be a requirement to make payment because you're purchasing a good in the market. There might be a requirement of making a payment for school fees, education fees, hospital bills, etc. That is essentially called as a precautionary motive. So everybody is okay with the first and second, transaction and precautionary motive. What is the third one? Speculative motive. What is this speculative motive? Imagine right now in the market, the prices of certain assets. And when I say assets here, I'm talking about financial assets. Financial assets. For example, bonds. And do not worry, in later part of the discussion, we will cover even the concept of bonds also. Let's say the prices of the bonds in the market have gone down. When the prices of the bonds have gone down in the market, what is your expectation? Your expectation is prices right now are lesser, but in the coming days will start moving upwards. The coming days, the prices of the bonds will start going upwards. So you want to purchase the bonds right now, essentially at a lower price, and sell it later at a higher price, essentially making profits. So remember the term speculative. Speculative essentially means you are expecting a movement to happen. We're essentially expecting certain movement to happen, that is called as a speculative motive. And let's say the prices of the bonds in the market are higher today. Let's say the prices of the bonds are higher in the market today. You will not purchase it. Why? The prices are higher. And if the prices are higher today, you will know that after certain time period, that is in the future, the prices of these instruments will go down. So rather than purchasing today, you will hold on cash. That is, keep the money with yourself. And after the prices of the instruments will go down, you will use the money to purchase the instrument. That is essentially called as a speculative motive. So again, please understand. So far, we have covered two very important aspects. One, what is the definition of money? And the second one is what is the reason? What is the demand? Right? Why do we keep money? What is the reason behind keeping money? So point number two. Let me go to the third point here, the functions of money. And those who will have doubt, listen to me very carefully. I know some of you will be having doubt even while I'm discussing. Please make a note of two things. Make a note of the slide number and make a note of the point which is your doubt. After every 1.5 hours, I will ask you if you have any doubts. At that point of time, please tell me what is the slide number, what is the point number, what is the area of your doubt. Is it okay? Now, let me go forward. What are the functions of money? What are the functions of money? We generally divide the functions of money into primary, secondary functions. And there'll be many more functions which are called as additional functions or contingent functions. Right? Primary and secondary are the most important one. Right? What are the functions of the primary? Right? Let's say in the form of primary. First one, money will be used as a medium of exchange. That is, for purchasing goods and services, when you make payment, you will exchange rupees with a good or a service. That is called as a medium of exchange. Primary. Second, measure of value. You want to define anything in the market, you can define it in terms of rupees. For example, can you define this in market in terms of rupees? Yes. Can you define this particular bottle in the market in terms of rupees? Yes. Can you define, right, let's say a biscuit packet in the market in terms of rupees? Yes. Vegetable, gold, piece of land, a flat, a car, aeroplane, yes, 400 missiles, etc., or defense system, etc. Yes, right. Everything in the market can be defined in terms of money. That is essentially measure of value. So these are the two very important functions of the money which are defined as primary functions. What are the secondary functions of money? One, it can be used to store value. It can be used to store value. What do you mean by store value? Let's say I have certain amount of money today. Can I purchase, using this money, can I purchase a piece of land? Can I store it for 5 years, for 10 years, etc.? Yes. Right? It can be used to store value. Second one, it can be used to transfer wealth as well. That is, I will purchase certain piece of land today. After 10 years, I will transfer it to, let's say, right, somebody in my relatives. I'll transfer it to my children. I'll transfer it to my parents. That is, the value or the wealth can be transferred. And the money can also be used under the secondary function as a mode of a deferred payment. That is, essentially, you take a loan today, you will repay the money, you will repay in terms of rupees in the future. Right? That is essentially the function of money called as deferred payment. Everybody is okay with the functions of money? Everybody is okay, right? So, definition of money. Second one is a demand for money. And the third one, the functions of money. Let me go to the fourth point. What are the different types of money? What are the different types of money? First one, commodity money. Second one is fiat money. Third one is fiduciary money. And the fourth one is commercial bank money. Okay, let's start. Earlier, please understand, today, whatever we are using, I've told you this earlier also, whatever we are using today is called as a fiat money. Be it the currency coin or currency notes. Okay, the currency coins as well as currency notes, both are fiat money. And please remember, before we shifted to the concept of the fiat money, we used in the earlier period, we used the concept of a barter system. We used the model of barter system. In barter system, essentially what used to happen, the goods or services would be exchanged with goods or services. Simple. We used to exchange goods or services with goods or services. I will basically give you, let's say, the fruit, such as, let's say, apples. I'll sell apples to you, and in return, you will give me 2 cows. I will sell, let's say, coconuts to you. In return, you will give me or you will pay me in terms of, let's say, pineapple. So the goods or services would be exchanged with other goods or services. That is essentially the concept of a barter system. But the problem with the barter system was that there is a problem in terms of finding double coincidence of ones. Remember the term double coincidence of wants. What do you mean by double coincidence of wants? If I want to sell, let's say, apple in the market and I want to purchase, let's say, 2 cows, when I sell apple, I will have to find somebody in the market who is willing to purchase apple and wants to sell cows. What I want to sell, the other party should be willing to purchase it. And what I want to purchase, the other party should be willing to sell it. That is essentially called as double coincidence of wants. That was a problem. And second, if the products that are there with me, if these are, let's say, vegetables, if these are fruits, etc., essentially those products which will have very short duration or which are perishable in nature, very difficult for me to find a buyer or a seller or a buyer in case of the market. That is, I want to sell, let's say, a perishable commodity such as onion, or let's say tomatoes for that matter. Very difficult for me to find somebody who wants to purchase this particular product. So, double coincidence of wants, the perishable items, etc., basically imposed a restriction over the success of the barter system. And that is a precise reason, slowly and steadily, from the barter system, part of the barter system or related to barter system, we moved to a concept called as commodity money. We moved essentially to another system called as commodity money. And in case of commodity, what generally used to happen, we used to use certain commodities such as gold, such as, right, let's say, the food grains, or for that matter, bronze, silver, right, or let's say pearls. etc. These kind of commodities were used to make payment or accept payment in the market. Is everybody okay? This would be used to make as a payment or accept as a payment in the market. That is essentially called as a commodity money. The defining feature of a commodity money, remember this, the defining feature of a commodity money is that the commodities had intrinsic value. Is it okay? The commodities had certain intrinsic value. Remember this particular point. Sir, what do you mean by intrinsic value? The commodities are made up of certain, right, let's say raw material. Commodity money is made up of certain commodity. That commodity was of a demand in the market. Individually, it had value in the market. Just to give you a very simple example, a lot of you might be wearing gold ring. Now you tell me, a gold chain, gold ring, etc. Don't you think gold on its own has value in the market? And when you use gold to manufacture something, a gold coin, a gold ring, or a gold chain, etc., don't you think because the gold has value, the output will also automatically have value? So apply the same logic here. The commodity money had lot of intrinsic value. Remember this particular point. And from commodity money, over a period of time, we shifted to one more type of money that is essentially called as fiat money. From commodity money, we shifted to the concept of fiat money. What is this fiat money? Fiat money is the money which is issued through order of the government. It is the money which is issued through order of the government. For example, any currency note that you use today, either to make payment or receive the payment, essentially is issued in the market through the order of the government of India. Although it could be printed by Reserve Bank of India, please understand, it could be printed by Reserve Bank of India. The order essentially comes from the government of India. Hence, this is called as a fiat money. The kind of fiat money that we use today are essentially the coins, the currency coins, and the currency notes. Okay, currency coins and currency notes. The currency notes are printed by Reserve Bank of India. These are printed by Reserve Bank of India. Please do let me know in the chat section. Do you think all the currency notes are printed by RBI? If UPSC will ask you this statement, all the currency notes in India are printed by Reserve Bank of India. Is the statement true or false? Correct? Incorrect? Yes or no? All the currency notes are printed by RBI except 1 rupee note. Except 1 rupee note. Except 1 rupee note. And I hope you understand this. That's the reason the 1 rupee note is not counted as a part of the currency notes in India. The 1 rupee note is counted as a part of coins. Remember this. The 1 rupee note is not counted as a part of currency note. It is counted as a part of coin in India. And the 1 rupee note will generally carry the signature of the finance secretary against the currency notes, other currency notes, which will bear the signature of the current RBI governor or the presiding RBI governor. And that happens because, remember, the laws which will mandate printing of currency notes is different. And the laws which will allow RBI, or the provision which will allow RBI to print is different, and the minting is different. Minting of the coins is done by the government, and the printing of the notes is done by Reserve Bank of India. Can anybody tell me? I'm just looking at the chat section now. Can anybody tell me where are the currency notes printed in India? Let me see. Where are the currency notes printed in India? I'm talking about printing, by the way. Start. Where are the currency notes printed? 4 places. Correct. What are the 4 places? Right. One is Salbani. One is Salbani in West Bengal. Second one is Nasik. Nasik in Maharashtra. Right. Third one, Mysore. Absolutely right. Mysore, right? Essentially in Karnataka. And the fourth one is Devas. Devas in Madhya Pradesh, MP, Madhya Pradesh. So these are the four places where the currency notes are printed in India. Please make a note of it. UPSC can ask you, please make a note of it. On the other side, let's start. Where are the currency coins minted in India? Where are the currency coins minted in India? Let me see how many of you know the answer. Start now. Where are the currency coins minted in India? Right? Noida, that is one place. Second one is Hyderabad, Nasik. I'm sorry, Noida, Hyderabad, Mumbai. Mumbai. Right? So these are the some of the very important places. Please make a note of all of these places. Make a note of all of these particular places. UPSC can ask you about the places where the coins are minted or notes are printed. UPSC can ask you a question about this. Okay, let me go forward now. One of the very important features of the fiat money, that is especially the currency notes, remember, they do not carry intrinsic value. They do not carry intrinsic value. They do not carry intrinsic value. That is a currency note, for example. Let's say this is a currency note. This has a value of 100 rupees because I hope you understand. Because the government of India has issued an order. If there is no order of government of India, this currency note will be simply a piece of paper. That's the reason the currency notes do not carry the intrinsic value. What about coins? Right? Do you think all the coins, right, do not carry intrinsic value? No, please understand. Coins carry certain intrinsic value, especially those particular coins which are commemorative in nature. Have you heard of this? Which are commemorative coins in nature. Commemorative coins carry very high intrinsic value. For example, last year or a year before that, the government of India issued or released a coin commemorate to basically commemorate the 75 years of independence. 75 years. So in that particular situation, when this particular coin was released, it had multiple metals content in it. The content of the metal was very high to the extent that the actual price of the metal which was used to produce the coin was much, much higher. And that is the precise reason you will see lot of these commemorative coins are not used for circulation purposes. Lot of these coins are not used for circulation purposes. These are essentially collector editions. They will basically auction them. You'll have to participate in a bidding process, right? Or purchase these coins and simply keep it with you. Do not circulate them. Do not pay, right, using these particular coins. But if somebody will give you these coins in the form of payment, collect it. Use it. Okay, done. So these are certain important points regarding the fiat money. The fourth type of money, commercial bank money. What do you mean by commercial bank money? Listen to me carefully. In case of the commercial bank money, bank will collect deposits, use the deposits to give loans. Is the point clear? I'll repeat the statement. The bank will collect the deposits, use the deposits to give loans. Here the bank is not creating here the bank is not printing money. Here the bank is not printing or minting anything. The bank is simply collecting the deposits and giving this in the form of a loan. And that money is called as a commercial bank money. A lot of you are saying check. A lot of you are simply saying, sir, it is a fiduciary money. No, my dear, commercial bank money is the loans which are created. Right? Essentially, the third one I'll discuss now, fiduciary money. Fiduciary money example is a check. The example for fiduciary money is a check. Right? For example, if I issue a check to you, that is fiduciary money. You will take the check, go to the bank, deposit the check, and the bank will simply transfer the money into your account. That is essentially the example of a fiduciary money. Fiduciary money examples are checks, the DDs, that is the demand drafts, etc. Right, so these are the four different types of money. Please make a note of these. UPSC can ask you questions in any one of these. And please understand, in the context of commercial bank money, there is a term. The term is fractional reserve system. Please remember this also. Fractional reserve system, FRS, fractional reserve system. What do you mean by fractional reserve system? When the bank will collect deposits, it will not use all the deposit money to lend in the market. It cannot use the complete deposit to give in the form of a loan in the market. Part of the deposit the bank has to keep with itself, and that is called as a fractional reserve system, FRS. Very, very common, especially in countries such as India. The banks, that is the public sector banks, the private sector banks, etc., follow the principle of fractional reserve system. Okay, so we are done with the four types of money. Let me enter into the banking now. We are slowly and steadily moving into banking. Whenever you talk about banking, listen to me. Generally, the banks are divided into two types. One is called as a scheduled commercial bank, and the second one is non-scheduled commercial bank. Scheduled, non-scheduled. What is essentially the difference? The scheduled commercial banks are registered under Schedule 2 of RBI Act. These are registered under Schedule 2 of RBI Act. Whereas the non-scheduled commercial banks, these are not registered. Remember this. These are not registered under Schedule 2 of RBI Act. Now, because you are registered and non-registered, whether you can get access to the services of RBI, whether you have to keep, let's say, CRR with yourself or with RBI, whether you can get loans from RBI or not, all of these will basically vary. Those who are scheduled will basically have to maintain CRR with RBI, will get access to borrowing from RBI, will have to meet conditions set by RBI, etc. Whereas in the context of the non-scheduled, usually these kind of features, these kind of services are not offered by Reserve Bank of India to the non-scheduled commercial banks. Any example of scheduled and non-scheduled? The public sector banks. The public sector banks. The public sector banks are scheduled commercial banks. And a lot of these urban banks, or let's say urban cooperative banks, or local area banks, lot of these are non-scheduled commercial banks. Done? So these are certain important points in the first slide. Let me go to the next one now. Let me go to slide number 7. Let me continue discussion into the banking here. Reserve Bank of India. I expect one or two questions to be asked on Reserve Bank of India. In the prelims, definitely questions have been asked in the past, and they will be asked in the the upcoming civils as well as the next year civils as well. That is on the area of Reserve Bank of India. What are the important points? Point number 1. Reserve Bank of India was established with the passage of RBI Act of 1934. Remember, point number 1, it was established with the passage of RBI Act of 1934. Point number 2, it was established on 1st April 1935. Established on 1st April 1935, started operating. Initially, the Reserve Bank of India was owned by the private investors, privately owned. Initially, it was privately owned, and later on, the ownership was transferred to Government of India. That is in which year? 1949. Nationalization. The Reserve Bank of India was nationalized in 1949. Now, these are important points, right, regarding the origin of Reserve Bank of India. What are the important sections of Reserve Bank of India? Right, that is RBI Act of 1934. What are the important sections? And when you look at all of these particular points, you will realize there is a potential question which can be asked in the prelims on the sections itself. One example I'll tell you. This year itself, the Reserve Bank of India transferred record surplus to Government of India. I don't know how many of you have read that. The Reserve Bank of India transferred record surplus to the Government of India. Now, what is the number, section number, which is associated with the surplus transfer to Government of India from RBI? That is section 47. Remember this. Section 47 talks about essentially the transfer of surplus from Reserve Bank of India to the government. And if you ask me, sir, what do you mean by surplus here? Surplus essentially means RBI will perform certain functions, it will incur expenditure. At the same point of time, RBI also generates revenue. RBI also earns a revenue. So the amount of income earned is higher compared to the expenditure. That is called as a surplus. For a normal company, we use the term profits for a normal company. But RBI is not a commercial entity. It is basically an entity 100% owned by Government of India. That's the reason we use the term surplus. And based on the recommendation of Bimal Jalan Committee, Bimal Jalan Committee, based on the recommendation of Bimal Jalan Committee, we have a formula now as to how much of the surplus has to be transferred from Reserve Bank of India to the Government of India. Right? So record surplus has been transferred. Potential question, please make a note of it. Section 3 talks about establishment of RBI. Section talks about capital held by RBI. Section 17 talks about business carried out by RBI. Business carried out by RBI. Make a note of this. Why? I'll tell you. Very recently, it was revealed that RBI is holding huge amount of government securities, gold, etc. What is the section which will dictate how RBI is supposed to function? Where RBI is supposed to invest? That is section 17. Please remember that. A lot of you, I know, you will read about gold. Gold prices have increased. Central banks are purchasing lot of gold, etc., etc. But which section of RBI Act will dictate that RBI can invest only in these areas? Section 7. Section 22, exclusive rights over issue of currency notes. Section 7, the Government of India, after consulting RBI, will issue a directive to RBI. RBI has to follow it. That is Section 7. Section 8, composition of Central Board of Directors. In the current affairs class, we looked at certain sections where monetary policy committee will be formed. What is the composition of monetary policy committee, etc., etc. But UPC might ask you, what is the composition of the Central Board of Directors? That is the decision-making body of Reserve Bank of India. And this Central Board of Directors, please do let me know, what is the maximum number of members who are present in the Central Board of Directors? According to the RBI Act, there can be certain vacancies right now. Don't worry about it. What is the maximum composition or maximum number of members who are present in the Central Board of Directors? 21. 21. Please remember this. And I can see a lot of you are basically answering. Generally, the way I teach, I tell the students to memorize a 1, 4, 10, 4, 1. A mirror image. 1, 4, 10, 4, 1. And I'll say generally on one side, write additional 1. That is 21. Totally the 21 members. This is a composition. Please have a look at it. Questions can be asked on the composition of Board of Directors of Reserve Bank of India. Done? So these are certain important points associated with, right, let's say the important sections of Reserve Bank of India. Let me go forward. Functions of RBI. The functions of Reserve Bank of India. And those who are wondering, sir, how can I download the PPT? Initially, when I started the discussion, I basically displayed a QR code. If you have not seen that, you can use this particular address to search in the Telegram channel, join the Telegram channel, and the PPT will be made available after my class. That's my promise. Mother promise, by the way. Okay, you will get the PPT, don't worry. Now let me start. What are the functions of Reserve Bank of India? Very important functions. What are the functions of Reserve Bank of India? First one, controlling inflation. Controlling inflation is the function of Reserve Bank of India. And that's a reason we have signed an agreement by the name of MPFA, Monetary Policy Framework Agreement. Monetary Policy Framework Agreement. This was signed in 2015, implemented from 2016. Under MPFA, the agreement basically says once every 5 years. I repeat, once every 5 years, Reserve Bank of India, right, that is, Government of India will consult RBI and decide what will be the inflation target. What will be the target inflation for the next 5 years? And that is essentially decided under MPF. So from 2016 to 2021, first round is over. From 21 to the next 5 years, that is till 2026, that is essentially being implemented now. What is the inflation target? Right now, the inflation target is 4% plus or minus 200 basis points. 4% plus or minus 200 basis points. That is essentially the inflation target is kept maximum at 6% and the minimum, that is the lowest, at 2%. 2% is the floor level, 6% is the ceiling level. And please remember this, the inflation that I'm talking about here is essentially the headline CPI. It is the headline CPI inflation rate. Okay, that is the concept of inflation targeting. Apart from this, certain other important points. RBI, that is a monetary policy committee, will have to meet at least four times in 1 year. Once every 6 months, they will have to publish a report. The monetary policy committee, if there is right, let's say for 3 consecutive quarters, if the inflation is more than 6, less than 2%, etc., for 3 consecutive quarters, then the monetary policy committee will have to give a written explanation to Government of India regarding this. Let me ask you a question regarding this. If the monetary policy committee submits a report to the Government of India because they have not been able to bring inflation under control, should this be displayed, or is there any provision which says it should be made public? Do let me know. Any provision anywhere, right? When this report is submitted, do let me know. Is there any provision which says it should be made public? It should be discussed in the parliament, etc. There is absolutely no provision. Remember this. There is absolutely no provision to make this report public. If the government wants to make it public, it can do. If the government wants to simply keep it as a secret, it is right absolutely their prerogative. So remember, there is no provision to mandate that the report be discussed in the parliament or report be made public, right, to anybody. And everybody is okay. There was a very interesting question by a student. Sir, what will be the duration of this particular session? I've planned for 12 hours. Simple, I've planned for 12 hours. That is essentially covering every static portion that is needed, revision, and to make it easier for you to revise it later, and basically for me to reduce the burden of writing, I've made the mind map for every chapter. Every chapter that I'll be discussing, there is a mind map. Please download these mind maps, use it for revision before the prelims as well. Okay, let's go forward. Next one, monetary policy. Monetary policy. What are the important points in the monetary policy? Please have a look at this particular table first, or let's say the flow chart here. Monetary policy, or else also referred to as a credit control tool. Monetary policy or credit control tools. These are divided into two parts. One is called as a quantitative, and the second one is a qualitative. Quantitative, qualitative. What is essentially the difference between both qualitative and quantitative? In quantitative, you can simply change the money supply. Overall money supply can be changed. Overall money supply. In the full economy, you can either increase the money supply or decrease the money supply. That is quantitative. What about qualitative? In case of qualitative, you can target a specific segment of the economy. You can target a specific sector of the economy and change the money supply in this. That is essentially called as qualitative. And that is the precise reason. There are two other names for this. Quantitative are also referred to as general credit control tools. General. Whereas qualitative are also referred to as specific credit control tools. And one is general, right? And the second one is specific. Now, let me start with quantitative here. That is general credit control tools. And do not worry, I'm not going to write everything, right? To prepare arrow marks like this, explain to you the whole process. No, it's a revision session. So, what I've done is I've prepared a very small table. Please have a look at the small table here that I've prepared, essentially summarizing what will happen under each of the tools. Just observe. Let's start with the first one, the most important policy tool or the policy rate, that is repo. The most important one, the policy rate is repo rate. What happens in a repo rate? The definition of repo says under this, Reserve Bank of India will give a loan to a bank for a short duration. Remember this, for a short duration, and will charge a rate of interest on this. That is called as repo rate. But technically speaking, listen to me carefully now. Repo stands for repurchasing order. Repo stands for repurchasing order. What do you mean by repurchasing order? Repurchasing order essentially means where one party will sell an asset to another party, and after specific time period it will repurchase the asset at a specific price. Is it okay? I'll repeat the statement here. Please listen to me carefully. Under repurchasing order or repo, one party will sell the asset to another party with the promise of purchasing it back after certain time period and at specific price. It's a contract, it's an agreement where today the asset is sold and after specific time period it is purchased at a specific price. This is called as a repurchasing order. Is everybody okay with the explanation here? Banks will borrow from Reserve Bank of India and banks will pay a rate of interest. That is repo. And have a look at this. Are collaterals involved here? Are there any collaterals involved in the repo? Yes, collaterals are there. Right. Second one, reverse repo. What is reverse repo? Reserve Bank of India will take a loan from a bank and pay rate of interest to the bank. Right? Simple explanation and then technical argument. In case of reverse repo, Reserve Bank of India will take a loan, that is collect money from a bank and will pay rate of interest to the bank. That is essentially reverse repo. Or else you can also say that under reverse repo rate, the banks will park a certain amount of funds with RBI and RBI will pay certain rate of interest on the funds which are parked by the bank. That is essentially called as reverse repo. But again, technically speaking, it is a type of repurchasing order. Is it okay? It is a type of repurchasing order. Only thing is, in the first case, bank is selling the asset to RBI with the promise of repurchasing. In the second case, Reserve Bank of India is selling the asset to the bank with the promise of repurchasing. Is everybody okay? That's the reason. Are the collaterals required? Are the collaterals involved in case of reverse repo? Yes, collaterals are involved. Done? Okay, so repo and reverse repo. And in terms of rate of interest, always remember repo will be here. Reverse repo will be below repo. Is it okay? Repo, if it is, let's say, hypothetically 4%, reverse repo will be less than 4%. But please understand, there is a problem with reverse repo. What is the problem? The problem is, what if RBI doesn't have sufficient government securities? Simple, right? You're saying banks will deposit money, RBI will give government securities. What if RBI doesn't have sufficient government securities? And that's a precise reason we have introduced one more tool now, standing deposit facility. Remember this, standing deposit facility, SDF. Which committee recommended SDF? Do let me know in the chat section. I'm able to see your chats. So do not hesitate. Let me know. Which committee recommended standing deposit facility? Huh? Anybody? Nobody is willing to answer now. At which committee recommended? Urjit Patel Committee. Tushar Kumar says Urjit Patel Committee. And question mark after that. Narsimham Committee. Khurshid Narsimham Committee. Ilma Islam Bimal Jalan Committee. Motivation Guru Raghuram Rajan Committee. My dear Urjit Patel Committee. Please remember Urjit Patel Committee. Raghuram Rajan Committee is more associated with the Financial Stability Development Council, FSDC. Remember that also. Right? Rangarajan Committee is more associated with, let's say, effective revenue deficit. At Bimal Jalan Committee is associated with surplus transfer. Urjit Patel Committee is associated with the STF. And always remember this, if Government of India wants to basically introduce a new tool, they want RBI to do something else now. They want RBI to follow STF. They want RBI to basically have a flexible inflation targeting. For all of it, you need to amend RBI Act. For all of it, you need to amend RBI Act. Remember this. All of this, you need to amend RBI Act. So if UPSC will ask you, RBI Act was amended to introduce STF. RBI Act was amended to introduce inflation targeting. Yes. Right? All the statements you will have to say, yes, these statements are correct. Okay, let me go forward. But before I go forward, standing deposit facility, how is it different compared to, let's say, reverse repo rate? Apart from collateral. Collateral is not needed because in case of standing deposit facility, basically RBI will collect deposits and pay rate of interest. Right? It's purely a lending and borrowing rate of interest. Remember this. Standing deposit facility purely is a lending and borrowing rate of interest. RBI collects money, pays rate of interest. No security, no repurchasing, nothing. But in addition to that, remember one more term. There is a term called as standing here. Right? There is a term standing. What does it signify? The term standing signifies that it is available throughout the year. Remember this. STF is available throughout the year. On the other hand, repo, reverse repo, these are available whenever RBI announces them. The facilities are open wherever RBI announces. But on the other hand, STF is available throughout the year. Let me give you one more example here. Can you see this one? First, second, third, fourth, and fifth one. Can you look at the fifth tool as well? That is marginal standing facility. This is also available throughout the year. Right? But in marginal standing facility, please listen to me carefully. The banks will borrow for a very, very short duration. Under MSF, the banks will borrow for a very, very short duration from Reserve Bank of India. Please understand the difference between STF, MSF, repo, reverse repo. Understand all of them. Do not simply assume RBI will use anything whenever they want to. No. For example, let me ask you a very simple question. If RBI wants to increase the money supply for a longer duration, do you think RBI will use repo rate? Think of it. If RBI wants to increase the liquidity for a durability basis for a longer duration, do you think RBI will use repo rate? No. But don't you think RBI using reverse repo rate can increase the liquidity for a longer duration in a bank? For example, if reverse repo rate is reduced, banks will not prefer to keep deposits with RBI. They will keep it with themselves. If CRR is reduced, banks will have more money for a longer duration now. I hope you understand, right? Be very careful with these kind of statements used by UPSC in the preliminary examination. Okay. So marginal standing facility, very short duration, generally on overnight basis. Banks will borrow from Reserve Bank of India. Collateral required? Yes, collateral is required. Okay, so these are the four. Fifth one, bank rate. Serial number 6, but at the fifth tool I'm discussing. Bank rate. Bank rate is purely a lending rate of interest. Bank rate is purely a lending rate of interest. That is essentially here, banks will borrow from RBI, use it to lend in the market. That's it. Banks will take a loan pay a rate of interest and use it to essentially lend in the market. That is the bank rate. And that's the reason a lot of times you will get confused. They will say in the books, repo rate is for short term lending, bank rate is long term lending. Correct? I'm pretty sure some of you might have seen this in the book. Repo rate, they'll say, for short term lending, and bank rate is for long term lending. Okay, so these are the 5 very important tools. Now let me discuss 2 reserve requirements. Because earlier I was discussing fractional reserve system, FRS, and there was one student who asked, what is the difference between FRS and CRR? I'm explaining it now. Listen to me. There are 2 reserve requirements. One is called as a CRR, cash reserve ratio, and the second one is called as SLR, statutory liquidity ratio. The names are there here. One is CRR and the second one is SLR. What is essentially the difference? Before I tell you the difference, let me explain to you in short the concept of NDTL. Net demand and time liabilities. Net demand and time liabilities. What is the meaning of net demand and time liabilities? The banks will collect deposits. These will be of 2 types. And this was asked once in preliminary examination. Listen to me. The banks will collect 2 types of deposits. One is called as essentially the time deposit, and the second one is called as a demand deposit. And whatever deposits are collected by the bank, these are essentially the liabilities of the bank. These are liabilities of the bank. Right? What do you mean by liability? The bank has to return it back. The bank has to give it back. That's the reason liability. Now, time deposits are collected for a specific period of time. It could be for 1 year, could be for 2 years, could be for 10 years. Deposits. Okay. Demand deposits. Whenever there is a demand from the customer, the bank has to return the deposit. The demand is there for the customer. They will demand this money from the bank. Bank has to allow this money to be with. Best example, current accounts, savings accounts, right? So these are the demand deposits. So you take the sum total of both of these deposits. What you get is gross demand and time liability. Is it okay? Gross demand and time liability. Out of these deposits, there are type of deposits which are called as interbank deposits. There are types of deposits called as interbank deposits. You take out interbank deposits, what is left out is net demand and time liability. Everybody is okay? So this is NDTL. Please make a note of this. Now come to cash reserve ratio and statutory liquidity ratio. The cash reserve ratio represents percentage, I repeat, percentage of NDTL that the banks will have to keep with Reserve Bank of India. The CRR represents percentage of NDTL that the banks will have to keep with RBI. Right? And on this CRR, Reserve Bank of India doesn't pay any interest. No interest is paid by Reserve Bank of India. And this is generally in the range of 3 to 15%. It is fixed in the range of 3 to 15%. Then what about SLR? Statutory liquidity ratio. The banks will have to keep percentage of NDTL with themselves. Right? I'll repeat this. Statutory liquidity ratio. The banks will have to keep percentage of NDTL with themselves, not with RBI, with themselves. Essentially, there are 3 forms in which SLR is maintained. One is cash. One is in the form of cash. Second one in the form of gold. And the third one in the form of approved government securities. Approved government securities. And so this is a statutory liquidity ratio, and this is cash reserve ratio. And that's the reason I've written NA. Right? Understand this. I've written NA in the context of collateral. What do you mean by NA? Not applicable. Right? Collateral concept is not applicable to CRR as well as SLR because these are essentially reserve requirements. This is not a lending and borrowing. These are reserve requirements. So everybody is okay? Everybody is okay with the quantitative set of tools? I've taken 10 minutes. I've used the table to explain all the quantitative tools. You can expect one question from the area of quantitative tool. Okay, now there is one more tool here. A lot of you are confused regarding this. Listen to me carefully. Open market operations. Okay, open market operations. OMO. What do you mean by open market operations? Listen to me carefully regarding this. Open market operation basically refers to RBI selling or buying government securities. RBI buying or selling government securities. That is called as, right, open market operations. And open market operations can be two types. One is called as outright. I'll write it separately here. One is called as outright OMO. One is referred to as a outright OMO. And the second one, right, I don't know how many of you have read NCRT, repo. Do let me know how many of you have read NCRT regarding this. In NCRT book, this is given. Right, under OMO, they will basically list out two types. One is called as an outright, and the second one, right, is a repo. And if you're wondering, sir, what is the difference between outright and repo? My dear, tell me, under repo, don't you think RBI essentially will give money? This is RBI. Okay, RBI will give money because the bank has sold government securities. Correct? Everybody is okay? Bank has sold government securities, hence RBI is giving money. But don't you think this is only for short time period? Correct? This is only for short time period. How? Right? I'm sorry. How long? Let's say 7 days. It could be for 14 days, etc. So I hope you understand. Repo, that is a type of OM only, but that will essentially change the liquidity for a shorter duration. It will change the liquidity for a shorter duration. That is repo, it is a part of OMO. Whereas in case of outright, let's say RBI will simply purchase government securities, pay money to the bank. RBI will purchase government securities, pay money. That's it. Right? In case of outright, the money supply will be for durable time period. The money supply will be for a longer time period. So be very careful. UPSC can ask you, can OMO be used to induce liquidity for a durable time period? Yes. But is it all the types of OMO? No. Only the outright OMO can be used to induce liquidity for a longer time period. Is it okay? Everybody is able to understand the difference between all of them. And before I go forward, let me throw one more term here. How many of you heard of the term tri-party repo? Let me see how many of you heard of this. Tri-party repo. Right? You have heard of the term repo. Right? Definitely, yes, you should have heard and you have read also repo. But what about tri-party repos? How many of you heard of right tri-party repos? Understand, the concept is simple. Don't complicate it. In repo that I explained just now, can I simply say there are only two parties? Do let me know. Simplify, don't complicate it. The repo that I explained, there are only two parties, RBI and a bank. But what if I say instead of two parties in a repo transaction, there are three parties? That is, let's say there is one authority which will ensure the transactions are completed. Let's see, right? Instead of two parties, let's say there are three parties, right? One is the buyer and the other one is seller. And there is one more entity which will ensure the transactions are completed. That is, my dear, a tri-party repo. Is it okay? That is essentially a tri-party repo. And I know somebody will ask me, sir, who will be the third party here? Which is the entity? Clearing corporation. Clearing Corporation of India Limited, CCIL, Clearing Corporation of India Limited, it will act as a third party, ensuring that the transactions are completed. Right? So repos can, I'm sorry, tri-party repos can also be asked in the prelims. Just be very careful. Okay, done. So quantitative is done. Before I go forward, this is the sequence. Please make a note of this sequence. Repo rate is the most important policy rate. Repo rate is the most important policy rate. Below repo, you will have standing deposit facility, SDF. Below repo, you will have a standing deposit facility. Below standing deposit facility, you will have reverse repo. Above repo, you will have the marginal standing facility, and you will also have a bank rate. Is it okay? Above repo, you will also have marginal standing facility and the bank rate. And if you are observing very carefully, the MSF rate as well as the bank rate, both are one and the same. Both are one and the same. Okay, the MSF and bank rate generally that is fixed again by Reserve Bank of India. Both are one and the same. Then, and what is the importance of writing this sequence? If repo rate changes, I repeat, if repo rate changes, automatically other rates will also get adjusted. I'll repeat this statement. If repo rate changes, automatically other rates will automatically change. If monetary policy committee will change the repo rate, reverse repo rate automatically gets changed. STF automatically gets changed. MSF automatically gets changed because all of these are connected to the policy rate, that is the repo rate. And final point associated with the quantitative here, the policy corridor. There is a term called as policy corridor. Right? What do you mean by policy corridor? Right? Listen to me carefully. Imagine if repo rate is, again I'm just taking a hypothetical number, not the current one. Do not worry about it. UPSC will not ask you all of that. If repo rate is, let's say, 5%, reverse repo rate, reverse repo, which was earlier used, today it is not used. I'll tell you why. Just give me some time. Reverse repo rate, let's say, is 4.5%, and right, let's say, marginal standing facility is 5.5%. Then, my dear, policy corridor will be this. That is 100 basis points. 5.5% and 4.5%. That will be called as a policy corridor. Is it okay? And if you're getting confused, sir, what do you mean by that? It is essentially representing what is the rate of interest, maximum rate of interest charged by RBI, and maximum rate of interest paid by RBI. Is it okay? And today, I hope you understand this. Are we using reverse repo rate as a main tool to collect deposits from the bank? We are not using reverse repo rate. We have basically introduced a new tool called as standing deposit facility. And that's the reason now generally the policy corridor will be calculated by taking MSF and STF rates. Is it okay? For all intentions and purposes, the reverse repo rate has become useless. Why? STF is available throughout the year. It is available throughout the year. So that is the reason now the rate difference between MSF and the STF, that is essentially taken as a policy corridor. Is everyone okay? Can we move forward now? We are done with all the points that you need to understand from the quantitative tools. Let me shift to qualitative tools. One is rationing of credit, priority sector lending. PSL essentially represents the percentage of the loans. I'm using the term loans, but technically it is called as ANBC, adjusted net bank credit. Okay, so it is the percentage of loans that the banks will have to give to specific sectors. We have totally 8. Most important one, agriculture, MSME, export, right? You have weaker sections of the society. We have educational loans, housing, etc. So totally 8 areas are there. Maximum weightage has been given to agriculture sector. That is 18% of the total loans will have to go to agriculture sector. Done? Everybody is okay? For most of the banks in India, it is 40%. For most of the banks in India, the PSL is a 40%, right? But for RRBs, right, it is 75%. For the small finance bank, 75%. For urban cooperative banks, it is 60% now. It has been reduced to 60% for urban cooperative, right? That is one, rationing of credit. Second one, variation of margin requirements. Right? Be very careful with the second tool here. I'll tell you why. Be very, very careful with the second tool, variation of margin requirements. Why? There has been a lot of discussion in the context of gold loans. Correct? All of you heard of the gold loans? There has been a lot of discussion in the context of gold loans. And with the prices of the gold being very, very high, going up very, very high, the banks are also becoming very about or worried about or concerned about more and more gold loans being issued. And so have a look at this. What is the connection of right? Let's say the term that I've written here, that is margin requirement with the gold loans. Listen to me carefully. Whenever you take any loan, the bank will give you the loan up to certain level of the asset you want to purchase. Simple. Okay. Whenever you want to purchase anything from the market, or you want to buy a car, you want to buy, let's say, a house, you want to buy, right, let's say, a company, etc., certain percentage of the value of the asset will be given in the form of a loan, not the 100% of the value of the asset. That is essentially, there will be a difference between value of the asset and the gold loan given. If the value of the asset is, let's say, 1 CR, the gold loan, let's say, is given at 70 lakh rupees, then, my dear, remaining 30 lakh rupees is the amount that you will have to pay from your pocket, and that is called as margin. Is it okay? That is essentially called as margin, right? So if you vary the margin requirements, and this is in the context of gold loan as well, is applicable to gold loan as well. In the context of the gold loan, remember, there's a term called as loan to value ratio, LTV ratio. Loan to value ratio. Right? RBI decides the loan to value ratio. It is around 75% now. So essentially can be connected to the gold loan. And what is the importance of this? If the margin is changed, if RBI will increase the margin, then you will have to pay more money from your pocket. You will take lesser loans. If RBI will reduce the margin, you can take more loans, purchase right, more assets from the market. So the margin requirements can also be used to address the kind of loans which are issued in a particular segment or industry. Regulation of consumer credit. More, let's say, housing loans issued, lesser housing loans issued, right? Lesser vehicle loans being issued, lesser gold loans being issued. Consumer credit can be addressed by changing the amount that will be used to give loans. Okay. Moral suasion, direct action, and publicity. Simple terminologies. Moral suasion simply means RBI is asking the banks to follow guidelines. Whenever they are supposed to give a loan up to certain limit, they are not allowed to cross the limit. For certain borrowers, they are supposed to stick to those borrowers. So, whatever guidelines have been issued so far regarding the lending activity, the banks will have to follow the guidelines. And RBI sending a notice to the bank, RBI warning a bank, RBI writing a letter to these banks, right? All of these are referred to as a moral suasion. If the banks do not mend their ways, if the banks do not change their ways, now RBI will take action, which is called as a direct action. And finally, publicity. That is essentially making lot of ads in the market or issuing advertisements in the TV. During IPL, you must have seen lot of these ads will be directed towards the banking consumers in order to provide information to the consumers. This is essentially called as publicity. So quantitative and qualitative. Done. Right. And somebody was asking, sir, you can you write this somewhere that will be useful for me to revise, etc. Listen to me very carefully. Before I go forward, I'll just take 30 seconds for you to understand what I've done so far. Please listen carefully. I've uploaded one document which will basically give you all the decisions of Monetary Policy Committee from January 2024 to April 2025. Sir, where is it present? Right? I don't know. Please tell me where it is present. Use the, right, let's say the name, join the Telegram channel, go to the documents segment, you'll be able to find. The title is also the same. Second one, I've already uploaded. It's been, I believe, around 1.5 months to 2 months. I've already uploaded, I think, around 50-page document. Around 50-page document, essentially providing you the summation or let's say short notes of all the static portion. Sir, where is it present? Same Telegram channel, right? Go there, you will get it. Third, I've given you summation of all the NCRT books, ninth class, 10th class, 11th, and 12th. All the right, some important points from NCRT books. Fourth one, I've given you current affairs notes, CA notes from January 2024 to April 2025. And fifth one, right, I'm giving you mind maps today. This will be there in the same Telegram channel. Do not panic. And I know a lot of you will basically say, sir, you have drawn the mind maps on a PPT, slide on PPT. The slide is colored one. If you give me these particular slides, one, I'll have to take too many printouts. And second one, because it is a color slide, right? The cream color slide is there or light color slide is there, it will not be very clear to me. I'm addressing both of your problems. Don't worry. By doing what? After the session, I will upload a PDF. I will basically upload a PDF on my Telegram channel. And in this particular PDF, it's basically A4 sheet. Right? Basically A4 sheet. In this particular PDF, I think whatever mind maps I'm using, all of these mind maps, I've put them in the PDF in hardly around 15 pages. 15. 1 5. Not 50. 1 5. 15 pages. Right? Just simply take the printout or simply have that PDF either in the mobile or, right, let's say a hard copy or in your laptop. Before the exams, that should be your checking point. That should be a checklist. Point by point, revise, 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 revise. Hardly it will take you, let's say, 2 hours, 3 hours to essentially finish the complete revision of the static portion of current affairs. And I know somebody will say, sir, something is missing. Something is missing out of all of this. That is economic survey. And today, in this particular session, I will cover important areas of economic survey. Certain important areas are there. The total economic survey document has around 480 pages. 480 pages. Should you read all the 480 pages? No. Hardly around, I believe, around 7 to 8 pages of the data is needed for prelims. And, right, basically around 7 to 8 pages for mains. Because I believe questions can be asked from economic survey in the mains as well. Right now, focus is on prelims. So what I'll do is, after the session is over, I will upload one more PDF of economic survey. Please download that as well. So now tell me, if you have taken care of current affairs from 2024 to April 25, economic survey, right, NCRT books, summation documents, right, and the mind maps, should you go beyond this? And again, I know somebody might say question can be asked beyond this also. Yes, questions can be asked beyond this also, but my question is, how much more you want to read? Tell me how much more you want to read. Don't spend too much of time beyond this also. Just stick to these. Read, revise, 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 revise. That's it. Just revise it. That's more than sufficient. Done? Okay. So all of this will be there in my Telegram channel. And I know a lot of you will basically say, sir, where is your link? You have not given the link anywhere, right? I'm not able to find the link of the Telegram channel. That's the reason today I've done something else also. Every slide at the right side top, I've given the link of my Telegram channel. If somebody puts a comment in the right, let's say video section saying that, sir, where is the Telegram channel link? I will realize you have not seen the video. Very simple. I will realize that you have not seen the video. You are simply basically here to type and say, where is the Telegram channel link? So every slide it is there. All you need to do is go search. You will get all the documents will also be there. Okay. Now let me go forward. Done with right all the doubts you have regarding the Indian economy notes, current affairs, static portion. All of it will be made available. Let me go forward. Right. Another function of Reserve Bank of India currency notes. I've already covered it. Currency notes, where it is printed, right? What is the importance of the currency notes, where the coins are minted, right, etc. I've done all of it. Okay. Next function of Reserve Bank of India, banker to the government. Somebody says, sir, I don't have printer, give me printouts. My dear, do one thing. Send me your email ID, send me your address. I will take the flight, come to your home, right? Basically, hand deliver the notes to you. Hand deliver. And if you want, I'll sit there, teach you economics and come back. Okay. Let me go forward. Banker to the government. The next function, banker to the government. Listen to me very carefully. What is the meaning of banker to the government? RBI, in the context of government of India, it will auction the government bonds. It will essentially, right, collect the money, transfer the money to government of India's account. It will maintain the public debt of government of India. It will essentially make payments on behalf of government of India. Right, collect all the monies that the government of India needs to collect, transfer it into the account of government of India. And that is the reason RBI is referred to as a banker to the government. Everybody is okay? Banker to the government. Next one, RBI is also referred to as a banker to banks. Right? RBI is also referred to as banker to the banks. What is the meaning of banker to the banks? Any bank wants to take a loan, they can approach RBI, borrow from Reserve Bank of India. We have seen the tools already. Again, don't worry, we have seen the tools already. So we have covered banker to the bank. And next point is banker of last resort. RBI is referred to as bank of last resort. Why this is referred to as a bank of last resort? Any bank which has a emergency. Any bank is facing an emergency, they can go to RBI, borrow from Reserve Bank of India. And that's a precise reason why RBI is referred to as bank of last resort. Okay. Management of forex. RBI will maintain forex reserves. The forex reserves essentially are four components, or it has four components. One, please do let me know what are the components of forex reserves. I'll write it here. What are the components of forex reserves? This can be asked in the preliminary examination. Be very careful. The four components of forex reserves are one, right? Essentially, STR, special drawing rights under IMF. Second one is gold tranche. And second one is gold tranche or reserve tranche. Third one is foreign currency assets. And the fourth one is gold. Fourth one is gold. These are the four components of the forex reserves. Please make a note of this. I'll give you a connection to current affairs. And UPSC ask you a question like this. Do let me know. With the rise in the gold prices, which of the following are likely to happen? That is a statement. And one of the statement is the forex reserves held by Reserve Bank of India will increase. Statement is correct. Do let me know. I'll repeat the question again. The question statement is, with the gold prices increasing, which of the following are likely to happen? And one of the statement is the forex reserves held by Reserve Bank of India will likely increase. Is the statement true? Yes, the statement is absolutely true. Statement is absolutely true. This is how UPSC can connect with a static portion with current affairs. Be very, very careful. In fact, in today's newspaper, there was one very interesting article, Financial Express. Not in Hindu. I know a lot of you stick to Hindu only. In Financial Express, there was a very interesting article. And the article basically read, in the last 10 years, the value of the gold held under the forex reserves has doubled. I'll repeat the statement. Right? The value of the gold held under the forex reserves has doubled. And this is on account of one, RBI purchasing more gold, and second, the price of the gold going up. Because of these two factors, the value of the gold held by RBI has actually. Is it okay? Done? Right? Everybody is okay? So these are important points regarding the forex reserves. Please make a note of these things. Somebody asked me, sir, what is gold tranche? I'll discuss this when I take up IMF. STR and gold tranche, I'll discuss when I take up IMF. Okay. So the functions of RBI are done and dusted. Expect one question from the functions itself. Expect one question from the functions of Reserve Bank of India. In fact, there are many more functions which are, right, let's say, secondary and tertiary functions. These are the most important ones. Let me go forward. Lending rate regime. Lending rate regime. Now, please understand, historically, if you see, there are different types of rate of interest which are decided in India. Different types of rates of interest. We had primary lending rate, which was again replaced with benchmark primary lending rate, PLR, PPLR. Okay, PLR, primary lending rate. Then there was a BPLR, benchmark primary lending rate. First one 1994, second one 2003. And then we had a base rate regime. Base rate regime 2010. And 2016 we introduced, right? Fourth one, MCLR, marginal cost of funds based lending rate. And one which is famous today in addition to MCLR is the external benchmarking. Then it is external benchmarking. Right now, most of the loans which are given by the banks are either charged under MCLR or charged under external benchmark. This was introduced in 2016. This was introduced in 2019. Please remember 2016, 2019. And this is based on the recommendation of Janak Raj Committee. Janak Raj Committee. And between these two, if UPSC will ask you which is much more efficient, which is right having much more impact on let's say the monetary policy transmission, the answer will be the second one. External benchmarking has a higher impact in terms of having efficient monetary policy transmission. Done. So these are certain important points regarding external benchmarking. If at all a question is asked, I expect the question to be asked either on MCLR or on external bench. Can I go forward now? So far, so good. Do let me know. Right? Many of you are asking for lunch break. You need lunch break. Arey Baba, you joined at 12 o'clock. And I know a lot of you might be having lunch right now as we are speaking. So let me cover certain amount of portion, then we can take a break. Don't worry. Don't worry. Okay. Certain more parts of banking. I'm discussing a lot of banking because questions have been asked in the past. 4 to 5 questions will come from banking. That's a reason. Okay. Next part is cooperative banking. Be very, very careful with the term or the area of cooperative banking. Because of these urban cooperative banks, etc., questions can be asked in prelims. So cooperative banking essentially can be divided into two parts. One is urban cooperative banks. Second one is rural cooperative banks. Urban cooperative banks can be further divided into those which are scheduled and non-scheduled, right? And these can also be divided as a single state as well as a multi-state cooperative. Single state and multi-state cooperative bank. Do not, right, basically complicate the issue of cooperative banks. Urban cooperative banks are just like your normal banks. Is it okay? Urban cooperative banks are just like your normal banks. That is, you go to SBI, you'll keep deposit in SBI. You borrow from SBI. You have, right, let's say loans from SBI, just like a normal bank. But the specialty will come from rural cooperative. Okay? The specialty will come from rural cooperative banks. What is the specialty? Listen to me carefully. The rural cooperative banks are generally divided into one, short-term rural cooperative banks. Second one, long-term rural cooperative banks. The short term essentially will provide the services such as a collection of deposit and lending. But in addition to this, especially the lowest one, that is a PSES, primary agriculture credit societies, they are also involved in providing other services. They are also involved in providing other services. What do I mean by other services here? For example, they will sell seeds, they will provide fertilizers, they will provide warehousing capacity, etc. So the lowest one, that is the PSES, are involved in all of these particular activities. The PSES are assisted by district central cooperative banks, and the district central cooperative banks are essentially overseen and assisted by the state cooperative banks. Right? That is essentially the short term lending or rural cooperative bank structure. And why these are called as a short term? These are called as short term rural cooperative banks because they provide loans to agriculture sector which are of short duration, generally up to 15 months. An important point within this, the primary agriculture credit society is registered as a society. It is not a bank, and that is the precise reason. I'll connect it to one more current affairs, DICGC. All of you heard of this? Deposit Insurance Credit Guarantee Corporation. Under the concept of DICGC, the PSES is not covered. If you keep any deposit with the PSES, you will not get the insurance coverage of up to 5 lakh rupees. Remember that also. Insurance coverage is up to 5 lakh. Okay, done. What about the long term? We have two structures. One is essentially primary cooperative agriculture and a rural development bank, P card B. Primary cooperative agriculture and a rural development bank. And the second one is state cooperative agriculture and a rural development bank. These are banks essentially providing long term loans to the agriculture sector. Okay, so this is essentially the structure of cooperative banking. Please remember this. Okay, please remember this. Next one, RRB structure. Okay, next one is RRBs. Right there in the current affairs, please remember this. RRBs were set up based on the recommendation of Narsimham Working Group. Narsimham Working Group. Point number one. Point number two, the government of India passed RRB Act, and with the passage of RRB Act, multiple RRBs have been set up throughout India. These RRBs essentially had three stakeholders. I'll repeat the statement. These RRBs had three stakeholders. One, essentially central government having 50% ownership. Second one, the state government having 15% ownership. And the third one, the sponsoring bank. Sponsoring bank, which will have the ownership or the stake of 35%. And that I've given here, center, state, and sponsor, respectively 50, 15, and 35% owner. The government of India, over a period of time, especially post 2003 and 2004, has started this argument of consolidation of the regional rural banks, and that is the reason the number of RRBs has actually come down. Right now, there are 43 RRBs. Government of India has launched one state, one RRB, OSOR. Remember this name. Government of India now has launched one state, one RRB, OSOR, under which they want to consolidate, amalgamate all of these RRBs in the state into only one RRB. And that's the reason from 43 RRBs, now they want to reduce the number to 28 RRBs. And so these are important points in the context of RRB. Remember. And finally, the differentiated banks. With this, we'll be done with the banking sector. Differentiated banks. Please understand there are two types of differentiated banks in India. One is right, the payment bank, and the second one is the small finance bank. Why these are called as differentiated banks? Listen to me carefully. One is the concept of a universal bank. In universal banking, what will happen? The universal bank will provide the primary functions as well as the secondary functions of a bank. The primary as well as the secondary function. What do you mean by primary? collection of deposits, and giving loans. I'm using the term collection, they will use the term mobilization. Don't get confused. Collect a deposit, give loan. That is basically the primary function. Over a period of time, the banks have adopted multiple other functions as well. For example, today, if you go to, let's say, State Bank of India, SBI will provide insurance services to you. SBI will provide locker facilities to you. Right? So I hope you understand over a period of time, many other functions have been adopted by the banks. Those are classified under secondary functions. So when a bank will provide primary plus a secondary, those are referred to as universal banks. But if the bank will provide very few of the function, these are called as differentiated bank. Everybody is okay with the difference here? Please do let me know in the chat section. Everybody is able to understand the difference between a universal and a differentiated bank. And in case of a Reserve Bank of India, it is promoting two types of institutions under differentiated bank. One is a payment bank. Second one is the small finance bank, SFB and payment bank. Now, what is the importance of both of these? The payment banks are essentially set up to promote financial inclusion. These are set up to promote financial inclusion. Differentiated banks are set up to promote financial inclusion. Right? For example, under the small finance bank, 75% is the target under PSL. And that too, they cannot provide it to, let's say, big companies. They cannot provide it to, let's say, right, the bigger farmers, etc. They will have to target small and marginal farmers. They will have to target the micro enterprises in rural parts of India, etc. So these kind of banks have been set up in order to provide in order to promote the financial inclusion in the domestic market. Can the foreign investment be brought under both of them? Answer is yes. Foreign investment can be brought under both of them. Can loans be given by both of them? Answer is no. Payment banks are not individually allowed to provide loans. They are not individually allowed to provide loans. Small finance banks, yes, they are allowed to provide loans. So these are the two types of differentiated banks which are being promoted by Reserve Bank of India in the domestic market. And everybody is okay? Everybody is okay. Okay. Final concept under banking. With this, we'll be done with banking. And ah, let me cover this particular final part of the banking, then I'll take up your questions. Listen to me. Let me cover this. Okay, one area of current affairs which has been there even as a part of static portion is the Basal Guidelines. I'll cover Basal Guidelines here. What is the idea for Basal Guidelines? Simple. Right, there is a city by the name of Basel. Is it okay? Right, in Switzerland, there's a city by the name of Basel. And in this particular city, there is a bank by the name of Bank for International Settlements, BIS, right? Bank for International Settlement. Under this Bank for International Settlement, there is a committee by the name of BCBS, Basel Committee on Banking Supervision. Basel Committee on Banking Supervision, BCBS. India is a part of BCBS, by the way. What is the role of BCBS? BCBS will regularly meet, take decisions, and recommend certain policies which are supposed to be followed by the banks. Which are supposed to be followed by the banks. Is it okay? Right? So, the banks will have to follow across the world. The member countries will have to follow these particular regulations. The first round of regulations was announced, which was called as Basel 1, 1988. India is already Basel 1 compliant. By 1999, we were able to implement all of it. Then there was a Basel 2, which was announced. We have implemented Basel 2 as well. Right now, we are implementing Basel 3. We are implementing right now Basel 3 guidelines. What are the important provisions of the Basel 3 guidelines? One, capital adequacy ratio or credit to risk weighted assets ratio. Right now, Reserve Bank of India simply says for all the banks in India, that is the banks, scheduled commercial banks, it will be 9%. For public sector banks, capital adequacy ratio will be 12%. For payment banks, the capital adequacy ratio will be 15%. But what is the meaning of capital adequacy ratio? Every bank is facing certain type of risk. Simple. Every bank is facing certain type of risk. It could be a risk because the bank has given a loan, it will not be able to recollect the loan. This is called as credit risk. They've given the loan, they're not able to recollect, credit risk. Right? Or else, let's say they have invested in the market and the assets in which they have invested, the market prices have gone down. That is a market risk. And third one, let's say because of the systems, because of the processes, because of the people, etc., they will face a certain risk. That is called as operational or systemic risk. So there are three types of risk which are faced by the bank, and the risk can basically become losses for the bank. So if a bank will incur losses, how much money it should have, how much capital it should have to absorb the loss. That is called as a capital adequacy. Is everybody okay with the term CAR? Do let me know. If the bank is, right, let's say facing certain risk, it can become losses. To basically cover the losses, how much should be the capital held by the bank? That is called as capital adequacy. Now, whenever you use the term capital of a bank, listen to me very carefully. The capital of the bank will have two components. One is tier 1 capital, and obviously the second one has to be tier 2 capital. Tier 1 and tier 2 capital. What is essentially the difference between tier 1 and tier 2 capital? Listen to me very carefully here. Tier 1 is called as a core capital. Tier 1 is called as core capital. And tier 1 can be used much more sooner, much more easier by the bank to absorb losses compared to tier 2. Is it okay? I'll repeat the statement here. Tier 1 can be used much more sooner, much more easier by the bank to absorb losses. That's the reason the tier 1 is called as a core capital. Focus is more on collection of tier 1 capital. Right? Tier 2 comparatively, right, subordinate capital, comparatively it is difficult to estimate the value of tier 2 capital. It will be used only after the tier 1 capital is to absorb losses. Right? So that is essentially the concept of tier 1 and tier 2. Is everybody okay? For example, if you issue shares in the market, if a bank issues the shares and collect the money, right, that is a paid up capital. It is a type of tier 1 capital. Additional tier 1 bonds, right, are tier 1 capital. Tier 2 bonds, right, you must have heard of the term tier 2 bonds, which is a tier 2 capital. Right, so these are the important points associated with the capital adequacy ratio. Next one, capital conservation buffer, CCB. Capital conservation buffer. What is this idea of a capital conservation buffer? The capital conservation buffer is the additional capital. I'll repeat the statement. Additional capital that the bank has to maintain, which can be used to absorb the losses whenever there are, right, let's say, emergencies faced by the bank. Said, okay, whenever there is an emergency, the bank has to have more capital to absorb losses. That is essentially capital conservation buffer. And I can see Parampita Parmeshwar, my dear, welcome. So Parampita Parmeshwar says business cycle. Do not use the term, according to me, please do not use the term business cycle in the context of capital conservation buffer because there is one more term called as, I don't know how many of you heard of this, counter cyclical capital buffer. Let me know how many of you heard of this? Counter cyclical, right? Conservation buffer. Counter cyclical, CCYB. CCYB is different. Listen to me carefully. We have not activated CCYB, and I know a lot of you will be feeling, sir, now it is looking like I'm an Indian batsman playing an Australian pitch. It feels like I'm an Indian batsman, I'm playing an Australian pitch. That too, delayed Perth, etc., where everything is bouncing. Listen to me carefully. In India, Reserve Bank of India has activated capital conservation buffer. Yes, correct statement. Has RBI activated counter cyclical capital buffer? Statement is no, it has not activated it. Is it okay? It has not activated it. Why? Listen to me carefully. What is the essential meaning of a counter cyclical buffer? When there is, let's say, high GDP growth, banks will have to reduce the lending. I hope you understand this. Right? Counter cyclical. If there is high growth situation in the economy, banks should not lend more. Banks should withdraw, banks should hold back, banks should reduce their lending. That is counter cyclical buffer. Otherwise, what will happen is if the growth rate is higher, banks will lend more, economy has to move upwards and then go downwards also. Correct? It's a cycle. If the economy goes upwards, it has to go down also. The economy, when it will enter into a slowdown or recession, because you become very ambitious during growth, now during slowdown and recession, the NPAs will suddenly balloon. NPAs will suddenly increase for the bank. Losses for the bank will be much higher. That is the precise reason. There is a buffer called as right, the CCYB. RBI has not introduced or activated CCYB in India. It has only activated capital conservation buffer. Okay. Final point regarding Basel 3, that is liquidity coverage ratio. LCR, liquidity coverage ratio. That is essentially estimate for the next 30 days how much will be the outflow from your bank. Equivalent of that, 100% of that, maintain in the form of right capital, maintain in the form of high quality liquid asset, HQLA, high quality liquid asset. And right now, please remember, only the government securities have been classified as a high quality liquid assets under liquidity coverage ratio. Remember this particular point. It was there in the current affairs also. It is there as a part of Basel 3, can be asked in the prelim. And final point in this particular chapter, a big chapter of banking, banks versus NBFCs. Banks versus NBFCs. Listen to me very carefully. The banks are registered under Banking Regulation Act of 1949. NBFCs are registered under Companies Act of 2013. Point number one, banks can collect the demand deposits as well as time deposits. The NBFCs are not allowed to collect all the types of deposits. NBFCs can collect only the time deposit. And when you say time deposits, can you collect all the types of time deposits? No. The deposits shall be in the range of 12 months to 60 months. 12 to 60 months. The banks will be registered with RBI. NBFCs shall get the certificate of registration from RBI. The deposits with the banking sector are covered under DICGC, Deposit Insurance Credit Guarantee Corporation. The deposits that you keep with deposit taking NBFC are not covered under DICGC. These are the very important point of comparison between a bank as well as NBFC. A couple of more points. One is checkbooks cannot be issued. NBFCs cannot issue checkbooks on their own name. Banks such as SBI, will they issue checkbooks on their own name? Bank of Baroda, ICICI, all of these are issued in their own name itself. Definitely yes. Right. In addition to this, one more very important point of distinction: banks are part of payment settlement systems. Banks are part of payment settlement system, whereas NBFCs are not part of payment settlement system. That is essentially, can you go to a bank and transfer money using NEFT? Can you transfer money using RTGS? Yes. Can you go to right, let's say NBFC and try to do that? No, NBFCs are not part of payment settlements. Okay, so these are the important points of differences between banks and NBFCs. And remember, RBI is worried about NBFCs because RBI simply says for banking sector, we have very good regulation. Right? Banks are regulated in a very good way in India, whereas NBFCs are loosely regulated. There are a lot of gaps in terms of regulation of NBFC. And that's a reason for NBFC, RBI has announced a scale based regulation. RBI has announced scale based regulation. That is from the lowest to the highest. When you keep on going upwards in the scale like this, that is the size of NBFC, the regulations imposed by RBI will also keep on rising, will also keep on increasing. Done? Okay, so these are the important points. I've covered the complete chapter of banking now. I believe I've taken a lot of time. I know that. At around 1 hour 45 minutes, I know that reason being banking chapter is important. Questions in the past have been asked on banking chapter and they will be asked even this year in the banking sector. Okay. Now, before I start with the next one, any doubts from your side? Any doubts from your side? Sir, is capital adequacy ratio and tier 1 capital same? Listen to me. Summer, my dear. Capital adequacy ratio is what is the percentage, right? That you will have to maintain percentage of what? Risk weighted assets. That is, bank, imagine, has given a loan. Loan is an asset for a bank. So, we will find out how much of the loans, how much of the advances, how much of the investment, etc., are risky assets. Percentage of these risky assets that the bank will have to maintain is called as a capital adequacy ratio. Now, this capital that you need to maintain, you can maintain in two forms. One is called as a tier 1 capital, and obviously the second one will be referred to as tier 2 capital. Done? Okay. Next question. Slide number 4. Any difference between medium of exchange and transaction motive? My dear, one is basically a medium of exchange that is given as a definition. Transaction motive is why there is a demand for money in the market. Right? Essentially, the demand is there for medium of exchange only. But medium of exchange is essentially used as a definition of money. One of the reasons why we hold money is because we want to purchase goods and services. Okay. Uh, Outright repo and OMO. My dear, listen to me very carefully. OMO is a common term. Under OMO, there are two types. One is a repo and a reverse repo, and the second one is outright repo. Simple. Is it okay? OMO is a common term, right? Whereas outright repo is part of it. Nitiraj Wadave, Basel 3, explain in detail. My dear, Basel 3 will take me 1 hour. If you want me to explain Basel 3 in detail, the whole economy I'll have to take in 100 hours then. And I hope you understand. Right? So please revise. If there is any doubt, you ask me. Uh, GDTL, NDTL difference. There are certain banks which will keep deposits with other banks. For example, payment banks. Payment banks will collect deposit from you. And when payment banks will collect a deposit from you, are they allowed to lend in the market? No. The statutory liquidity ratio, SLR, 75% of the deposits they will have to invest in government security. Remaining 25% they will invest in the form of deposits with another bank. Here is a bank keeping deposit with another bank, interbank deposit. So when you talk about NDTL, please understand the total deposits collected by the bank is called as a gross demand and time liability. Out of this, I will subtract interbank deposit. What I'll be left out after this is a net demand and time liability. Okay. What is the difference between medium of exchange, mode of exchange? My dear, mode means how are you exchanging? Medium means you are giving A and in return you are getting B. That is medium. Okay. What about NABARD bank? My dear, don't worry. In that case, there are so many banks. NABARD is there, Exim is there, right? So many types of banks are there. Don't worry about everything in the banking sector. Focus on what is important. Okay. Uh, Tarak N. In SLR, banks have to keep to itself that is applicable to the branch or a bank or the bank as a whole. Bank as a whole. Generally, it is calculated per bank. Policy corridor. Policy corridor essentially is the interest rate, highest rate of interest that is charged by RBI and also paid by RBI. RBI will pay a highest rate of interest under which tool? Essentially, it is a standing deposit facility. RBI will charge a highest rate of interest under which tool? The MSF. So, difference between MSF and the STF is essentially the policy corridor. Okay. Alish Singh, is only government securities considered as high quality liquid asset? Yes. RBI very recently has published this. Only government securities are considered in that. Sterilization I'll discuss when I take up international trade. Okay. Sir, can you explain in detail simply? My dear, I explained this 3 times now. 3 times. Total amount of deposits collected. Out of that, remove the deposits which the bank has collected from another bank. That is essentially what is left out is NDTL. Okay. What is difference between FRS, CRR and SLR? My dear, FRS is a basic practice where lending is done. That is part of the deposits you'll have to keep in the form of reserve, remaining loan. That practice is called as FRS. CRR is right basically part of the deposits that if I ask you how fraction reserves are held in let's say banking sector in India, essentially through CRR and SLR, right? So I hope you understand. And I explained that when I was discussing the model of CRR and SLR, I explained that. Okay. Let me go forward. Let me go forward. International trade. And those who are asking for a break, let's take it at let's say 2:30. Let's take the break at 2:30. 2:30 to let's say 3:15 and then we can again continue, then take a break, then again continue. Okay. Next one, international trade. Next chapter, international trade. Under the international trade, I'll be taking five important concepts. One is the exchange rate. Second one is the balance of payment. Third one is World Trade Organization. Fourth one is market integration. And the fifth one is foreign trade policy 2023. Let's start now. First one is the exchange rate. Can everybody see the picture which is there? Let's say on my right hand side, this side. Can everybody see the picture which is there on my right hand side? Okay. Now let me start exchange rate. Let me go one after the other. What do you mean by exchange rate? Essentially, the exchange rate means how many domestic currencies you will have to pay to get 1 unit of a foreign currency. How many units of domestic currency you will have to give in order to get 1 unit of foreign currency. That is called as an exchange rate. And whatever you come across in the newspaper right now, whatever rate you come across in the newspaper, that, my dear, remember, that will be a nominal exchange rate. Remember this. That will be a nominal exchange rate. So, for example, in yesterday's newspaper, they would have simply given $1 is equal to, let's say, 83 rupees. $1 is equal to 85. $1 is equal to 86, etc. All of that is a nominal exchange rate, NER. Right? So, that is basically the definition of exchange rate. Now, how do we determine exchange rate? What are the methods using which we determine the exchange rate? Basically, two methods. One is the fixed exchange rate. Second one is the floating exchange rate. In fixed exchange rate, let's say, hypothetically speaking, India doesn't follow this. Most of the countries around the world follow floating, a type of a floating. What would happen in a fixed exchange rate? RBI will announce $1 is equal to, let's say, 50 rupees. I'll repeat the statement. Imagine RBI will announce $1 is equal to 50 rupees. RBI always will try to bring the exchange rate to this only. Simple. What do you mean by fixed exchange rate? You have announced one exchange rate, and because of inflow, outflow, etc., the exchange rate will start moving like this. RBI will keep on intervening. RBI will keep on participating in the market and ensure that exchange rate will be this much. This is a fixed exchange rate. Is it okay? This is called as a fixed exchange rate. Does India follow a fixed exchange rate? No. India doesn't follow a fixed exchange rate. India essentially follows a type of a floating exchange. India follows, and countries around the world, most of them follow a type of floating only. Right? A floating exchange rate. What do you mean by floating exchange rate here? Floating exchange rate essentially means the supply and demand for the currencies. Supply and demand for the currencies will determine what is the exchange rate. Is it okay? The supply and the demand for the currencies will determine what is the exchange rate. Meaning what? You tell me, if right now, again imagine, if $1 is equal to, let's say, 60 rupees, if the demand for rupees increases, if the demand for rupees increases, don't you think the value of rupee against the dollar should go upwards? Yes or no? If the supply of the rupees increases, don't you think the value of rupee, because the supply has increased, the value of rupee against the dollar should go downwards? Does it make sense to you? The argument is very simple here. It is a exchange rate. That is, you supply one currency, you purchase another currency. So, in case of this particular market, based on supply and demand forces, the value of the currency would be determined. This is essentially called as a floating exchange rate. This is called as a floating exchange rate. And that is the reason a lot of times you will see supply of rupee increases and rupee value against the dollar will start going downwards. I'll give you one example. Let's connect it to current affairs. I'll give you one example. In the last 2 days, what do you think would have happened to Indian rupee? You tell me. The last 2 days, according to you, what would have happened to Indian rupee? Would the Indian rupee gone up or gone down against the dollar? And if you're wondering, sir, how can I say this? I'm not an expert. I know a lot of you will basically say, sir, how can I answer this? I'm not an expert. My dear, all of you know what is happening between India and Pakistan. And when these kind of, right, these kind of, let's say, frictions will happen, do you think foreign investors will be happy? And if foreign investors, right, are not happy, do you think they will continue to come into India, hold more investments in India? No, they'll be worried. They will take their money out of Indian market and go out of India and invest somewhere. So you tell me, if they're moving out of India, all of you will agree the supply of Indian rupee in the market would have increased. Supply of Indian rupee in the market would have increased. And if the supply increases against the dollar, because they are selling rupees, purchasing dollars, right, don't you think the value of Indian rupee against the dollar would have also gone down? And this is exactly what has happened in the last 2 days. Right. So, and please remember, I'll use technical terms now. Whenever all of this happens because of the market forces, I repeat, whenever all of this happens because of the market forces, we use the term depreciation and appreciation. Okay, we use the term depreciation and appreciation. What is essentially the meaning? Depreciation means value of one currency against another currency will go down. Appreciation means value of one currency against another currency will go up. So depreciation, appreciation. But remember, use these terms whenever you are talking about a floating exchange rate or a type of a floating exchange. Right? And in case of India, we use a type of floating exchange rate which is called as a managed exchange. We use the term managed exchange rate. IMF calls this as a dirty float. IMF refers to this as a dirty float because we are interfering in the market. RBI interferes in the market to basically stabilize. Remember the term stabilize. Do not use the term RBI interferes to fix exchange rate. Trust me when I say this. If you simply use the term RBI interferes and fixes exchange rate, either in the interview or in the mains examination, you can simply say Tata bye bye to 1 or 2 marks. I hope you understand. You can simply say Tata bye bye to 1 or 2 marks because it is completely incorrect. And RBI every now and then will keep on reminding you people in the newspaper, we do not fix exchange rate. We stabilize exchange. We stabilize exchange rate. RBI doesn't fix exchange rate. Done. So in case of fixed exchange rate, the terms used revaluation and devaluation. In case of floating exchange rate, the terms used are appreciation and depreciation. Right? Effect is same. That is, let's say, depreciation or devaluation. Effect is same. That is, value of one currency will be brought down or will go down against another currency. But if it is done because of the market forces, depreciation. If it is done by the central bank or the government, devaluation. The last time we did devaluation was during BOP crisis. It was during the BOP crisis. Today we do not follow devaluation policy as such. We simply allow the market forces to determine the exchange. So far so good with everyone. So this is associated with the methods. Next, what is the impact? If there is a excess depreciation, excess, right, let's say appreciation, etc., what is the impact? What is the impact of it? Impact is very simple. On investments, on inflow, outflow, on imports, exports, all of these would be affected. Either there is a depreciation or appreciation in the market. For example, if there is a depreciation in the currency, let's say rupee depreciation happens, what will happen to the imports? Imports will become costlier. Correct? Imports will become costlier in India. What about exports? Exports, we generally say competitiveness. Understand, competitiveness will increase. Do not say exports will increase. You can simply say competitiveness will increase. Be very careful with this. Now, I know some of you will say, sir, how can you say that? I will write that exports will increase. I will not agree with you. My dear, India is a net importer. India is a net importer. And when rupee depreciates, there is no doubt you are a net importer. Imports will become very, very costly. There is no doubt regarding that. But with the depreciation, what will happen to your export? The exports might become cheaper compared to other goods. That's it. It can become cheaper compared to other goods. But what if there is a pandemic in the global market? What if USA is imposing heavy tariffs on you? Can you simply write now exports will increase from India? Not necessarily. This was once asked in the preliminary examination. Be very, very careful. Export competitiveness will go up. Imports will become very, very costly. So, in terms of imports, exports, in terms of investments, all of these would be affected with the changes in the exchange rate, with the movement in the exchange rate. Right. Next, what is the role of RBI in the exchange rate? And what is the role of RBI in the exchange rate? The role of RBI, please listen to me carefully, is to stabilize the exchange rate. It is to stabilize the exchange rate. How can RBI do that? There was somebody asking me about sterilization earlier. Let me explain it to you. Right? What is the idea of a sterilization here? Let's say hypothetically. Listen to me carefully. Hypothetically, there is a sudden outflow of dollars from India. Okay? Let's say hypothetically, there is a sudden outflow of dollars from India. When there is a sudden outflow of dollars, can I simply say as a result of this, the outcome will be rupee will start depreciating? Yes or no? Rupee will start depreciating. Right? So how? Very difficult, etc. My dear, if there's a sudden outflow of dollar, it simply means investors have sold rupees, taken the dollars, taken the dollar out of India. That's it. Right? So there is a depreciating rupee. Now, how do you reduce this depreciation? How do you bring it under control? That is where the role of RBI will come into picture. RBI essentially will now realize in the market there is a very high demand for the dollar, there is a very high supply of rupees. Simple. Demand for dollar is very high, supply of rupee is very high. RBI will basically start selling dollars and in return purchase. Is it okay? RBI will basically start selling the dollars and purchase rupees. Now you tell me, if RBI does this, will this not stabilize the exchange rate? Will it not reduce, right? Let's say the rate at which rupee is depreciating, right? So that is how RBI basically tries to stabilize. And on the other hand, somebody will say, sir, is it the only function of RBI? No. What if there is excess inflow of dollars into India? Let's say there is excess inflow of dollars into India. When there is an excess inflow, everybody is okay. What will happen is rupee will start getting appreciated because the demand for rupee will be very higher. Supply of dollar will be very higher. Can RBI allow this to continue? No, RBI has to stabilize the exchange rate. What does RBI do here? Dollar supply is higher, rupee demand is higher. What does RBI do? RBI does exactly opposite. What does RBI do? RBI will start purchasing the dollars from the market and start selling the rupees in the market. I hope you understand. Essentially, what is RBI role here? What is RBI trying to do? RBI will realize either the supply or the demand for the currencies is changing. If the supply is too high for one currency, start purchasing it. If the demand for another currency is very high, start supplying that particular currency, thereby, right, trying to stabilize the value of the exchange rate. That is essentially the role of Reserve Bank of India. Listen to me very carefully now. If RBI does this, in this particular situation, what is happening? RBI essentially is realizing that demand for the rupee is very high. RBI will start, right, have a look at this. RBI will start selling the dollar and taking the rupees. Sorry, will basically take the dollars and start selling the right rupees in the market because rupee demand is very high. Now, don't you think because of this activity of RBI, because the RBI is basically taking the dollars and giving rupees in the market, rupee supply will increase? Correct? Rupee supply in the market will increase. And if the rupee supply increases, can this contribute to inflation in the market? This add to inflation in the market? Yes, there is always a danger. RBI supplying rupees, purchasing dollars with higher rupees, higher inflation. So what does RBI do here? RBI will start essentially conducting open market operations. The other side. Simple. On one side, sell rupees, purchase dollars, stabilize exchange rate. On the other side, because the money supply in the banks is increasing, on the other side, sell government securities. Sell government securities, take out the money from the bank. So, from one hand, RBI is giving money. In the other hand, RBI is taking the money back from the market, thereby ensuring that exchange rate stabilized, inflation rate stabilized. This is called as sterilization. Everybody is okay with this? This is right referred to as sterilization activity of Reserve Bank of India. Everybody is okay? Please do let me know. Okay. So this is the role of RBI, and because the RBI is selling the dollars, dollars are part of foreign, I'm sorry, forex reserves. And somebody was writing, I don't remember the name. Somebody was writing forex reserves. One of the component is dollars. Listen to me carefully. They wrote one of the component is dollar, another one is gold, another one is right. Let's say STR, the special drawing rights, and the final one gold tranche or reserve tranche. My dear, please listen to me very carefully. The forex reserves, does it have only dollars? The statement will be incorrect. Forex reserve doesn't have only dollars. Out of four, one is not just a dollar, right? Remember this very carefully. It is foreign currency assets. Understand the difference between all of these. Foreign currency assets. FCA. They will write this as FCA. Foreign currency assets. What do you mean by foreign currency assets? Dollar is there, right? Euro is there. Pound is there. Dollar bonds are there. I hope you understand this also. Dollar bonds are there. Euro bonds are there. All these are freely convertible currencies. Freely convertible currencies. That is a basket of STR. Plus, right, the bonds in these particular currencies, all of them are counted as foreign currency assets. All of them are counted as foreign currency assets. So that's a reason when you write, let's say, the components of forex reserves, mention foreign currency assets. Mention foreign currency assets. Don't simply write dollar. Dollar is one of it, not the only currency in the forex reserve. Okay, let me go forward now. Because the RBI is using the forex reserves to stabilize the exchange rate, this is called as a sale of official reserves. Remember this. It is the Reserve Bank of India which will conduct the sale of official reserves. Nobody else is allowed. RBI is allowed to conduct the sale of official reserves in India. Can be asked in the preliminary examination. Make a note of it. Next one. What are the factors which will influence exchange rate? Which factors will have an impact on exchange rate? Let's go one after the other. Please listen very carefully. First one, if I say imports and exports, everybody is okay with this? Imports and exports, it will have influence on the exchange rate? Yes. Second one, the monetary policy. The monetary policy, or else can I simply say interest rates? Interest rates will influence the exchange rate? Of course, yes. For example, if India's interest rates, that is RBI, will increase the interest rate, you can expect more investments into India. If USA will increase interest rates, you can expect more investments into USA. So essentially, the investment will keep on flowing into that particular market, which will offer them higher interest rates. So interest rate is an outcome of a monetary policy. So imports, exports, monetary policy, that is essentially interest rate. Third one, right? Third one, the rising incomes of the country or changing incomes of the country. Yes, because the as the incomes of the countries will change, it will have an impact on imports. All of you are able to understand? It will have a more impact on imports. And when imports will start increasing, automatically it will have an impact on exchange rate. Okay. Fourth point, inflation. Remember this very carefully. Inflation. How inflation will have an impact on exchange rate? Listen to me very, very carefully. I'll explain this once. Don't keep on asking me, repeat it, repeat it. Listen right now. Imagine there is a particular product which will cost you 100 rupees in India. Okay, 100 rupees. And there is a similar product which is manufactured in USA. Manufactured in USA. Right now, we are not able to import it because the cost of this product, when you import it, let's say will be 102 rupees. When you import it, it will become 102 rupees in India. That's the reason you're not importing. Now, what if I say inflation rate in India will be 10%? Inflation rate in India will be 10%. Inflation rate in USA will be 2%. Can I simply adjust the price of the products with the inflation rate, which will make the product now 110 rupees and 104 rupees? Everybody is okay? Do let me know. I'm just taking the numbers here, not decimals. Don't worry about decimals. Now tell me, is it okay if I say because the inflation rate in India is very high, exports will start losing competitiveness, imports will become more competitive? Yes or no? Simple question to all of you. right? Because the inflation rate in India is very high, exports will start losing competitiveness, imports will become more competitive. And if exports and imports will start changing, will this have impact on exchange rate? Correct? Will this not have an impact on exchange rate? Yes, it will have an impact on exchange rate. Done? Okay. So imports and exports, inflation. Next, government debt. All of you, please remember this. Government debt will contribute to inflation. Government debt will contribute to inflation. Sir, how? Can I simply say, again, somebody will say, sir, what do you mean by government debt? Government debt essentially represents the amount of money that the government has borrowed, which it needs to repay. Simple. The amount of money that the government has borrowed, which it has to repay. That is the debt of the government. Now, listen to me carefully. If the government borrows more money, does it not mean more money supply, more expenditure in the market? When there is a higher expenditure, let's say government will spend money on roads, government will spend money on, right, let's say construction of manufacturing facility, airports, etc. Money supply in the economy increases. With a higher money supply, will this not contribute to inflation? Will it not have an impact on inflation? Of course, yes. So that's the reason, please remember this. When governments tend to borrow more and more money, it is always connected to inflation rate in the market. It is always connected to higher money supply, higher, right, price levels in the domestic market. Now you tell me, if there is a higher inflation, will this have an impact on exchange rate or not? We have already discussed that. If there is a higher inflation, will this not have an impact on exchange rate? Yes, it will have an impact on exchange. Okay. Monetary policy is already done. Deficits in the balance of payment. I'll discuss the deficits when I take a BOP. That is the next discussion. Don't worry. Right. So these are certain factors. Again, if you ask me, sir, are these the only factors? No. I hope you understand. Are these the only factors which will influence exchange rate? No. There are multiple factors also. For example, uncertainty and volatility. Will this not have an impact on exchange rate? Right now, you tell me. The uncertainty or volatility, is it not affecting exchange rate in India? Yes, it is having an impact on exchange rate. But traditionally, these are the types of factors. For example, one more, speculation. There is one more term, speculation. Right? What do you mean by speculation? Speculation is generally associated with, right, let's say movements in the market. If you are speculating that something will happen in the coming days, will you not conduct transactions well before that? For example, imagine you're a foreign investor who has a lot of money invested in the Indian market, stock market. If you feel that the situation between India and Pakistan is going to get worse now, again, I'm not wishing that, by the way. Don't simply say, sir, how can you say that? Right? It should become bad, etc. No, just a speculation, by the way. If you feel that the situation between India and Pakistan is only going to get worse, why will you keep your investments in India? Will you not take your investments out of India even before the situation becomes bad? Yes. Right? That is speculation, by the way. Right? So speculation is you are having certain expectation. You are expecting certain event, expecting certain outcome. That is speculation. Okay. So speculation will also is a factor which will contribute to the exchange. Done. So all these are, right. All these are essentially the factors which will contribute to movement of exchange rate. Everybody is okay? Done. So far so good. Please do let me know in the chat section. Aman Burnwal says and not making any sense. What sense? Which part which is not making sense, my dear? Do let me know. Huh. Any question? Any doubt so far? Okay. So one part is right, basically the deficits in the BOP. Right, deficits in the BOP. Now, what is this deficit in the BOP? Understand this. The war speculation. My dear, then you are not reading. And don't take it personally. You are not looking at what is actually happening in the market. Please read. I'm saying please, by the way. Please read. You will realize in the last 2 days, foreign investors have withdrawn more than 3,000 crore rupees from the market, from the Indian market. More than 3,000 crore rupees. Why? Reason is they feel the system, or let's say the situation between India and Pakistan is going to become worse now. And if the or let's say if the attacks continue, the stock market will react to that. The stock market will take a hit, right? Because now the focus will be more on fighting the fight and not on promoting growth. And that will basically also mean the resources will get diverted. And if the resources will get diverted, the growth will be hit. If the growth is hit, essentially the performance of the companies will be hit. Why do you want to hold on to the share of a company whose performance is going to be hit? The market price of the share is going to fall very soon. Take the cue right now, sell the share, move out of India. That is speculation. Whether it will happen or not, that's a future thing, by the way. But that is how the market behaves. Right? Okay, done. Let me go forward. These are the factors. Be very careful. Expect a question from the area of factors which will contribute to the movement of exchange rate. Okay. Now there is a deficit. Let me discuss this. There is a term called as a deficit of balance of payment. Now listen to me carefully. Okay. Now point number one. I'll go back to the previous slide. Don't worry. Somebody will say, sir, right, you're missing certain points here. I'll come back to this. Don't worry. Let me cover the how the deficits will contribute to exchange. Have a look at this. Balance of payments. Point number one, what do you mean by balance of payments? The balance of payments essentially represent the total, repeat, the total amount of transactions which will lead to inflow of currencies as well as outflow of currencies. And remember this. What is the balance of payment? It's a record. It will basically consist of all the transactions which will lead to inflow of the currencies or outflow of currencies. That is essentially whatever dollars will come into India and whatever dollars will go out of India are recorded, and that is called as a balance of payments. Is the point clear to all of you? Is the definition clear to all of you? Right? So this is one. Point number two. The balance of payments is maintained by whom in India? It is recorded by whom in India? It is recorded by Reserve Bank of India. The balance of payments accounts is recorded, published by Reserve Bank of India. Point number two. Point number three, historically, if you see, the balance of payments which is published by Reserve Bank of India has two accounts. The balance of payments accounts in India, there are two accounts. One is called as a current account and the second one is called as a capital account. But technically speaking, IMF, International Monetary Fund, which is basically the authority regarding all of it, says there have to be three accounts. Not two, but three accounts. Right? One is the current account, second one is the capital account, and the third one is the financial account. Third one is the financial account. What does RBI do? It will publish current account. It will club the financial and the capital account, publish only one account. Is my statement clear to all of you? According to IMF, there have to be three: current, capital, and financial. What RBI does is, historically, it has been publishing the current account separately. It will club the capital and financial, publish one more account. So, in India's case, RBI publishes two accounts. So, that is the current as well as the capital. Current as well as the capital. Okay, and that is the reason. I'm pretty sure a lot of you would have read this in the book also. Whenever they talk about the deficit, it will basically talk about the current account deficit. It will talk about the surplus in the capital account. It will talk about the deficit in the capital account. They will generally not discuss, let's say, fiscal account deficit. or fiscal account surplus, etc., they will talk in the context of only two accounts, current and capital. But if you ask me, sir, how do I distinguish between both of them? What is the difference between both of them? How do I find out which is a current and which is a capital? Simple. If it is a transaction which is associated with an asset, simple. I hope you understand this. If it is a transaction which is associated with an asset, put it under the capital. Put it under the capital. For example, you give a loan to somebody. Is it not an asset? You take a loan from somebody. Is it not an asset? You invest from India in the foreign market, either in the stock market or in the, let's say, the companies, that is FDI or FPI. Is it not an asset? You borrow from the external market. Is it not an asset? Again, for you, it is a loan, but it is an asset. So I hope you understand, anything to do with the asset, put it under the concept of a capital. Put it under the area of capital account. And it is got to do with, let's say, incomes, right? Let's say national income. It is got to do with, right, incomes of your investments in the foreign market, etc. Classify it under the current account. Is everybody able to understand? I'm discussing this for a simple reason. UPSC has the tendency of asking this question. They will give you certain transactions and they will ask you, tell me, is it part of current account or capital account? Right? So be very careful. Assets, right, or let's say liabilities, put it under the capital account, or anything to do with, right, let's say remittances, anything to do with, right, let's say the incomes, right, etc., put it under the current account. That is how you differentiate between a current and a capital. Okay, let me go forward now. So current and capital. Now, whenever you talk about deficits, whenever you talk about the concept of deficits here, the deficits essentially have written three types here. One is a current account deficit. Second one is, right, let's say a trade deficit. And the third one is the overall BOP. And again, please understand, do not be under the impression, because I'm using the term deficit multiple times, do not be under the impression that there is always a deficit. No, it will vary from one situation to another, from one country to another. For example, if UPSC will give you a statement saying that India has always experienced a current account deficit, the statement is incorrect. Right? Is my statement clear to all of you? If UPSC will give you a statement such as, right, India has always experienced a current account deficit, no. There have been instances in the past, very, very recently only, where India has experienced a current account surplus as well. India has experienced a current account surplus as well. So that's the reason, be very, very careful. Be very careful. There can be a deficit, there can be a surplus. But majority of the times, India has experienced trade deficit. India has experienced current account deficit. Is it okay? Right? India has experienced a trade deficit majority period of the time. And India has experienced a current account deficit. And when you talk about trade deficit, there are two components here. Listen to me very carefully. When you talk about trade, there are two components. One is basically the merchandise. Merchandise is visible, correct? Merchandise trade. And the second one is services. Services are invisibles. Remember this. Services are invisibles. Invisibles means you can't see them. But again, to be very, very precise here, if UPSC will ask you which of the following are invisibles, one of them is services. Can I give you one more example? What about remittances? Do let me know. What about remittances? Remittances are also. What about investment income? What about investment income? Investment income is also invisibles. So I hope you understand, services is part of invisibles. Services is not equal to invisibles. Invisibles is a bigger term. There are remittances within this. There are investment incomes within this, etc. But focus on this. In case of the trade, if you talk about only the merchandise trade, India experiences a deficit here. Not always, but generally. India, right, experiences a deficit. In case of merchandise trade, India experiences a deficit. That is, in a nutshell, India imports more compared to exports. Right? India imports, let's say, $100 billion worth of merchandise. Exports, let's say, $70 billion. So essentially, 30 billion is a merchandise deficit. What about services? India experiences a surplus. Remember this. India experiences a surplus. India experiences a surplus in the context of services trade. Right? Overall, if you ask me, sir, what about overall? Overall, most of the time, India has experienced a trade deficit. And most of the time, India has experienced trade deficit. Is everybody okay with the discussion so far? Right? Again, Baba. Focus on the discussion. I'll give you a break. Don't worry. From last 2.5 hours, I'm shouting at the height of my voice, and you are worried about break. Focus on the discussion. Right? Once you become IS officers, you can't simply tell the Prime Minister, sir, right, evening time, the war is happening between India and Pakistan in these particular states. I'm in this part of India, so give me break. I want to go home and sleep. And the Prime Minister basically will say, go home only. Don't come back. Go home. And so focus. You're appearing for civil services examination. You should be very serious. You should be ready to slog it out. Okay, done. So let's continue the discussion here. I'll give you a break. Don't worry. Let me cover this area. After this, I'll give break. A lot of you worried about break only. Okay, done. So trade, a lot of times we experience a deficit in the context of India, but it will be incorrect. It will be incorrect to say the trade deficit or we will always have a trade deficit. No, we have experienced a trade surplus also, but again, very, very few times, generally we end up experiencing trade deficit. Okay. Now I wrote a couple of more points here, that is remittances. Remember this. This can be asked in the preliminary examination. Remittances. India is the highest recipient of inward remitter. India is the highest recipient, right? Highest recipient of inward remitter. How much? According to the latest data, we have more than $120 billion. Right? We have received more than $120 billion. So for the last couple of years, India, right, consecutively has been the highest recipient of inward remittances. Remember that particular point can be asked. I've covered this again in the current affairs session also. Can be asked in the preliminary examination. Okay, and somebody was asking about investment income. Point number one, investment income means what? Right? Imagine you have invested in USA stock market. You have invested in the USA stock market, and on that you have earned a certain amount of money. You have purchased, let's say, government security, or you have invested outside India. You are earning certain interest on this. That is basically part of investment income. That is essentially part of investment income. That income will be counted as a part of current account transaction. Then, is it always positive or always negative? No, it's not necessary. It will vary from one time period to another time period. I do not assume it is always positive or it is always negative. And so these are certain important points in the context of the balance of balance of payments, and specifically within the balance of payments associated with trade. Everybody's okay? Okay then. Can we take a break now? Do let me know if there are any doubts. I'll take, let's say, a couple of doubts for the next 5 minutes, or let's say next 2 or 3 minutes. Then we can take a break. Sir, investment income is always negative? Not necessarily, my dear. It is not necessary. It can vary from one situation to another situation. For example, can you simply say balance of payment is always deficit for a country? No, it can be a surplus also. It all depends from the situation to another situation. Huh. Is investment income not part of gaining assets? No, my dear. Your asset will remain same. You are earning certain income on that. That will be counted as a part of current account. Okay. Uh, Shripat Mishra says no break needed. My dear Shripat Mishra, I read your comment by the way. You said, sir, I joined 40 minutes late. So you had a buffer of 40 minutes. Other people have joined at 12 o'clock. Already they are basically saying take a break. And you're talking too much. Take a break then. So and I need to give them a break. Don't worry. Ah, so decrease in crude oil prices will lead to depreciation or appreciation, remittance or import bill will dominate. Point number one. Traditionally, listen to me very carefully. Crude oil prices, traditionally, we have seen that there is a connection, there is a cyclical connection between the remittances as well as the crude oil prices. I'll tell you why. And again, I'm saying historically, reason being, if you look at the let's say the population which is moving out of India for the purpose of working, let's say the migrant population, a lot of this population has gone to the Middle East. And because this has gone to the Middle East, if the crude oil prices go down, the earnings in the Middle East will go down. Is it okay? The earnings will go down. Incomes of these countries will go down. And when the incomes will go down, hiring, the salaries which are paid or the wages which are paid will also go down in these countries. Right? And this has been affecting the remittances which are coming to India. That's the reason I said there is a cyclical connection. But that is historical. Right now, Reserve Bank of India's report says we are changing. The situation is actually changing. Why? The situation is changing because a more and more amount of remittances we are receiving from other developed countries rather than receiving from the Middle Eastern countries. For example, the recent RBI report simply says more than 50% of the remittances are coming from the developed countries, such as USA, which accounts for around 27 or 28% of the remittances. So I hope you understand historically it has held true. But with the change in the migration like this, with the change in the remittance flows like this, can it also change? Of course, yes, it can also. Done? Okay. So somebody was saying, change the pen color. Is it not visible? I'm using red color pen. Is it not visible? The background is cream color, and on that I'm writing with red. It should be visible. Do let me know in the chat section. It's fine. It is fine. Okay. Somebody has written, is it? If you write, is it? It's a question, not an answer. Okay. Done. So let's do one thing. Uh, Time is 2:40. Let's take a break. Let's take a break. So what I'll do is, Rahul Singh, agriculture is not yet covered, my dear. We will cover it. Don't worry. We will cover it later. So time is 2:40. Uh, Take a break then. We'll restart, let's say at 3:20. Is it okay? 40 minutes break? Everybody is okay. We'll restart at 3:20. Do let me know. 3:30. My dear, why 3:30? I'm giving 40 minutes. Okay, let's do one thing. Let's take 30 minutes then. 3:10. Okay, let's start at 3:10. Take a half an hour break. Right, whatever food you want to have, coffee you want to have, finish it. Want to keep on scolding me during these 30 minutes? You can do that. So take a break of 30 minutes. We'll restart at 3:10 p.m. Take a break then. Okay. Welcome back. Am I audible and visible? Please do let me know. Am I audible and visible? Hmm. Okay, great then. Let's start. Just a second. Okay, done. Let's start then. Let's continue. So before the lunch break, we were discussing balance of payments. In balance of payments, we have discussed the concept of a trade, deficit, surplus, the remittances, other parts of the current account, etc. So we need to pick up, basically cover the current affairs, BOP, etc. Let's start now. Next one I want to discuss is the concept of a current account. Now, before the break, I hope all of you remember we had a discussion regarding what is a current account, what is a capital account. How do you distinguish both of them? What kind of transaction will be part of current account? What kind of transaction will be part of capital account? We had a detailed discussion. Now, let's continue. Current account. Let's say there is a current account deficit or a current account surplus. Just let me know now. If there's a current account deficit, can I simply say it will lead to outflow of dollars from India? And if there's a current account surplus, this will lead to inflow of dollars into India. So when you say current account deficit and current account surplus, right? Basically, what is the meaning of it? Essentially, under the current account, there is either a net outflow or net inflow into the domestic market. And do let me know right now itself. I want to address that particular point as well. In one of the points earlier, that is the factors which will influence the exchange rate. The factor which will influence the exchange rate, I told you deficits. The deficits in the balance of payments will have an impact on the exchange rate. Now, don't you think if there is a current account deficit, it means a dollar will flow out, it will impact the exchange rate? It will have an impact on the exchange rate? Yes. And if somebody will ask me, sir, is it only the deficit? Can the surplus also have an impact? Of course, yes. Because please understand, either dollar coming in or dollar going out. In either of the cases, they will have an impact on exchange rate. And so if UPSC will ask you, the surplus in the current account will influence exchange rate, don't say wrong. Hey, that is also correct. That will also have an impact on the exchange rate. But generally we experience a deficit in the current account. That's a reason that can be asked in the preliminary examination. Okay, so current account deficit, current account surplus. Most of the times we have current account deficit. Sometimes here and there we have experienced a current account surplus as well. Let me go forward now. In the balance of payment, there is a classification of transactions. That is, if you have seen, generally the transactions which will take place or which will happen in the balance of payments are divided into two parts, are divided into two types. One is called as an autonomous transaction, and the second one, right, essentially is referred to as accommodating transaction. One is autonomous and the second one is accommodating transaction. What is the difference between an autonomous and accommodating transaction? Listen to me very carefully. Autonomous transactions are those which are done independent. I repeat, independent of status of BOP. That is within the BOP, either right there is a deficit, a surplus, doesn't matter. These transactions will keep on happening in the economy. For example, you tell me now, imports and exports. Simple question to all of you. Imports and exports. Do you think imports and exports will be done based on the deficit in the balance of payment? Don't you think these are independent? These are done in order to make profits, in order to earn income, etc. So these kind of transactions which will take place, which are independent of the status of the BOP, are called as autonomous transactions. Remember this, autonomous transactions. Whereas, let's say RBI will conduct a sale of forex reserves. Simple question now, you tell me. RBI will conduct a sale of forex reserves. RBI will sell the forex reserves. Why do you think RBI is doing it? What is the logic behind conducting the sale of official reserves of the forex? It is basically to stabilize. It is basically to address the issue of deficit in the BOP. Everybody is able to understand the logic here? Please do let me know. Right? Accommodating, right? These are called as accommodating because there is certain issue in the BOP. Accommodate means to adjust, to basically address some issue. Right? So in that particular situation, those transactions are called as accommodating transaction. And suddenly UPSC will also use one more term, below the line transaction. They will also use the term below the line. Below the line transactions. The accommodating transactions are called as below the line transactions. And autonomous are called as above the line transactions. Remember all these technical terms. UPSC can ask you questions on all of them. Right. So balance of payment, concept of types of transaction. Now there is one part that I left out here. Balance of payment deficit, balance of payment surplus. What is the meaning of it? If you look at the BOP, generally the account of BOP, a simplified version. I'm giving you a simplified version here. Generally, the BOP will be written like this. The table will be given in this way. On one side, you will have income transactions. The other side, you will have expenditure transactions. And you will have current account and you will have capital account. This is a simplified version of a BOP. I hope you understand. And I know some of you will search for this in the Google. You'll be redirected to RBI website and RBI will give you 3-page BOP transaction statement. RBI will give you right a 4-page BOP transaction. And should you look at it? Answer is no. Even if you look at it, don't get confused. What RBI could have done is, or RBI generally does is, rather than writing income and expenditure side by side like this, they will write income and then expenditure, one below the other. Right? So please don't get confused. Even if you look at it, please do not get confused. Is it required for civil services? Absolutely no. It is not required. So come back to the point here, the current account and capital account. When you say balance of payment, the deficit or surplus, it is the sum total of income side, it is a sum total of expenditure side. Simple. Sum total of income, sum total of expenditure. What is the total here? What is the total here? If income is greater than the expenditure, it is called as a BOP surplus. If it is vice versa, then it will be referred to as a BOP deficit. And whenever there is a BOP deficit, what does it mean? The supply of dollars in the domestic market is lesser compared to inflow of dollars. And that is where RBI generally takes into consideration the forex reserves, starts supplying these forex reserves to ensure that sufficient dollars are available. Sufficient dollars are there in the market in order to ensure dollars will be purchased and dollars will be taken out of India. So in this particular case, is it okay if I say forex reserves will start coming down? Forex reserves will start depleting in India. Everybody is able to understand, right? So BOP deficit and BOP surplus. What generally happens in India? We generally experience BOP surplus, right? So these are certain important points in the context of balance of payment. Now, when you talk about all of this, there is also a term called as import cover. Remember this. There is also a term called as import cover. What is the meaning of import cover? Import cover essentially refers to the amount of forex reserves that are sufficient to cover certain months of imports. How much is the forex reserves which we have? And is it sufficient to import for 6 months, 7 months, 8 months, 10 months? How many months can I import? That is essentially called as import cover. Generally, India's import cover hovers around 10 months. It can be higher in certain months, it can be lower in certain time period, but generally it is around 10 months. Okay, that is point number 1. Point number 2, before the lunch break, there was one student who was continuously asking me. I did not answer that because I had to discuss it now. That is essentially the concept of twin deficit. How many of you heard of this? Twin deficit. What is this idea for twin deficit? Twin deficit essentially refers to two deficits. One is the fiscal deficit, and the second one is the current account deficit. Remember this. One is the fiscal deficit, second one is current account deficit. Be very, very specific. Be very specific. Because I can see one student is saying BOP and budget. Right? They can give you those terms also. But simply say, right, fiscal deficit as well as current account deficit. Now, please understand, it was happening. It is not happening now. It was actually happening in the context of pandemic in India. That is, at the same point of time, we were observing that the fiscal deficit as well as the current account deficit both were actually going upwards. And that is the reason this is referred to as a fiscal deficit. Is there connection between both of them? Let me see how many of you know this. Is there connection between both of them? Why do we connect to both of them? Why do we consider only both of them? Why not anything else? We could have talked about, let's say, trade deficit and a revenue deficit. We could have talked about, right, let's say, primary deficit and a fiscal deficit. But why specifically the current account deficit and the fiscal deficit? The reason is very simple. Listen to me carefully. According to multiple theories, if a particular country's fiscal deficit starts to go upwards, it will contribute to inflation. Point is clear. If the fiscal deficit goes up, it will contribute to inflation. And if there is inflation, lot of investors will look at the inflation and start running out of India. If there is, right, let's say, withdrawal of investments, right, if there is outflow of money like this, what will happen to, let's say, the rupee value? Rupee value will be affected. And when the rupee value is affected, automatically what will happen? It will have an impact on exchange rate as well as the deficit. That is the trade deficit, which will contribute to the current account. So multiple theories are there. I hope you understand. Multiple theories are there. Some experts argue that there is a connection between both of them, strong connection. And some experts argue no, there is sufficient data not available for it. Anyways, if UPSC will ask you what is a twin deficit, fiscal and current account deficit, these are the two deficits. Is it okay? Now, last concept within the balance of payment, that is convertibility. Convertibility. In the context of convertibility, what you need to understand? Point number 1. What do you mean by convertibility? Convertibility simply means, are there any restrictions? Are there any restrictions in terms of converting dollar to rupee and rupee to dollar? That is essentially from the domestic currency to a foreign currency and back, that is from the foreign currency to domestic currency. Is there any restriction or is it freely allowed? That is a concept of convertibility. In the context of India, please remember this. Please remember all of this. And those who are asking for notes, I'm actually surprised that you people are still asking for notes. The handout for the short notes, that is basically for prelims, the handout is already there in my Telegram channel. You can download it from there. It has been there for the last 2 months on my Telegram channel. Okay, let me go forward now. In the context of convertibility, capital and current. In case of current account, post 1993, repeat the statement here. Post 1993, we have shifted to full convertibility. In current account, post 1993, we have shifted to the full convertibility. Whereas in case of capital account, even today, we follow partial convertibility. In capital account, even today, partial convertibility. What is the meaning of it? Listen to me carefully. Under the current account, you want to convert rupee to dollar, dollar to rupee. Any restriction? No. Freely convertible. You bring in dollars, can you convert that into rupees? Allowed. Allowed, perfectly allowed. You want to convert rupees to dollar? Allowed. Whereas in the capital account, imagine you're a foreign investor, you want to invest in India. Will there be a restriction on your investment? Yes. You want to invest in America. Will there be a restriction on your investment? Yes. You want to borrow from America. Will there be a restriction? Yes. So, in the capital account, restrictions are there. And the reason is very simple. RBI and the government of India simply say, if there are no restriction, let's say there is a event which will basically destabilize the global market, such as a COVID, such as 2008 global financial crisis, suddenly the dollars will flow out of India. Sudden flow. And that will have a huge impact on the forex market as well as the financial market. We are not ready for such kind of volatility in the Indian market. So we do not want to basically provide for full convertibility. That's the reason current account, full convertibility, capital account, partial convertibility. But remember the name of the committee, I've written it here, SS Tarapore Committee. SS Tarapore Committee. The SS Tarapore Committee has recommended that India should shift to full capital account convertibility. India should shift to full capital account convertibility. We are yet to do that. Right. So, and there is one more term here, dual exchange rate. LERMS. I've written the term LERMS, which was introduced in 1992, withdrawn in 1993. What is LRMS? LERMS, Liberalized Exchange Rate Management System. Liberalized Exchange Rate Management System. Sir, what is this exchange rate management system? Listen to me carefully. After independence, we had a different exchange rate. We had basically connected our exchange rate to a foreign currency. We had capped our exchange rate. After 1970s, we introduced a system where RBI would determine the exchange rate using a basket of currencies. That continued till 1991. In 1991, there was LPG reforms. And one of the outcomes of the LPG reforms was we wanted to liberalize the exchange rate. We wanted to shift from the fixed exchange rate mechanism to the floating exchange rate mechanism. But our concern was we did not want to shift suddenly like this from one extreme to another extreme. All of you able to understand what do I mean by one extreme to another extreme? From fixed to floating, sudden shift like this. No. What we did was, as a temporary measure, we introduced a system called as dual exchange rate. And that, my dear, is called as LERMS, Liberalized Exchange Rate Management System, where part of the currencies, certain percentage, 40%, 40% of the currencies were exchanged at fixed exchange rate, and 60% of the currencies were changed at basically the market determined exchange rate. So we did this for 1 year, and then we shifted 1993, we shifted to floating exchange rate, that is basically providing the full convertibility to current account. Everybody is okay with the story here? Everybody is okay with the story? Try to understand all of this like a story. It will be easier for you to remember rather than simply memorizing everything. Okay, so this is basically the discussion regarding the concept of balance of payment. Now let me go back. There is one part that I'm yet to discuss here. That is in the slide, last three terminologies are there. One is the real exchange rate. Second one is the nominal effective exchange rate. And the third one is real effective exchange rate. What is the meaning of each one of them? Let's understand. A lot of you are generally confused between rear and near. Listen to me very, very carefully now. Please listen to me very carefully. Point number one, what is nominal exchange rate? It is essentially right now how many rupees you will have to pay to get $1. That's it. Right now in the market, how many rupees you will pay to get $1. That is called as a nominal exchange rate. So $1 is equal to, let's say, 60 rupees. That is the nominal exchange. There is a real exchange rate. Now tell me, can only the nominal exchange rate be useful to find out how products in India can be purchased or compared with products in USA? Think of this. Can only the nominal exchange rate, or is it only sufficient to compare goods in India with goods in USA? It is not sufficient. Those who are wondering, should I say yes or no? Answer is no, it is not sufficient. Why? If one good in India, let's say a cup of coffee in India will cost 10 rupees, same Starbucks coffee, again, I know somebody will say, sir, 10 rupees, what Starbucks you will get? Let me make it much more realistic. Let's say Starbucks coffee in India will cost you, let's say 300 rupees. Same Starbucks coffee in USA will cost you, let's say $5. Correct. Will cost you $5 in America. The argument is only the nominal exchange rate is not sufficient to find out and compare the pricing of the goods. Right? The goods in India with the goods in USA, only nominal exchange rate cannot be used to compare both of them. Reason being, what are the wages in India will be different compared to USA wages. What is the price of raw materials in India will be different in India compared to USA. What is the profit motive here, there will be different. Essentially, the point I'm trying to make is the price levels of the products will also matter. Is everybody okay so far? Do let me know. Price levels of the commodities will also matter. And that is the precise reason what we do is whenever you want to compare, let's say, goods in India with goods in USA, we do not just use nominal exchange rate, we use real exchange rate. And what is the use of real exchange rate? Let's say hypothetically, one product in India is equal to, let's say, three products in USA. I'm writing India this side and USA this side. Let's say right now, listen to me very carefully now. Okay, right now, let's say $1 is equal to 60 rupees. Hypothetical number, by the way. Hypothetical. Don't say, sir, you're wrong. $1 is equal to 87 rupees, but you're taking a lesser number. Hypothetically. Okay. $1 is equal to 60 rupees. And if I take $1, I can purchase three products in USA. And if I have 60 rupees, I can purchase one product in India. If this is the exchange rate, can I simply say the products in USA are cheaper compared to products in India? Yes or no? I want your answer now. 3:30, I know a lot of you will be feeling sleepy. Sir, Saturday afternoon, etc., etc. Do let me know. If I use $1 is equal to 60 and I'm comparing products in India with USA, whether I have $1 or 60 rupees, I can purchase one product in India and similar three products in USA. Can I simply say products in USA are cheaper compared to product in India? That is essentially, my dear, real exchange. That is essentially a real exchange rate. Is it okay? Everybody is on the same page with me? Because nominal exchange rate will compare currency with currency. Real exchange rate, you can use it to compare products. You can use it to find out purchasing power. There is something called as purchasing power parity. Purchasing power parity. What is the meaning of purchasing power parity? How many currencies are required to purchase the same set of goods and services in two different countries? What is the money that you require to purchase the same set of goods and services in two different countries? That is called as a purchasing power parity. For example, let's say you are taking a basket of goods and services. You're taking a basket of goods and services. To purchase this basket of goods and services, let's say in America, you need to spend $10, and in India, you need to spend 200 rupees. Then basically, I'll compare these two currencies, derive a exchange rate that is $1 is equal to 20 rupees. This, my dear, is the exchange rate at purchasing power parity. Everybody is able to understand now? And if UPSC will ask you connection between the purchasing power parity and the real exchange rate, remember this. Whenever the real exchange rate is equal to 1, we simply say the currencies are at parity. I'll repeat the statement here. Whenever the real exchange rate is equal to 1, we will simply say the currencies are at parity. Meaning what? Whatever is the nominal exchange rate, whatever is the nominal exchange rate, you can use those currencies to purchase the same set of goods and services in both India as well as USA. That is essentially the concept of nominal exchange rate, real exchange rate, as well as purchasing power parity. Can we move forward now? Can we move forward now? Okay. Now, next is the concept of near and rear. All of you, please listen to me very carefully. Near and rear. Before I start discussing, I just want to give you a disclaimer. Disclaimer. Please do not enter into the discussion of how both of them are calculated. Is it okay? Is my statement okay? Do not enter into a discussion, because trust me, if you ask me, sir, show me how both of them are calculated. This is the formula for calculation. Near is calculated using this formula. Now tell me, how many of you are okay with me discussing this particular formula? And the rear is calculated using this particular formula. And these are very, very small formulas which are used to calculate both rear and near. And if somebody will ask me, sir, tell me how both of them are calculated, I'll start discussing these two formulas and calculation. I know lot of you people, at least some of you people, shifted from, right, let's say the science part to the arts part. And in college, you simply said, no, sir, I don't want to become a science graduate. I want to take up arts because you are afraid of mathematics. And now, if I basically drag you into the calculation of integration like this, you'll basically say, sir, no, I want to skip UPSC also. So, point number one, listen to me very carefully. Point number one, do not worry about how both of them are calculated. Don't worry. Point number two, both of them are calculated by Reserve Bank of India. Both of them are calculated by Reserve Bank of India. RBI calculates. Okay. Point number three, both are nothing but indices. Both are nothing but indices. Both are index number. Both are essentially representing what is happening to, right, let's say certain parameters. That's it. You need to remember only these things. Next, next point. What is near and what is rear then? What is near and what is rear? Near represents Indian rupee against basket of currencies. Is my statement clear to all of you? Do let me know right now. Near represents value of Indian rupee against basket of currencies. So which currency? The trading partners. You have trading partners. Their currencies are there. Take that. right? And on the other side, REER represents India's trade with, that is goods, or let's say exports of India with exports of trading partners. You need to remember only this much. Now somebody will ask me, how do I understand when the numbers are given? When the numbers are given, right? Simply understand this. If near index goes up, right? Listen to me very carefully. Let me explain it to you. Okay, here is the blank slate. Let me write it. Let's say I'll write it like this. 1 rupee is equal to, let's say, $2. Let's take a simple number, okay? 1 rupee is equal to $2. And if 1 rupee becomes is equal to $3, can I write it like this? 100 and 150? Do let me know. Can I create an index using all of this? Can I write it as 100 and 150 when the exchange rate will move like this? I want an answer from all of you in the comment section. And whether this is Sharir or Paneer, Sripat Mishra, others, please listen to me. Sripat Mishra has a different formula. You people listen to me. And please do let me know, if 1 rupee is equal to $2 and 1 rupee becomes is equal to $3, can I index the numbers? And now tell me, if the index number goes up further to 200, if the index number goes up further to 200, can I simply say it represents Indian rupee is appreciating and dollar is depreciating? Everybody is able to understand? It means Indian rupee is appreciating and dollar is depreciating. Now, instead of one currency, you take group of currencies. That's it. Instead of one currency, you take group of currencies. And if the index number goes up, what does it mean? Simply means Indian rupee is gaining value. The basket of currencies is losing value. Indian rupee is gaining value. And if index number, let's say last year, if the index number was 170, and this year, index number has fallen to, let's say, 150, what does it basically represent? What does it mean? It represents rupees losing value, basket of currencies are gaining value. Everybody is able to understand how do you read near numbers now? Do let me know. I'll shift to rear now. How do you read near numbers? Everybody is able to understand. Now, how do you read rear numbers? Take the same example that we took earlier. Real exchange rate. Let's say one good in India is equal to 3 goods in America. If this is 100, one product in India is equal to 4 products in America. Can I make it as 133? Do let me know in the chat section. I'm looking at the chat section, by the way. If one product in India is equal to 3 products in USA, if it can be equated to 100, can I equate one product in India with 4 products in America as 133? Of course, yes, indexing. This is the basics of indexation. But what has happened here? Can I simply say, if the rear number goes up, if the rear number goes up, Indian product is losing competitiveness. Indian exports are losing competitiveness. Imports are becoming cheaper. Correct? Now, instead of comparing with one product, only one product from USA, can I take products from, let's say, China, product from UK, product from Germany, that is a basket of products. Can I compare one product in India is equal to, right, how many products in trading partners? That, my dear, is rear. Now tell me, is it okay? Final point associated with the exchange rate. If rear index goes up, can I say India's export competitiveness will go down? Do let me know. Final point, by the way. If rear index number goes up, can I say India's export competitiveness is going down? And import competitiveness or imports will become cheaper. And if rear index goes down, rather than increasing, if it goes down, then India's export competitiveness is increasing, imports are becoming costly. That's it. These are the things you need to remember. Is everybody okay with rear and near at least now? Is everybody okay with rear and near? Again, I know for lot of you, this will be new information. Revise it today. Please revise it today. For a lot of you, this is the first time you are hearing to how do you understand the difference between NER, RER, REER, and NEER. So I know. So what you need to do is consolidate it. How do you consolidate? Revise. Revise once, revise twice. Automatically you'll understand. Okay. And by the way, one more point which UPSC can ask you, because you'll have to be technically sound also. Remember, whenever you talk about a near and a rear, whenever you talk about rear and near, there is a concept of trade weight as well. Right? I'll repeat the statement. Whenever you talk about near and rear, there is a concept of trade weight as well. I'm rounding off something. Can you see? In both the formulas, I'm rounding off a numerator, or let's say to the power. What is that WI? WI stands for trade weight. WI stands for trade weight. So please remember, whether you are talking about near or rear, there is a concept of trade weights as well. Right? But what is the difference between near and rear? In near, you're taking currency against basket of currencies. In rear, you're taking goods with a basket of goods. Price levels are adjusted or considered in rear. Price levels are not considered in near. Is it okay? Done? Right. So these are the important things in the context of exchange rate. So we are done with exchange rate. We are done with balance of payments. Let me go forward. World Trade Organization. I'll cover IMF also. Cover IMF today. Don't worry. And I don't know how many of you are reading newspapers very, very carefully. Today, was there an article in the newspaper regarding IMF? Today is a newspaper. Was there an article regarding IMF? Yes. In the last 1 year, there has been a lot of discussion regarding IMF. Be very careful. Now, let me go forward. World Trade Organization. Okay. Point number one. WTO was okay. Sorry. WTO was established on 1st January 1995. 1st January 1995. Before this, there was GATT. 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 General Agreement on Tariffs and Trade, which was the outcome of Bretton Woods Conference, which was held in 1944 in USA. Right, which was held in USA. Essentially, after the discussion in 1948, essentially we set up GATT, because the ITO, which was earlier, basically the proposal ITO was not accepted. We agreed to a temporary arrangement called as GATT. But over a period of time, we realized GATT is not performing well, because GATT was focused only on the merchandise. We wanted to go beyond merchandise, cover even, let's say the services. We wanted to cover IPR, etc. That's the reason we held negotiations. And finally, 1995, we established World Trade Organization. Now, what is the structure of World Trade Organization? At the top, highest decision-making body, it is a ministerial conference. Right? Generally, I repeat, generally, once every 2 years, the ministerial conference or ministerial conference, not council, ministerial conference. Ministerial conference is held once every 2 years. Again, generally, not always. But please understand the day-to-day decision making. The day-to-day decision making of World Trade Organization essentially is done by General Council. Okay, General Council, GC. It is this General Council which will act as a dispute settlement body. It is this General Council which will also act as a trade policy review body. Remember these points. It will essentially act as a dispute settlement body, also as a trade policy review body. Now, whenever you talk about dispute settlement body, what is the basic idea? How it is connected to current affairs? Listen to me. Dispute settlement body is set up as per the dispute settlement understanding which was decided at the time of establishment of World Trade Organization. And right, listen to me. The dispute settlement body will take up the disputes which are involving, let's say, two countries or group of countries, one country on one side against a group of countries, whatever it is. Whenever there's a dispute, we will basically take up this to the dispute settlement body, and it is this dispute settlement body which will address the disputes by establishing a panel. A panel is set up which will generally have three experts. The panel will investigate, submit a report. Against the findings of the panel, you can approach appellate body. That appellate body can overturn the findings, can basically enforce the can enforce the findings of the panel, or essentially it can alter the findings of the panel. So appellate body, once it gives the order or basically issues an order, now the voting will take place in the dispute settlement body, and after that the findings of the panel are accepted. This is generally how the dispute settlement body will work. Now please remember, the decision making in the dispute settlement generally happens through consensus. It happens through consensus. Remember this. And in case of appellate body, generally there are seven members. There are seven members who are appointed through consensus. And right now, there are zero members in the appellate body. And it was this dispute settlement body which was considered as the crown jewel. It was considered as a crown jewel of World Trade Organization. Right now, it is not functioning correctly because the appellate body is dysfunctional. Okay. Now, next point, agreements under WTO. Agreements under WTO. Generally, one question is asked regarding the agreements. Please make a note of these agreements. And please understand this. All of this is there in the handout. Download the handouts. So, important agreements. One, GATS agreement. GATS, GATS agreement. GATS agreement essentially talks about, listen to me carefully, the trade in services. The GATS agreement essentially talks about trade, international trade in services, general agreements on trade in services. Remember this. Why? I'll tell you. You should remember all of this. Why? Very recently, again, although it has happened very recently, these terms are there in the newspaper for a longer period of time. Very recently, India signed a free trade agreement with UK. Yes or no? All of you heard of this? India signed a free trade agreement with UK. And in this particular trade agreement, was there a discussion regarding allowing Indian workers free access or more liberalized access to the UK market? Simple point. Right? Liberalized access or more freedom will be given for these Indian workers to basically get access to the UK market. Right? And whenever you talk about, let's say, the UK market, one of the very important exports from India is the service exports. And I'm pretty sure all of you have heard of this. And I even have seen that particular lecture. Sarmat sir spoke about that in that day's CNA. He spoke about a convention regarding double contribution. Convention regarding double contribution. Right. So essentially, it is going to have a huge benefit to service sector in India, especially the IT sector in India. My dear, when you talk about IT sector, you're talking about services. And when you talk about international trade in services, it is connected to GATS. It is simply connected to GATS. So GATS is there in the current affairs for multiple reasons. Please remember that. Under GATS, generally the services are divided into four categories. Let me see how many of you know that. What are the four categories? What are the four categories of services which are divided under GATS? Let me know. Ah, anybody remembers? Nobody is answering. Why? What are the four categories right under the GATS where services are divided according to the classification? Cross border supply. Somebody says cross border supply. Somebody says consumption abroad, commercial presence. Right? These are called as technically four modes. Four modes. Classification of services into four modes. My dear, please remember that. Important, please remember that. One is a cross border supply. One is cross border supply. Second one is consumption abroad. Third one is a commercial presence. And the fourth one is presence of natural citizens, natural persons, presence of natural persons. Four classification. And the way I basically told you is according to the sequence. According to the sequence, you should not simply memorize them abruptly. Mode 1 is cross border supply. Mode 2 is consumption abroad. Mode 3 is commercial presence. And mode 4 is presence of natural persons. Right? So you will have to remember according to sequence number. Please do not make a mistake in that. Okay? So all of that comes under GATS. Most favored nation principle, a national treatment principle, all of them are under the concept of GATS. Okay. Next, TRIPS, trade related intellectual property rights. Trade related intellectual property rights. TRIPS. What is the importance of TRIPS? Every member country under WTO should have a law in order to protect intellectual property rights. It could be, let's say, copyright. It could be industrial design, it could be patent, etc. Every member country should have a law in order to provide protection to the intellectual property rights of, let's say, domestic companies or even foreign companies. And trust me, even this was there in the newspaper. I'll prove it to you. Even this was there in the newspaper. And many of you ask me, sir, how? You're wrong, etc. Two things. One, when Mr. Donald Trump announced tariffs on China, one of the arguments that he put forward was protection of IPR. Correct? All of you have heard of this. Second, when Mr. Donald Trump announced tariffs on India, there was a report published by United States Trade Representative. And the USTR basically raised the same concern. One of the concern was raised was weak protection of intellectual property rights in India. So the model of IPR, the discussion regarding IPRs is happening a lot. Be very, very careful. Is there a law under WTO? Is there an agreement under WTO? Yes. And that is TRIPS, by the way. And TRIPS basically mandates that every member country should provide through a law the protection of the intellectual property. And one more agreement is a TRIMS agreement. TRIMS agreement. What is this TRIMS agreement? Investments are done by a USA company in India. Can government of India have a policy of discrimination against it? Goods are coming into India from USA. Can government of India have a policy of discrimination against this particular good? That is basically under the regulation of TRIMS agreement. TRIMS essentially says the goods, investments, right? Let's say foreign companies, right, entering into a particular country, etc. The member countries will have to provide protection. Provide protection to that. Do not have a discriminatory policy. Right? Provide protection in the form of most favored nation principle. Provide protection in the form of national treatment, etc. So these are the very important agreements. Please go through this. I feel one question will be asked in this particular slide because lot of discussion is going to happen. If not in prelims, at least in the mains, I believe one question will be asked on this. Done? Okay. So next, associated with international trade, I've covered the concept of, right, have a look at this. In international trade, I've covered exchange rate, balance of payment, World Trade Organization is done. Let me go forward with market integration as well as foreign trade policy. That will essentially ensure that these important areas of international trade would be covered. Now, in international trade, what do you mean by market integration? Listen to me very carefully. There is a principle under WTO by the name of MFN. Correct? Most favored. What is this idea of a most favored nation? Most favored nation basically says a member country of WTO, if it provides a certain benefit to another trading partner, that same benefit shall be extended to all the other countries, all the other trading partners. I'll repeat the statement. All of you, please listen to me carefully. If a trading partner will extend a benefit to another trading partner, then the same benefit shall be extended to all the trading partners. That is, it is a policy of non discrimination. Is everybody okay? It's a policy of non discrimination. There shall not be any kind of a discrimination amongst the trading partners. That is essentially the most favored nation. Now, there are certain exemptions. There are certain exemptions to MFN principle. One such exemption is market integration. Market integration. Why? In the market integration, can India sign a trade agreement with USA, extend the benefits only to USA? Allowed. Can India sign a trade agreement with UAE, UK, or Australia for that matter, extend the benefit only to these countries? Yes. That is allowed. And that is essentially the concept of market integration. How do you define market integration? It is an approach followed by the countries around the world where they will have discriminatory policies in favor of a country or group of countries. Is it okay? Where they will have a policy of discrimination which is in favor of one country or group of country. That is, if I sign a trade agreement with USA, it's a discriminatory policy, but it is in favor of USA. That is essentially the concept of marketing. Okay, so what are the different levels of market integration? Please listen to me very carefully. First one is PTA, Preferential Trade Agreement. Second one is FTA. Third one is Customs Union. Fourth one is Common Market. Highest level is Economic Union. Please memorize this in the same sequence. I'll repeat the statement. Please memorize this in the same sequence. Do not mix and match. Why? From one level to the next level, integration goes up, complexity goes up, the connection between the countries or group of countries goes up. So, if UPSC will ask you which is the highest level out of all the five, you cannot simply arbitrarily pick up any one. It has to be the economic union. Which is the lowest level of integration? You cannot arbitrarily say anyone. It has to be PTA. So, start with PTA, then go with FTA, then you will have customs union, then you will have common market, and then you will have economic union. That is how the integration happens. And quickly, please listen to me carefully now. Quickly, what is the meaning of each one of them? PTA, small part of the total trade will be covered. Between two countries or group of countries, small part of the total trade will be covered. And there are no percentages here. Don't ask me, sir, small part means give me percentages. No fixed percentages. Okay. Second, FTA, most of the trade would be covered. I'll take a current affairs example to make you understand. In recent times, India UK FTA, this was there in the newspaper. And if you have read the newspaper correctly, what was one point? 99% of the trade that will be exported from India to UK would be covered under this. Am I correct? This was there in the newspaper. So essentially, that is FTA. Most of the trade would be covered. Most part of the trade. Okay. Customs union. What is basically the idea of a customs union? Imagine two countries, they are in a trade agreement. Now, these two countries will basically have the same customs duties when they trade with other countries. Just to give you an example, imagine India and UK. India and UK tomorrow will form a customs union. What does it mean? They will essentially have the same rate when they will trade with USA. Right? Essentially will have the same customs duties, that is imports and export duties, when they will trade with rest of the world. That is basically the customs. Common market. Now, this group will have, right, let's say, free movement of capital. This group will have, right, let's say, free movement of labor. That is essentially the common market. And finally, economic union. The group, whether it is two countries, three countries, 10 countries, 15 countries, doesn't matter. In this group, now they will have same policy, same currency, right? Same parliament also. That will become political union. Don't worry. But monetary policy will be same. Currency will be same. Fiscal policy will be same. That is essentially economic union. Everybody is okay with the discussion so far? So this is how the integration will happen. Please remember in this format itself. And please understand, India will be here. India has a multiple PTS. India has a multiple FTA. After that, do not search where is India present. Right? The economic union. Does India or is India part of any economic union? No. Is India part of any customs union? No. Is India part of any common market? No. India will be present in the first as well as second. After that, you will not be able to find India. And okay. So last point within the international trade, free trade policy. Last point within this, free trade policy. Now, what is this free trade policy? Listen to me carefully. In the beginning, government of India had a policy of annual export and import policies. Annual export and import policy. We used to call it as EXIM policy. That is, every year there will be one policy to promote export and import. But later, government of India realized in 1980s, no point of right having annual policy. We should have policy for 3 years. We should have a policy for 3 years rather than having annual policy. And that's the reason instead of 1 year, now we started having export and import policy of 3 years. And later government of India realized that there is no point of having for 3 years. We should have a policy for 5 years. Export and import policy for 5 years. And what we did was we renamed this export and import policy into foreign trade policy. Is it okay? We renamed it. Instead of calling this as the export and import policy, we called it as foreign trade policy. And until very recently, we used to announce a foreign trade policy once every 5 years. But the last foreign trade policy, which was supposed to be implemented from 2015 to 2020, government of India faced certain problems. What was the problem? Essentially, government of India realized the pandemic was having an impact. Government of India realized they cannot announce a new FTP. They were not able to announce a new FTP because there was a pandemic. So what they did was the same foreign trade policy was extended for 6 months. For 1 year, they kept on extending the foreign trade policy. And finally, in 2023, the government of India announced a new foreign trade policy. But what is the speciality about the new foreign trade policy? Please listen to me carefully. This new foreign trade policy doesn't have expiry date. Remember this. The new foreign trade policy doesn't have an expiry date. That is, this new foreign trade policy will continue to be implemented as long as government of India wants to implement. They want to withdraw it, they will announce it. But unlike earlier situation, automatically after 5 years, new FTP will not be announced. What about, right? What about the policies within this? Can the government of India keep on making changes in the policies? Government says yes. Right? Government says yes. Right? So essentially, the government is now announcing that this policy will continue to be implemented without any kind of right the sunset clause or expiry date. And another speciality of this right free trade policy. Did I say foreign trade policy earlier? Somebody says, sir, is it free or right for? Please do let me know. That person. Did I say free trade or foreign trade policy earlier? First, only sir said free. What did I say earlier? That's what I'm asking. I'm checking in the laptop also. Who said that? If I had said free, foreign, the correct term is a foreign. Most of you are saying, sir, you said free. Okay, my mistake then. If I had said free, my mistake, it is foreign trade policy. I'm checking comments in the laptop also. Foreign trade policy. It is foreign trade policy. Okay, done. Okay, if I had said free, correct it. Foreign trade. Okay, foreign trade policy 2023, no sunset clause. No sunset clause for this. It will be implemented, right, till the government of India wants to replace it. Everybody's okay, right? Now, what is the target under this? The target is essentially $2 trillion. The target is $2 trillion. By 2030, we want to achieve the exports of $2 trillion. And out of this, 1 trillion will be the goods or the merchandise, and 1 trillion will be services. Out of total 2 trillion, right, 1 trillion will be merchandise exports and 1 trillion will be the services. Now, in addition to this, there are multiple points here. For example, there is a policy called as SCOMET policy. SCOMET policy. SCOMET, again, very old policy. SCOMET basically stands for Special Chemicals Organizations. I'm sorry, organisms, not organizations. Organisms, right? Electronics, technologies, etc. So, SCOMET policy will be streamlined under this. We do not want to provide export, let's say, subsidies. Instead of export subsidies, we will start providing incentives so that we are not going to violate any WTO principle, any WTO agreement, etc. We are going to make districts as the export hubs here. We are going to promote the, let's say, exports from every individual districts, identify the products from the district, set up district export promotion councils, and start promoting production as well as exports of this. Is it okay? Done? Right. So this is essentially, right, let's say, the discussion regarding the foreign trade policy. Everybody is okay? Everybody is okay. So these are the important areas of the international trade. I want you people to go through this. Please revise all of it. Please revise all of it. Okay? Done. Some of you are still saying, sir, you said free. My dear, if I've said free, it's okay. It's foreign trade policy. It is essentially foreign trade policy. Okay? I corrected it. Anyways, it is there in the slide also. Foreign trade policy. Okay. Let me go forward. Financial market. What is DDEH? Developing districts as export hubs. Developing districts as export hubs. Listen to me carefully. Earlier, there was an initiative called as ODOP. Okay, what is ODOP? One district, one product. One district, one product. Right. So initially, this was launched by the government of India, and later, government of India also launched Foreign Trade Policy 2023. And before this, there was one more initiative by the name of Developing Districts as Export Hubs. So what government of India did was, there are two initiatives where there is a overlapping objective. There is, right, overlapping objective, that is focus is on districts only. So the ODOP essentially was brought under the, right, let's say, ambit of developing districts as export hubs. Now this is being implemented. This is being implemented. That is essentially under the DDH. What we are doing is, at every district level, we will set up export councils. We will identify which product has more export potential, right? Which export can be, right, sent to USA? How can we market it in other countries, etc., etc. All of this will be done. Essentially, we are going to promote these exports using multiple policies. That is essentially the model of developing districts as export hubs. Okay, done. So international trade is done and dusted. Let me go forward. Financial market. Financial market. Sir, in which category SEPA and SECA generally come under? These are associated with the free trade agreements. Free trade agreements. These are associated with free trade agreements. There are four new districts that added to export hubs in Mirzapur, Faridabad, etc. That's a new policy which was announced in the recent budget. It was a policy announced in the recent budget. Okay, let me go forward. Financial market. Listen to me carefully. Financial market is divided into two parts. One is called as a money market. Second one is capital market. What is essentially the difference between the money market and the capital market? Listen to me carefully. You will come across a term called as capital. All of you heard of this? You'll come across a term called as capital. Okay. What is the meaning of capital? Can anybody tell me what is the meaning of capital? Again, I'm not talking about state capital, national capital, etc. I'm talking about capital as a concept within economics. हाँ, those are asking कितने बजे start हुआ है class 12. 12 my dear. It was started at 12 p.m. only. Okay, let me go forward. Okay, all of you are answering assets, investment, machinery, asset, money to invest, capital is money, durable goods. Great. Future stream of benefits. Okay. Lalita Prasad Yadav says that thank you, dosto. So, dosto, thank you. Okay, done. So, listen to me very carefully. All of you, please listen to me. What is capital? Capital is anything that is produced by us. Listen to me carefully. Capital is anything that is produced by us which will be used for further production. All of you, please be careful. Capital is anything that is produced by us which will be used for further production. That is, understand this, capital is divided into two parts. One is called as, right, working capital. All of you heard of this? One is called as working capital and the second one is called as a fixed capital. One is called as working capital, second one is called as fixed capital. Important. Right? Working capital means what? It essentially, again, accounting concept I can discuss. Accounting wise, we can discuss excess of assets compared to working liabilities, etc. We can discuss that, but again, that will become more of a CA definition. But essentially, what do you mean by working capital? How much money that you spend to basically take care of day to day activities. That's it. Right? To take care of day to day activities, how much money you are spending. That is called as a working capital. Very, very simple definition. Again, I'm saying, according to accounting principle, this is not the definition, that has a different definition. But examples, any example, for example, you're paying salaries. You're paying, right, let's say electricity bills. You're paying for raw materials. All of them are counted, right, as a part of working capital. Second one is a fixed capital. Fixed capital are those assets which are essentially, examples are, right, let's say the machineries. The example is machinery, manufacturing facility, roads, right, infrastructure, etc. All of that are part of fixed capital. Now, why I'm explaining all of this? UPSC in the past has asked question on working capital. Be careful. Be careful. Both are part of capital only. Both are part of capital. Okay. Now, whenever a company wants to spend money for working capital, it wants to borrow money. They want to borrow money. Right? So, this amount of money generally the company will raise from the money market. The company will raise from the money market. Whereas, if the company wants to develop an infrastructure, if the company wants to basically purchase machineries, they want to purchase one more company, etc., etc., then, my dear, they will go to capital. Is everybody able to understand in which situation you will go to capital, in which situation you will go to working, fix the capital market as well as the money market? That's the reason in money market you will borrow for shorter duration. Shorter means up to 1 year. Up to 1 year. Whereas capital market you will borrow for, right, more than 1 year. It could be for 8 years. It could be for 10 years. It could be for 12 years, right? It could be for 15 years, etc. That is essentially capital market. Now, in money market, these are the different instruments. In money market, these are the different instruments. Call money market, treasury bills, certificates of deposit, commercial bills, commercial papers, repo, and reverse repo. Everybody is okay with the last one here. Repo and reverse repo, we have already done that. Is for short duration. All of you remember that. Let me cover the remaining one. Call money market, treasury bill, certificates of deposit, commercial bill, and commercial papers. Let's go one by one. And before going forward, as expected, there was one student who asked me, sir, explain to me what is CBLO? Commercialized borrowing, collateralized borrowing and lending obligations. CBLO. This was asked last year in the preliminary examination. And everybody will start running behind it now. Listen to me very carefully. A lot of times, you might criticize for this, you might criticize me for this, but a lot of times, there will be questions out of what you have studied. I'll tell you this. There will be questions right out of what you have studied. That is very common thing in the UPSC examination. Do not panic because of that. Please do not panic. Reason is UPSC will ask you those kind of questions because they want to make the questions difficult. Because they want to make the questions difficult. Otherwise, everybody will score 200 out of 200. Like NEET exams until now. But I'm pretty sure this time you have seen what was the reaction of the students who have written NEET exam very, very recently. Most of them are saying, forget about a 600, 650. I'm not able to get even 300. And basically, I was thinking, okay, NEET has shifted to UPSC pattern now. Right? So, argument is, again, don't worry about NEET exams. Argument is, do not worry. There will be questions which are out of what you have covered. That is very common. But don't simply say, I'll cover only one chapter, rest of it is out of what I've covered. So these kind of questions are there. I'll come to CBLO also. CBLO right now is not used in India. Last time CBLO was used, after which RBI basically stopped or basically banned, discontinued CBO was after 2018. We do not use CBLO. In fact, the tri-party repos that I discussed, tri-party repos replaced CBLO. But anyways, right, have a look at this. One more table for you to make a easy revision. Please have a look at the table. Call money market, treasury bills, certificates of deposit, commercial papers, and commercial bills. One after the other. Call money market. One bank will borrow from another bank only for short duration. Simple. And I expect a question from this particular table this year. I have my bet on the first one. I'll tell you the reason also. Right? I will place my bet on the first one, first tool itself. That is the call money market. I'll tell you the reason why. Call money market means what? One bank will borrow from another bank for a very, very short duration. How short? It could be for 1 day. It could be from 7 days or for 7 days. And it could be for 14 days as well. 14 days as well. So 1 day, overnight, week, or fortnight. That is 14 days. That is essentially the concept of a call money market. Is everybody okay with this? Please do let me know. Right? And the rate of interest that is applicable, the rate of interest that is applicable is called as a call money rate. And the call money rate is decided based on one more indicator called as MIBOR. Now tell me, was the MIBOR there in the newspaper in the last 1 year? Think of it. Is the MIBOR there in the newspaper for the last 1 year? MIBOR, by the way, stands for Mumbai Interbank Offered Rate. Mumbai Interbank Offered Rate. Right? So MIBOR. MIBOR is being replaced by one more indicator called as SOR now. How many of you heard of this? SOR. We have discussed this in the current affairs class. SORR. Secured Overnight Repo Rate. SOR. So that is the reason my bet out of this particular table is on the concept of the call money rate. Be very, very careful. Be very careful. Generally, if you take for 1 day, that is essentially called as a call money. If you borrow for 7 days, if you borrow for 14 days, that is called as a notice money. Right? So notice money for 7 or 14, otherwise it is essentially call money. Next one is a treasury bill. What is essentially the concept of a treasury bill? Listen to me very carefully. The government securities essentially are divided into two parts. These are divided into two parts. One is called as a treasury bill, and the other one is right essentially government bonds, or else these are also referred to as dated securities. Dated security. So far so good, right? So government securities can be treasury bills or dated security. The treasury bills will have a maturity period of up to 364 days. They will have a maturity period of up to 364 days. Whereas at the government bonds will have a maturity period of 2 years, 5 years, 10 years, 14 years, right? Let's say 30 years. Right now, the maximum maturity period of a government bond is 50. Is everybody okay? This part of the government securities are essentially part of money market. This is essentially money market. So these are called as treasury bills. Done? So treasury bills are the instruments which are issued by the central government. Please make a note of this. Central government. Are the state governments allowed to issue treasury bills? No. Only the center. So central government will use these instruments to borrow from the market for a period up to 1 year. But more importantly, remember this, the treasury bills are always issued at a discount rate. These are issued at a discounted rate. Meaning what? Imagine there is a treasury bill. The value, that is the face value of the treasury bill, is 100 rupees. The government will not issue this at 100. It will issue this at 95 rupees. And upon maturity, the government will pay you 100 rupees. So these are issued at discount, and upon maturity, you will get the face value of the instrument. These are also referred to as zero coupon instruments. Zero coupon instruments. Okay, treasury bills. Certificates of deposit. CDs, certificates of deposits. The certificates of deposits are issued by financial institution. It could be a bank, it could be all India financial institution. So these are issued, right? These are issued by these financial institutions for a shorter duration. For a shorter duration, right? Generally for 3 months, generally for 6 months, etc. And they will borrow from the market and provide certain returns on this. That is called as a certificate of deposit. Again, these are also issued at discount, redeemed at par. Next one, commercial papers. Commercial papers are issued by companies. Remember this. Commercial papers are issued by the companies, not any company. Not any company. For example, tomorrow if I open a company, can I issue a commercial paper? Not allowed. Right? Absolutely not allowed. What generally happens is the companies which are allowed to issue commercial papers should have a very good credit rating. Is it okay? They should have a very good credit rating, right? That is generally which will have a very good credit rating, such as a triple A, double A, etc. And essentially, they are allowed to issue commercial. Okay. So instruments of short duration issued by the companies, these are also generally issued at discount and redeemed upon maturity, redeemed at par value. Finally, commercial bills. The commercial bills are issued by a company which has purchased raw material, which has purchased certain services, etc. from a seller. Let's say you are supplying certain raw materials to me. Instead of making payment today itself, I will issue an instrument, a promissory note, which will promise you payment after 45 days, after 60 days. That is essentially called as a commercial bill, trade bill. It is also known as a trade bill. right? So these are basically promissory notes or guaranteed payment will be done after certain time period. After certain time period. Everybody is okay with the instruments under money market? Please do let me know. Everybody is okay with the instruments under money market. Now somebody said, sir, what about CBLO? Right? That is collateralized borrowing and lending obligation. That is essentially a type of instrument which was earlier used where, right, collaterals were issued and loans were taken. That's it. For short duration. What kind of collaterals? Government securities. Government securities were used as collaterals to borrow from somebody else in the market. That was the reason why this was called as a CBLO. And that's the reason I said from 2018, after 2018, we are not using CBLO. We have replaced that with the concept of the tri-party repos. Tri-party repos. And that is the argument. Okay. Okay. Now let me go forward. Capital market. Those who have questions, hold on to your questions. Let me cover some more, right? Let's say part, then I'll take up your questions for 5 to 10 minutes. 5 to 10 minutes. Capital market. Now, capital market definition I've already given to you. Yeah, I've already given the definition of capital market. In the capital market, what are the important points? Capital market is divided into two parts: debt market and equity market. Debt market is the one where the companies borrow, but please understand, this borrowing is done for a longer duration. They come under obligation of repayment. And right, have a look at this equity market. Here, the company will be able to collect the capital, but by selling, they will sell ownership and collect money. That is the debt market and equity market, respectively. In debt, ownership is not given, but they are under the liability. Whereas in case of equity market, ownership is sold, certain ownership is sold, and they're able to collect them. Now there is right two more terms here: primary market and secondary market. What is essentially a primary and secondary? Whenever a new issue is done, right? Understand this. Whenever a new issue is done, new issue of what? Any instrument. For example, a government bond is issued for the first time. Shares of the companies are issued for the first time. Right? Corporate sector will issue certain instruments. Whenever the issues are done for the first time, new issues are done, that will happen in a market which is called as a primary market. Now imagine you have certain shares of a company, you will start selling the shares. You have bonds of government of India, you will start selling these bonds in the market. That will happen in a market which is called as a secondary. For example, all of you heard of BSE and NSE? Please do let me know. All of you heard of BSE and NSE? BSE and NSE are essentially examples, right? These are examples of secondary market. These are examples of secondary market. Okay, right? So one, debt and equity, primary and secondary. Third one, IPO and FPO. IPO stands for initial public offering. FPO stands for follow-on public offering. Whenever the company will issue the shares for the first time ever, again shares, not the bonds, shares. Whenever the company will issue the shares for the first time ever, that is called as IPO, initial public offering. And how do you understand whether a company has gone for an IPO or not? Just to see whether the shares of the company are available in the stock market. Whether the shares of the company are available in the stock market or not, automatically will understand whether this particular company has undergone, whether this company has undergone the IPO or not. Right? So if the company has undergone IPO, it is called as a listed company. It is referred to as a listed company. Okay, this is essentially a listed company. Done? Everybody is okay so far? Now, what is FPO? A company which is already, right, issued shares, which has already issued shares. Let's say in 2010, a company is already right listed. It has issued shares. In such cases, please understand, if the company issues the shares again, that is called as an FPO. Everybody is okay with the term FPO and IPO? Please do let me know. Please do let me know in the chat section. Everybody is okay with the term IPO and FPO? A lot of discussions happening because, right, in the newspapers, because of the private sector in regards to both the terms. Please be very careful. Now, what is BSE and NSE? Both are indices. Right? NSE is also a market which will publish index. NSE index is referred to as a Nifty. NSE index is referred to as Nifty. And at BSE index is referred to as Sensex. Right now, what does both Nifty and Sensex represent? What does it represent? Basically, both of them represent movement of market capitalization. Remember this. Both of them represent what is happening to market capitalization. Is the market capitalization going upwards? Is the market capitalization going downwards? That is represented in the form of points. All of you heard of this? They'll simply say BSE Sensex fell down by 283. NSE Nifty, they'll say, has moved up to 19,000 points, 22,000 points, like this. What is the point? Point basically represents, right? It's an index, by the way. It represents what is happening to market capitalization. Is the market capitalization going upwards or going downwards? That is essentially represented in the form of, right, the indices here. Everybody is okay? Can we go forward now? Done? Can we go forward? Okay. So, within the concept of shares also, two types of shares, please remember them. One is called as preference shares. Second one is called as a equity share. One is a preference, second one is equity. What is essentially the difference here? Preference shares are those shareholders who will be given the first preference whenever the dividend has to be distributed. I'll repeat the statement. All of you, please listen to me. Right? What do you mean by, right? Let's say the preference share here, these are the shareholders. Right? Equity or the preference, both are shareholders. But whenever the dividend has to be distributed, what do you mean by dividend? Dividend is that part of the profit. It is that part of the profit earned by the company which the company wants to give it to shareholders. Remember this. It is that part of the profit of the company which they want to give it to shareholders. That is called as a dividend. So the part of the profit given to shareholders is called as dividend. Whenever the company wants to give the dividend, the first preference is given to these shareholders, hence called as preference shareholders. And remember this, these preference shareholders, how much dividend they would be getting annually, that is fixed. Whenever the dividend is given, how much is given? Fixed. Every year, let's say 4 rupees, provided, right, profit is there. Every year, 5 rupees. There is a fixed amount of dividend that is given to preference shareholder. And at the same point of time, also remember, the preference shareholders do not have voting rights. These do not have any kind of voting rights. They do not have any kind of voting rights. These are called as preference shareholders. What about equity shareholders? What about equity shareholders? The equity shareholders, right, understand, they will have voting rights. PR is voting right here. They will have voting right, but the amount of dividend that is given will vary. In 1 year, you might get 1 rupee. In the next year, you might get 4 rupees. Third year, you might have, right, let's say 3 rupees. So there is no fixed amount of dividend that is given. It will keep on varying from 1 year to the another year, but you will have voting rights. These are called as equity shareholders. So equity shareholders and preference shareholders, question can be asked. Please make a note of it. Next one is concept of bonds. Right, the idea of a bond. I have mentioned the concept of a bond in the context of the government of India. right? I said bond examples are 5-year bonds, right? Or 10-year bonds, 50-year bonds, etc. But in addition to the government of India, even the corporate sector, that is the private sector, the government owned entities, or even for that matter, international organizations are also allowed to issue multiple types of bonds. Is it okay? They are allowed to issue multiple types of bonds. I've given you some of the examples here. Convertible bonds, right? Convertible, non convertible, the masala bonds, zero coupon bonds, zero coupon and zero principal bonds, and indexed bonds. Let's go one after the other. Convertible bonds are those debt instruments which can be converted from a bond to equity. Simple. These can be converted from a bond to equity. That is essentially when you issue this, it will be a bond. After 2 years, after 3 years, this will be this will be converted into equity. That is, from a bond, you will become a shareholder now. These are called as convertible bonds. Everybody is okay with the term convertible bonds. What about non-convertible bonds? Best example, Government of India's bonds. If Government of India has issued a bond to you, let's say 30-year bond, after 30 year, it will still remain bond only. It will be, right, let's say completing the maturity period as a bond only. You cannot convert it. It will mature as a bond. That is essentially called as a non-convertible bond. Right? So convertible, non-convertible. Right? Somebody will ask, sir, any example of a convertible bond? Lot of the companies in India, right? Listen to me carefully. Lot of the companies in India, when they want to raise money from the foreign market, will issue a bond by the name of foreign currency convertible bonds. I don't know how many of you heard of this. FCCBs, foreign currency convertible bonds. Right? These are essentially the bonds which are issued by Indian companies outside India, let's say in dollars, let's say in euros. Essentially, now, if you purchase, let's say you're a foreign investor, you purchase it. After certain time period, these bonds will become shares. Right? So these are essentially called as foreign currency convertible bonds. Remember, FCCBs, according to RBI guidelines, FCCBs, the value of that is generally counted as a part of FDI, foreign direct investment. Reason being, after certain time period, the bond will become share. Share is equal to equity. Is it okay? Okay. So convertible, non-convertible, masala bond. What is this idea of a masala bond? Masala bonds are rupee denominated bonds. A company in India is allowed to issue, right? Let's say bonds in America, but the collection of the money, repayment, everything is done in rupees. These are local currency denominated. The context of India, the local currency is rupees. These are rupee denominated bonds. Right? These are issued in developed countries such as USA, such as European market. And what is the logic of the rupee denominated bonds here? The issuer is not taking a risk. Risk of what? Exchange rate. The borrower, investor, the investor faces the exchange rate risk. Meaning, if I issue this particular bond in America, I will issue it in rupees. That is, I'll collect the money in rupees, I'll make a payment in rupees. Whatever is the fluctuation in the exchange rate, it is the investor who will bear the burden of exchange rate, not me. And that is a precise reason these kind of local currency, right, or let's say masala bonds in the context of India, these kind of bonds carry higher coupon rate. These carry a higher interest. Okay. Zero coupon bonds, I've discussed that in the context of government securities or treasury bills. Zero coupon means very simple. Imagine I will issue a bond, maturity period of 3 years. The face value of the bond, let's say, is 100 rupee. I will issue the bond. Today, I will collect, let's say, 80 rupees from you. I'll collect 80 rupees. And after the maturity period of 3 years, I will basically give you the face value of the bond. And what is the face value of the bond? 100 rupees is the face value. I will give you the face value. That is essentially called as zero coupon bonds. And finally, I'm sorry, last but one, zero coupon and zero principal. How many of you heard of this one? Do let me know. Zero coupon, zero principal bonds. Where have you heard of this? How many of you heard of this? Zero coupon, zero principal. Let me know. Where? In what context? Ah, zero coupon, zero principal bonds are associated with, right? Remember the non-profit organizations. Non-profit organizations, social stock exchanges, SSEs, social stock exchanges, the entities which will get listed in the social stock exchanges will issue bonds which are called as zero coupon, zero principal instruments. That is, imagine I will sell a bond to you, value is 20 lakh rupees. You will give me 20 lakh rupees. It's a donation. It's a donation that you have done. In return, I will not give you interest. In return, I'll not give you coupon and I will not return your principal amount as well. That is called as a zero coupon, zero principal instrument or bond in the context of social, right? The SSEs, right? That is essentially very famous now. Please be very careful. Okay? Social stock exchanges. Okay. Finally, indexed. Let's say in the context of indexed, I will basically issue an instrument to you. I will link the returns to inflation rate. I will link the return to inflation rate. That is essentially as the inflation goes up, the amount of coupon I will pay to you will also go up. As the inflation goes down, the coupon will also go down. Here, I am connecting the returns to a particular parameter, that is inflation, hence called as inflation indexed bonds. Done. So these are the different types of bonds which are there from the static portion as well as the current affairs also. Please make a note of all of them. Next, concept of external commercial borrowings, ECBs. External commercial borrowings. Monu Chaudhary says, are they taxable? My dear, from one bond to another bond, it will vary. There is no fixed parameter to simply say all of them are taxable. I can't say that. I can't say all of them are not taxable. That is also incorrect. For example, infrastructure bond. If you purchase an infrastructure bond, which will have a maturity period of, let's say, more than 7 years, up to 20,000 rupees, it is not taxable. No taxes whatsoever up to 20,000 rupees, by the way. Whereas, if you invest in, let's say, normal government bonds, they're taxable. If you invest in sovereign gold bond, right, and you hold on up to 8 years, not taxable. Hope you understand from one type of a institution to, I'm sorry, one type of a instrument to another type of instrument, there is no fixed formula. It will vary from one bond to another bond. Okay. Now, external commercial borrowing. ECB, external commercial borrowing. What is an external commercial borrowing? The identified, let's say, sectors in India, any sector which is identified and which is allowed to attract EFDI, which is allowed to accept EFDI, right? That is a foreign direct investment. These entities are allowed to go to the foreign market and borrow from the foreign market. Is my point clear? I'll repeat this again. Please listen to me carefully. Any sector where FDI is allowed, where foreign direct investment is allowed, the companies in these sectors can go to the foreign market, borrow from the foreign market. And when they borrow from the foreign market, they can borrow either in the domestic currency or they can borrow in foreign currency, either domestic or foreign currency. This essentially is called as external commercial borrowing. Is it okay? External commercial borrowing, ECBs. Right now, the external commercial borrowings is allowed up to $750 million per year. And you can bring it and invest it basically, right, through different routes in the Indian market. For example, the concept of a masala bond, the concept of masala bond, right? The idea of a masala bond essentially is a part of external commercial borrowing. And if you ask me, sir, in what way can I borrow from the external market under ECB? You can issue different types of instruments, borrow. You can go to a bank, borrow from a bank, which is, right, let's say a foreign bank, or essentially from the foreign market. That is, right, all of it is counted under the concept of ECB, external commercial borrowing. Let me ask you a very simple question. Let me ask you a very simple question. ECB will be part of current account or capital account of balance of payment. Let me see. ECB will be part of current account or capital account of balance of payment. Where will you place it? Current or capital? All of you will agree it's a part of capital account. Is it okay? Right? It's part of capital account. Let me ask you one more question because I've discussed the financial market. X will sell a share to Y at 200 rupees. Listen to me very carefully. X will sell the share to Y at 200 rupees. Will this 200 rupees be counted as a part of GDP of India? Let me see. Will the 200 rupees be counted as a part of, right, GDP of India, gross domestic product? Right? Somebody will say, sir, can it be counted as GNP? Can it be counted as NDP, etc.? My dear, it will not be counted as a part of GDP. It will not be counted as a part of GDP. Why? Listen to me very carefully. When you sell a share, there is absolutely no production of a good or a service that has taken place. Is it okay? There is absolutely no production of a good or a service that has taken place here. Right? Essentially, money has transferred from one hand to the other hand. Instrument has transferred, right? In vice versa. That's it. So in such a case, right, there is no contribution to GDP. It is not counted as a part of GDP. So please be very careful. These kind of questions can be asked. And those are asking me, sir, is it 1.5 billion or 750 million? I said 750 million because it was increased to 1.5 billion. I've checked the RBI website, by the way. RBI website says it will be doubled from 750 million to 1.5 billion for a temporary period. For a temporary period. That is, I believe, up to 2023. After that, I think it has returned back to the basic number of 750 million. If it has been increased permanently, you take that. But I checked RBI website. It has not been given that it is permanently changed. During the period of pandemic, during COVID time, it was doubled from 750 to, right, let's say 1.5 billion. Okay, done. So everybody is okay. So far, so good. External commercial borrowing. Next, AIF. Concept of AIF, the Alternative Investment Funds. AIF stands for Alternative Investment Funds. Now, what is this Alternative Investment Funds? Listen to me carefully. Point number one, AIF are regulated by SEBI. Remember this. AIF are regulated by SEBI. Right? A lot of these are regulated by SEBI only. But what is the importance of AIF? All of you heard of mutual funds? In fact, that is also a point here. All of you heard of mutual funds? Right? Mutual funds sahi hai. The people who are watching IPL, you would know that. So mutual funds is a model where, right, basically the collections are done, the collections are pooled, investments are pooled, and the investments are further done into different instruments in the market. The investment will be done in debt market, investments will be done in the equity market. This is essentially the model of mutual funds. Please listen to me very carefully. I will use the same model to explain two more different models. One is essentially the model of AIF, Alternative Investment Funds. What is this idea of alternative investment funds? Rather than collecting money from individuals, small investors like this, can we collect money from large number of investors? When I say large number, I'm talking about the amount here. Can we collect large amount of investment from rich investors? That is essentially the model of an alternative investment. There are three categories. AIFs have three different categories. Right? For example, sovereign wealth fund. All of you heard of sovereign wealth fund? Please do let me know. SWF, sovereign wealth fund. For example, Abu Dhabi Investment Authority, the sovereign wealth fund which is investing in India. Right? It's essentially owned by a government. Sovereign wealth funds are owned by government. So please understand what essentially happens in AIF is a huge amount of investment is invested in the market through fund managers. Very simple model, right? Lot of investment, large number of investment is done through fund managers into the market. It can happen in different instruments in the market, but the basic idea is in case of AIF, the amount collected will be very high. Investment done will be very, very high. Right? That is essentially the model of right alternative investment funds. For example, you must have heard of venture capitalism. Venture capitalism essentially comes under this model only. Okay. Mutual funds, I know some of you will basically, what is the difference between a mutual fund and this then? Mutual funds is for smaller investors, Aam Aadmi, mango people, such as you and me, who will be worried, right? When my investment, for example, if you have invested in the stock market, like me, you'll be worried even if the prices will fall down by 10 rupees. Your investment is how much? 2000 rupees. It has fallen down by 10 rupees. You'll basically hold your heart like this. Morning it was 2000 rupees and now it has become 1990 rupees. And if it further falls down to 1980 rupees, more heart attack. So I hope you understand our investments are very, very small investments, right? But let's say rich people, high net worth individuals, the crorepati's, they are not investing small amount. They are basically pooling large amounts, right? There are different types of investors like this, different types of investments. All of them are covered under AIF, and all of them are regulated by SEBI in India. Done? Right? So mutual funds, I've explained the mutual funds here. Again, mutual funds is regulated by whom? SEBI only. Mutual funds is also regulated by SEBI. What is the basic model of a mutual fund? Mutual funds represent pooled investments. Pooled investments. That is essentially, right, all of you will basically donate, let's say, or not donate, will contribute, let's say, 200 rupees each. We will create one fund. I will invest in the stock market. I am a fund manager. I will manage it. Is it okay? Right. So that is the basic model of a mutual or small investor. Mutual funds is there. For large investors, right, alternative investment funds are there. Everybody is okay with the model of AIF and MF? Do let me know. And using the model of MF, let me explain one more model here. Have you heard of the model? Where should I write? Okay, write it here. Have you heard of the model Infrastructure Investment Trust and Real Estate Investment Trust? INVIT and RIT. Right? You can see above my head here. INVIT and, right, let's say INVIT. Now, because I'm discussing mutual funds here, let me explain the model of RIT and INVIT here itself. Point number one, in INVIT and REIT, it is the same model. That is the investments are pooled like this. Individual investors, rather than investing individually in the market, they will pool the investments. Then what is the difference between INVIT and REIT? In real estate investment trust, the investments which are pooled are invested in the real estate assets. So, example of a real estate asset, commercial complexes, shopping complex. For example, let's say you want to invest and set up a shopping complex. And if you say, yes, sir, individually I can do, I have so much amount of money, then my dear, you do not have to become an IS officer. You're already a crorepati. Right? If you have sufficient amount of money to set up a shopping complex, then think of doing something else and not become IS officer. But a lot of you, including me, by the way, we know that we don't have sufficient amount of money. but we have dreams. Correct? We have dreams. Right? Like they say, don't dreams are those which will not allow you to sleep. We also have dreams which will not allow us to sleep. All of us want to become croropatis overnight. So one way to become is invest. But invest where? Somebody will say invest in commercial real estate. But commercial real estate will require 500 crore investment, 1000 crore investment, etc. None of us have that much amount of money. So that is the reason there is an opportunity. Again, I'm not promoting anything, by the way. Right? Based on what I'm telling, don't make an investment decision. I am not recommending any investment, let's say, decisions to you. So now what we can do is we can approach an REIT, Real Estate Investment Trust, invest. All the money will be collected, and this money will be used to construct, let's say, commercial real estate. And any revenue that is generated now will be distributed amongst the investors. Can I simply say is it is similar to mutual fund model? Do let me know. Can I simply say it is similar to mutual fund model? Only difference is in the mutual fund, the investments are done in shares, bonds. Here, the investment is done in physical assets. What if they invest in highways? Think of it. What if they invest in highways, roads, ports, etc.? Then that is called as INVIT, Infrastructure Investment Trust. Real Estate Investment Trust, Infrastructure Investment Trust. Model is same. Participants might be different. At the let's say how many stakeholders are present might be different, but the model is same. Collect, pool the investment, and invest in different infrastructure. Right? That is Infrastructure Investment Trust and Real Estate Investment Trust. Everybody is okay? Similar. The model is similar to the model of a mutual fund. Okay. Now let's go back. AIF is done. Mutual funds is done. Last concept is left out here. ETF. ETF. Right? What is ETF? Exchange Traded Fund. ETF stands for Exchange Traded Fund. What is an exchange traded fund? Listen to me very carefully. You can go to the stock market, and when I say you can go, don't literally, I'm not talking about you literally going to the stock market. Okay. So you can go to the stock market and purchase shares. You can purchase, right, let's say bonds. But please understand, there are certain instruments which are called as ETF, where rather than purchasing individual securities, they will basically offer to you, groups of securities. Is it okay? I'll repeat the statement. Rather than essentially providing you individual securities, they will take group of securities, package it as one product. They will offer you this as a, right, let's say, a product, this as an investment opportunity. Right? So individual securities, can you purchase? Yes. Can you sell? Purchase? Yes. But rather than individual, now there is a basket. There is a packet of security. And that, my dear, essentially is right, a concept of exchange traded fund, ETF. Exchange traded fund. ETFs, please understand, ETFs essentially, right? ETFs essentially will be present in the debt market. That is, bonds can be clubbed into one product and sold to you. And ETF can also be present in the stock market. That is the equity market. That is equity market. In the equity market also ETFs are present. For example, let's say 100 shares of 4 companies will be purchased, and I'll club one share. I'll take one share of company A, B, C, D each. I will package it, sell you as one ETF. Right? So if you purchase this ETF, you are essentially holding shares in A, B, and C, D. Right? So equities can be clubbed, can be sold, packaged as ETFs. Debt can be packaged as ETFs and sold in the market. Everybody is okay with this model of ETF? Please understand and do let me know. Right? ETFs are basket of securities. ETFs are, right, let's say groups of securities. You can purchase an ETF, sell an ETF. ETFs are listed in the market, just like the shares, just like the bonds. Only difference is here it is group, there it is India. Ah, there was a very interesting comment, by the way. Somebody said a detailed question, much deeper question has been asked on Innovate. Yes, I know. Question was asked on, right, taxable or not. Question was, or a statement was given like, related to taxation, related to composition, etc. My dear, if I start discussing all of that in a revision class, imagine to what extent the class will get extended. It might even go right till the end of the week only discussing all of it. That's a reason, right? Let's say the full-fledged notes are there with you. Revise it. Please do revision. I'm not saying don't do revision. I'm saying do revision. But if I discuss everything in detail in 12 hours, I'll not be able to finish the right, let's say, discussion. It will easily take around 40 to 50 hours. Okay, done. One more concept I want you people to just have a look at it. Please do not do a PhD on this particular slide. Why? There is a market called as a derivative market. I know a lot of you will be interested. Lot of you would have already invested and burnt your fingers. Lot of you would have invested, right? Earn certain amount of money and invested everything back, only to realize, right? Nothing is left out in the market. You can't answer to your parents now regarding what has happened to the investment, etc. Is it interesting? Yes, it is interesting. Should you do a PhD on this for the civil services exam? Answer is no. Just restrict your understanding to the basics. That's it. Understand, right? Restrict your understanding to the basics. Listen to me carefully. Whenever you talk about, let's say, the market, you can divide the market into cash market and the derivative market. I hope you understand. You can divide this into the cash segment and the derivative segment. What is essentially the difference? In the cash segment, let's say for example, stock market, right? You purchase the shares, you pay money, right? Let's say on the same day, or if it is a settlement after 24 hours, you essentially exchange like this. You purchase, you pay. You sell, you receive. That is essentially the cash segment. What about the derivative segment? In derivative segment, please understand, today, right? Today the agreement is done, but the actual settlement, right, that is essentially the enforcement of the agreement, will happen, let's say, after 30 days, will happen after 45 days, will happen right after certain time period. This is essentially the market which is called as a derivative market. Everybody is able to understand what is the difference between a cash segment and the derivative segment. In cash segment, settlement happens, you sell, you receive money, right? You basically purchase, you pay money. Settlement will happen, right, immediately, in the sense in 24 hours, or let's say in 48 hours. But in case of derivative market, today you have entered into a contract with me to purchase shares, but the actual selling and buying will happen after certain time period in future. That is essentially the derivative. Now I'll tell you what is a derivative. Derivative essentially means an instrument which doesn't have an independent value, which will derive the value from something else. Repeat the statement here. Please listen to me carefully. What is a derivative? Derivative, it doesn't have any kind of a value of its own. It will derive a value from some other asset. It is called as underlying asset. Sir, right, I can't understand anything. Give me an example. My dear, if I issue a piece of paper and I tell you the piece of paper will have a price equivalent to 1 gram of gold. Simple. I'm just giving you one example. I'm issuing a piece of paper to you. You're taking this piece of paper. I am telling you whatever is the market price of 1 gram of gold equivalent to the price of the piece of paper. Now you tell me Is it okay if I say the piece of paper is deriving its value from something else? Correct? All of you able to understand? Do let me know. The piece of paper doesn't have any value, but it is deriving its value from the gold. As the gold prices will keep on changing, the piece of paper's value will also keep on changing. Everybody is able to understand? So that is essentially a derivative. It is essentially a derivative. Everybody is able to understand? Okay. Now, please go, right? Let's go ahead now. Somebody is asking for break. Don't worry, I'll give break. Don't worry, I'll give you break. So, derivatives, there are four types. Please have a look at it. Derivatives, there are four types. One is called as a futures. Second one is called as options. Third one is called as forwards. And the fourth one is called as swaps. Right? One is a F and O. That is generally there in the newspaper, F and O. Third one is the forwards and swaps. The first and second are essentially present in the market. These are regulated. These are done in the stock market. Whereas the third and fourth are called as over the counter. Over the counter means, right, essentially there is no market for this. These are done individually. For example, a farmer and a company, if they enter into an agreement, that is called as a forwards contract. It is not there in the market. It is basically an agreement between two different parties, private parties. That is a forwards contract. So what is essentially the meaning of all the four instruments? Please listen to me very carefully. Do not do a PhD, just understand the meaning. Futures. And in futures, there are two parties who have come together, agreed to buy and sell certain instrument in the future. Is it okay? They have agreed to buy and sell, right, certain instruments in the future. And these instruments can be commodities. These can be, right, let's say shares. These can be currencies, etc. So on a future date, at what price the, right, let's say asset will be sold, at what price the asset will be bought, that agreement is done today itself. That is called as futures. And please understand, right, in case of futures, there is right obligation on both the parties. Obligation on both the parties to buy and sell. What about options? Look at the name. What about options? In case of option, there is always an option. That is, if you want to, right, basically enforce the contract, you can go ahead and enforce the contract. Otherwise, I hope you understand, otherwise, you can choose not to enforce the contract. That is essentially option. Everybody is able to understand? Contracts give the right but not an obligation. These are providing you the right but not an obligation. That is, you want to enforce it, you can enforce it. But please understand, there is no compulsion here. Right? So it is a choice, right? Basically, not a compulsion under the options. Right? And I know a lot of you will be thinking, then what is the difference between futures and options? Which one is better for me, etc. I will not get into all of it. Then it will become basically an investment class. It will basically become a class where I'll have to give you tips also. Which one can be more dangerous? Where you can reduce, where you can hedge the risk, where income generation can happen, etc. etc. Do not worry about all of it. Simply understand the meaning. Forwards essentially will not happen in the market. It is not there in the market. It is outside the market, hence called as a over the counter. OTC, over the counter means outside the market, where two parties essentially come into contract. Individually, they will sign the contract and they will basically enforce. That is forwards. And finally, swaps. Swaps essentially offer an advantage in the form of, let's say, today agreeing to exchange something in the future. For example, you might agree to exchange interest rates. You might agree to exchange currencies on the future date, etc. That is essentially called as swaps. Everybody is okay with the four terminologies here? Please do let me know. Do not make a mistake of doing a PhD on this. Trust me when I say this, we can discuss only this particular slide for hours together. But I don't want to do that. Why UPSC will not ask you the details? Because trust me when I say this, we can talk about, let's say, what is a future and option, F&O. Very famous segment in the market, F&O segment. What will be the premium? What is a call option? What is a put option? What is a near? What is a far? There can be n amount of discussion on these instruments. But you please do not waste your time on this. Please do not waste on all of this. Simply understand the meaning of the term. Go forward. Is it for hedging? Is it for speculation? A lot of you are asking what is the meaning of hedging. Hedging means you're trying to escape. Hedging means you're trying to escape. Right? There is a risk you're trying to escape from that. That is called as hedging. And please understand all of this is technical in nature. Hedging is different, speculation is different. Speculation is generally done in order to make profits, in order to earn income. Whereas hedging is done in order to avoid certain risk that you might be facing. Both are different, by the way. And all of these are strategies which are used in the stock market, not for you people. You want to become IS officer, just stick to that. Okay, done. So these are the four terminologies, and this is essentially end of the financial market chapter for you people. If you have any questions, raise the questions now. I'll address your questions, then we can take a break. Any questions that you people have? Options point. My dear, what is the doubt? You asked me that. What is options? Options are essentially contracts which are signed by two parties in the market. And when I say market, there is a regulator. NSE is there, BSE is there. You can't simply run away from this contract because they will ensure that these contracts are enforced. Is it okay? What are debentures? Pranjal. My dear, in case of India, debentures are generally considered as bonds only. In context of India, it is equivalent to bond only. Futures and forward, please. Again, I don't understand what is the problem here. There are two parties. You have agreed to buy or sell, let's say after 30 days. If it is done in the stock market, it becomes a future. If it is done outside the market, let's say a company and a farmer, it becomes a forward. That's it. What is the difficulty? What is the difficulty? You enter into the market and there is a there is an authority which will ensure that there is a regulation. There is enforcement. Then it becomes futures. Outside, it becomes forwards. That's it. That's the only difference. Beyond that, I can spend number of hours. I don't want to spend. That's a reason. Okay. My dear, those who are asking for SORR, did you not attend my current affairs class? I cannot discuss all the current affairs in a static portion. I hope you understand that. I can't discuss everything in under the static. Then basically the 8 hours of current affairs that I've done, I'm doing again here. What is the point? Can we say preferential share is a tier 2? No, right? It is part of the paid up capital only. Maharaja bond versus again, I don't want to enter into all of it. My question is, did you people not attend current affairs classes? What did you people learn in current affairs classes if you're asking all of it again here? I don't want to waste my time. ZC, ZP, zero coupon, zero principal. These are donations. You can purchase these instruments and listen to me. The principal amount will not be given back to you. The coupon will not be paid to you. Zero coupon, zero principal. Done. All bonds are debentures, but all debentures. Where did you get this in? Right? Let's say statement. Essentially, under bonds, there are different types. Right? There are different types. Right? Basically, they're talking about in the reverse way. That's it. Short selling, my dear, current affairs. I hope you understand this is a repetition for the static portion. I've done that. I've done all of it in the current affairs classes. I had a question on short selling also, but I don't understand what did you people do in that class then. Don't understand. What is the doubt in static portion? Raise that. It's a static portion revision. And if you're expecting me to revise the complete static portion that we discussed for 120 hours, imagine I'll have to keep on discussing for 4 to 5 days without taking any break. Okay, done. Uh, Time is 5:20. Let's take a break. So 5:20, let's restart at 5:50. Write it here. Right, let's restart at 5:50. Half an hour break. Take a half an hour break. Come back. We'll restart at 5:50. Okay. Okay, welcome back. Am I audible and visible? Please do let me know. Am I audible and visible? One person said yes, others are okay. Ready. Great then. Let's continue. So, the next chapter that I'll be discussing will be the chapter of taxation. Just to remind you what we have discussed so far, we have completed banking. Just to put the things in perspective, we have finished banking. One, we have finished international trade. IT is international trade, by the way. Don't simply say income tax, international trade. We have completed financial market, FM, financial market. We have completed, right, one more chapter, that is essentially international trade is done, financial market is done. Okay, so within international trade, we have covered exchange rate, World Trade Organization, the foreign trade policy, right, and WTO, World Trade. I'm sorry, WTO is done. Exchange rate, WTO, right. Let's say other things. So FTP, multiple things we have covered. We are supposed to start with the taxation, correct? We are supposed to start with taxation. Let's start then. Before I go forward, again, I was going through the comment section or the chat section. Many of you are asking, sir, where will I get the PPT? The PPT will be made available in this Telegram channel. Either you can use this to join the Telegram channel, or in the beginning itself, there is a QR code. Use that either ways. There is second point. Somebody basically said, sir, I checked your Telegram channel, but the notes are not there. My dear, the notes are there. I don't know which Telegram channel you have checked. The notes are there. It will be there. Okay. Now let me continue the discussion. Next chapter, taxation. Now, what are the important points in taxation? Point number one, what are the types of the taxation systems? Different types of taxation systems. One, direct and indirect. Second one is ad valorem and specific. Third one, cesses and surcharges. Fourth one, progressive, regressive, and right proportional. So direct, indirect, ad valorem, specific, cesses, surcharges, progressive, regressive, proportional. And I'm pretty sure a lot of you will be having doubt in this. So listen to me very carefully. Let's go one by one. Direct and indirect. Whenever you can transfer the burden of tax, if you can transfer the burden of tax, right? What do you mean by burden of tax? Imagine the government will impose a tax on you, but you will collect the tax from somebody else and transfer it to government, pay it to government. Whenever you can transfer the burden of taxation, these are called as indirect taxes. Is everybody okay with the model? Please do let me know. This is indirect tax. And whenever the burden of taxation cannot be transferred, that is called as a direct tax. For example, government will impose a tax, income tax. This income tax I will have to pay from the income that I have generated, from the income that I have earned. I cannot simply transfer this burden to somebody else. But on the other side, GST, goods and services tax. In case of the goods and services tax, if I'm the shopkeeper, the government will impose GST on me, but I will transfer the burden to you when you come to my shop to purchase a good or a service. If I'm a hotelier, the government will impose a tax on me, but when you come to the restaurant, when you come to the hotel to eat food, I will simply transfer the burden to you. So, whenever the burden of transfer can be transferred or the tax burden will be transferred, indirect. When you cannot transfer, that is direct. Is it okay? There is a person who says HRX spark, incidence and impact. Absolutely, absolutely right. Technical, there are two terms, incidence of tax and impact of tax. If the incidence and impact is on the same person, that is called as a direct tax. If the incidence is on somebody else, impact is on somebody else, that is a indirect tax. Okay, technical terms can also be used. Remember. Next, ad valorem and specific. What is ad valorem and specific? If a tax is imposed on the value of the product, value here, price. If the tax can be imposed on the value of the product, then this is essentially ad valorem tax. If the tax is imposed on, let's say, certain physical attributes, certain physical characteristics of the product, that is called as a specific tax. For example, if the length of the car is below 4 meters, there is a different tax applicable. If the length of the car is above 4 meters, different tax is applicable. Petrol, the government imposes a per liter tax on petrol. Per liter tax on petrol. So when you impose a tax on volume, on weight, on height, on length, etc., that is essentially called as the specific taxes. Some of you are saying buffering. My dear, it is not buffering. There is absolutely no buffering. I can see. That's the reason. I was checking the comment. And if you're wondering, sir, how do you know whether there is a buffering or not? Can everybody see this? There is a laptop in front of me. I keep on looking at the comment section or the chat section in the laptop. That's the reason. There is absolutely no buffering from my side. If there is a buffering from your side, then maybe something wrong with your internet connectivity. Nothing wrong from my side. Okay. Now let's continue. So ad valorem and specific taxes. When you impose a tax on value, ad valorem. And when you impose a tax on a physical attribute such as height, weight, length, etc., then it is essentially a specific tax. Essentially a specific tax. Be very, very careful. Do not decide the tax, whether it is ad valorem or specific, based on, let's say, a product. Do not decide it on based on the product. Decide it how the tax is imposed. I'll give you an example. Central government imposes excise duty on petrol. Correct? Those who purchase petrol, I'm pretty sure all of you, by the way. Central government imposes, let's say, the excise duty on the petrol. This is imposed per liter. Is it okay? It is imposed per liter. Per liter means what? Based on the volume of the product. You tell me now. Is it specific or ad valorem? Let me see. Is it specific or ad valorem? Can I simply say it is a specific type of a tax? Correct? Everybody is okay because it is imposed per liter. But on the other hand, let's say the state government imposes VAT on petrol. State government imposes, let's say, sales tax on the petrol. That is imposed, let's say, as a percentage of the price. As a percentage of the price. Let's say if the price of the petrol is 50 rupees, let's say 20% of the 50 rupees. 30% of 50 rupees, 40% of 50 rupees. So tax is imposed on the value of the product. That is ad valorem. Everybody is able to understand? GST. How is the GST imposed? You must have heard of this. GST will have 5%. 5% of what? GST rate of 18%. 18% of what? 18% of the price. So I hope you understand. This is essentially the difference between ad valorem and specific tax. Be careful. Next one, cesses and surcharges. Cesses and surcharges. What is essentially the model or the idea here? Cesses are imposed by the government in order to achieve a specific objective. You want to achieve an objective, and to achieve the objective, you impose a tax that is called as a cess. For example, there is education cess. There is healthcare cess. For example, there is let's say, or was earlier, Swachh Bharat cess. What is the logic here? The logic is you impose, collect this, and you will have to use it for specific purpose only, for achieving a specific objective only. For example, have a look at this. Imagine the government imposes a healthcare cess and collects it. And by the way, it is there. Healthcare and education cess of 4%. They will impose and collect it. Can they use it to construct a port? Can they use it to construct a highway? Can they use it, to, let's say, repay the loans that they have taken from a World Bank, etc.? Absolutely no. It has to be used for a specific objective, specific purpose for which the cess was introduced by the, right, let's say government. Because all of this, the government has to introduce a bill first and then make it, right, convert that into an act, then implement these particular cesses. Correct? Everybody's okay? Abhishek Raj says, Sardesh Mukhi by Marathas. So I presume that you attended yesterday Abhishek sir session. And that's the reason you're quoting me an example of Sardesh Mukhi. Okay, let's go forward. Cesses. What about surcharges? Surcharges are the taxes which are imposed by the government on taxes. Right? Whenever basically there is a, right, a threshold exemption. I'm sorry, whenever there's a crossing of threshold, the government will impose a tax and collect it from you. And that is essentially the surcharges. That is essentially the surcharges. Everybody's okay? For example, if your income crosses more than 50 lakh rupees, government will impose a surcharge. If your income crosses more than 1 crore rupees, government will impose a higher surcharge. If your income crosses more than 2 crore rupees, higher surcharge. What is the logic? Under the canon of taxation, there is a principle of taxation called as a canon of, right, let's say the capacity. Canon of capacity. And in that particular situation, the government argues if your income is higher, you have a higher capacity to pay taxes. And that's the reason I will impose more taxes whenever you cross a certain threshold and collect more taxes from you. And that, my dear, is a surcharge. Right? So remember this, cesses and surcharges. Cesses, objective. Surcharges, essentially whenever you cross a threshold. Everybody's okay? So cesses and surcharges. And next point is both the cesses and surcharges imposed and collected by the center. There is no compulsion on the center to share that with the states. There is absolutely no compulsion. Right? Because according to the provisions of the Constitution of India, whenever the government imposes and collects this, it is up to the center whether they want to share this with the states or not. And that's the reason whenever you talk about the Finance Commission, there is a concept of divisible pool of taxes. The cesses and surcharges are not part of the divisible pool of taxes. They are out of the divisible pool of. Remember this. This year, the 16th Finance Commission is being discussed. So be very careful. Next one, progressive, regressive, and proportional. And before going forward, somebody said, Sir, please rub that particular 5:50 p.m. that you had written, the time that you had written. My dear, somebody has saved it. I'm not able to erase it. I hope you understand. I'm not able to erase that particular 5:50. That's a reason it's still there. Let's see. It's not going. So don't worry. Don't worry. You ignore it. Just like you ignore all my other recommendation, you ignore that number 5:50 also. Okay, let's go forward. Next point, progressive, regressive, and proportional. Please listen to me very carefully. At progressive, regressive, and proportional. Oh, Ram Singh has come. Ram Singh, my dear, I'll address your doubts after, let's say, 1.5 hour. Keep your, right, let's say, doubts to, right, yourself until then. And when I ask you any doubts, you can raise your doubts. Okay, don't worry, I'll address your doubts. Progressive, regressive, and proportional. Let's start. Progressive means as the, right, let's say the tax base or the income goes high, the amount of taxes imposed and collected will also keep on increasing. Repeat the statement. Right. So as the tax rate, I'm sorry, as the tax base, that is the income. As your income goes up, the amount of taxes imposed and collected will also keep on increasing. Best example for progressive taxation is the income tax rates in India. Income tax rates in India, that is up to 2.5 lakh rupees, 0%. 2.5 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. And above 10 lakh, 30%. So as a result of this, whenever the income keeps on increasing, the amount of taxes collected will also keep on increasing. That is progressive taxes. Everybody is okay? So far so good? Okay, now let me do one thing. Just give me a break of 5 minutes. I'll be pausing the class for 5 minutes. Don't worry, nothing is happening. I'll restart after 5 minutes. Just give me a break of 5 minutes. Please do not go anywhere. Okay. Sorry for the interruption. Please do let me know. Am I audible and visible? Am I audible and visible? Okay, great. I'll tell you just so that there's a clarity. Some technical issue is happening. For that, there might be a break. Don't worry. I'm not going to cancel the class. Nothing is going to happen. Don't worry. Okay, let's continue. So I was discussing progressive, regressive, and proportional. What is a progressive tax? As the income goes up, the tax imposed and collected will also go up. That is essentially a progressive tax. I told you example, the income tax rates in India up to 2.5 lakh, 0%. Up to 5 lakh, 10%. Sorry, 5% now. Earlier it was 10, 5%. Up to 10 lakh, 20%. Above 10 lakh, 30%. Is everybody okay with this idea of a progressive tax? Now, regressive. All of you, please listen to me carefully. Regressive. What happens in regressive taxation? As the income goes up, the percentage of the taxes that you pay out of this will keep on going downwards. Is it okay? I'll repeat the statement here. I'll repeat the statement. As the income goes up, the percentage of the taxes that you pay to the government will keep on going downwards. That is called as a regressive taxation. Anybody has a doubt regarding the definition? I'll make you understand very quickly now. Imagine your income is 100 rupee. You purchase a product worth 10 rupee. Tax paid is, let's say, 1 rupee. Tax that you're paying is 1 rupee. Can I simply say out of your 100 rupee, the amount of taxes you're paying is 1%? Is it okay? Right? Amount of taxes that you're paying is 1%. And your income goes up from 100 rupees to, let's say, 1000 rupees. If your income goes up from 100 rupees to 1000 rupees, then when you purchase the product, even now, you will pay 1 rupee in the form of tax. Now tell me, are you paying 1% of your income in the form of tax, or are you paying 0.1% of your income in the form of tax? Don't you think it is the latter one? That is, as the income has gone up, You are not paying 1% now. You are paying 0.1%. Now, please do let me know. Everybody is okay as the income is going upwards. The amount of taxes that you're paying as a percentage of your income will keep on going downwards. That is regressive taxation. Everybody is okay. Can I go forward now? And there was one student who said, Sir, you are not answering my question. Shashikant Singh, my dear, in between, I will not address anybody's question. Hold on to your question. When I take up or when I ask you any questions, ask me, then I will address your question. Just between every now and then, you can't keep on writing question. I'll not stop the class to address your doubt. I'll have to take care of everyone here. Okay, done. Everybody's okay. So progressive, regressive. Any example of a regressive taxation? Best example in India, GST. Right? Best example for regressive taxation is the GST. Remember this. Indirect taxes are generally considered to be regressive. I'll repeat the statement. Indirect taxes are generally considered to be regressive in nature. Everybody is okay with progressive and regressive. Let me address the third one, proportional. Proportional. Remember this. Whatever be your income, whatever be your income, out of your income, the percentage, the amount of income that you pay in the form of tax will remain fixed. I will repeat the statement. Whatever be your income, out of the income, the percentage tax that you pay to the government will always remain fixed. That is called as a proportional taxation. Any example of it? For example, corporate taxes. For example, corporate tax. What is a corporate tax in India? The base rate is 22%. Correct? The base rate is 22%. Now, if your income is 100 crore, how much will be your tax? 22 crore. Can I say 22%? If your income is 200 crore, how much will be your tax? 22%. If your income is 300 crore, how much is your tax? 22%. Everybody is able to understand now? Do let me know right now. Progressive, regressive, and proportional. In proportional, whatever be your income, fixed percentage will go to the government. Fixed percentage. And I'm happy. Some of you are saying it is not 22, it is 25. I'm happy. You people are listening very well to the class. Effective corporate tax rate in India is 25%. Absolutely correct. Why 22% is the base rate? You add cesses and surcharges, it will become 25.17%. You're absolutely correct. So everybody is okay with progressive, regressive, and corporate taxation. Example of progressive, income taxes. Example of regressive, right, indirect taxes. And example of proportional is corporate taxes. Right, HRX Park is asking how indirect taxes are regressive. My dear, GST is direct or indirect? You tell me. GST is direct or indirect? GST is indirect. And if your income is 100 rupees, you pay 1 rupee GST. If your income goes up to 1000, you will still pay 1 rupee GST. Is it not? Right? Let's say a regressive taxation. Yes. Let me enter into direct taxes one by one. Listen to me very carefully. First one is right, income taxes. First one is income tax. Income tax as in Income Tax Act of 1961. Please remember this. It was there in the discussion. It was there in the current affairs. Questions can be asked on this. Be very careful. Income Tax Act of 1961. When you say Income Tax Act, remember, income tax is not just applicable to individuals such as you and me. We are covered under this. We are covered under Income Tax Act. But in addition to us, companies are also covered. What is the income for a company? Think of this. What is the income for a company? Income for a company is essentially profits. Right, so all these entities which are generating profits, that could be companies, that could be right individuals, etc. All of these are covered under the Income Tax Act of 1960. So corporate tax rate under this earlier was 30%. Now it has been reduced to 22%. effective corporate tax rate is 22%. And for individuals, there are two tax slabs. You please do not focus on the rates. Two different slabs are there. Don't waste your time in all of it. Okay. Now, in addition to the income taxes, there is also one more type of a tax called as a MAT. MAT, right? Aman Pandey says in India-Pakistan ceasefire announced. Yes, ceasefire has been announced. With that, I do not think there will be any postponement of UPSC examination. I hope you understand. A lot of you are asking me, some of you had mailed me, some of you had messaged me, some of you are asking in the beginning of the session also, sir, will there be any postponement of the UPSC prelims examination? With this announcement, I don't think so there will be any postponement. I don't think so that is going to happen. Because if there is a ceasefire, why will there be a postponement of the exam? So now those who are basically hoping, praying for the postponement had stopped watching the video, etc. Now everybody will come back. Everybody will be concerned. Everybody or those people will start asking, right, sir, what have you covered? What is right tier 1 capital? What is tier 2 capital? Explain to me now. You people be focused. Let's continue. Okay. Matt, minimum alternate tax. What is the idea of a minimum alternate tax? Listen to me carefully. There were certain companies which were referred to as a zero tax companies. Okay, there were certain companies which were referred to as zero tax companies. What is the essential idea of a zero tax company? These were certain companies which were generating profits but were not paying taxes to the government. And I know some of you will basically raise a question, how is that possible that they are earning money but they are not paying taxes? Reason behind that is, under the provisions of the law, there are multiple deductions, exemptions allowed. Multiple deductions and exemptions were allowed. They would take all of this, reduce the taxable income to 0 rupees. And with reduction of the taxable income to 0 rupees, they will end up paying taxes of 0 rupees to Government of India. These were essentially called as zero tax companies. The Government of India, in order to target these kind of practices, to ensure that the companies will not avoid paying the taxes, introduced right a piece of reform which is by the name of minimum alternate tax. Earlier, this was called as a minimum corporate tax. Now, post 1996-97, this has been renamed as minimum alternate tax. What is the basic idea of a minimum alternate tax? The government using a formula will calculate certain amount of a tax. Listen to me carefully. Will calculate certain amount of a tax. How it is calculated, I'll just give you a calculation. Don't waste your time on this. Just to give you an idea. There is a profit called as a book profit. And there is also a profit called as taxable profit. And before you start typing, sir, what is the difference? Right? Tell me the difference. Book profit is derived by basically subtracting your expenditure from the income. Is everybody okay? Just subtract the expenditure from the income, that is called as a book profit. From the book profit, you will make adjustments. What kind of adjustments? Let's say tax exemption is there, tax deductions are provided. You will make adjustment from the book profit, you will arrive at taxable profit. The government usually calculates corporate taxes on the taxable profit. And if you have made huge number or claims of adjustment, taxable profit might become zero. You will pay 0 rupee taxes to government. The Government of India now said, under the minimum alternate tax, I will calculate, let's say, 30% of taxable profit, and I will calculate 15% of book profit. Is everybody okay with the statement? I'll repeat this again. The Government of India under MAT said they will calculate 30% of taxable profit, or right 15% of book profit. Whichever is greater, you will have to pay that as a form of a tax to government. This is essentially the concept of a minimum alternate tax. Everybody's okay? So applied on companies. Earlier, the minimum the minimum alternate tax was 18%. Now it has been reduced to 15%. Now the MAT has been reduced to 15%. Okay. Next one, capital gains tax. Capital gains tax. What is this concept of a capital gains tax? You purchase an asset, you hold on to the asset for a specific time period, and you sell the asset. What kind of asset? Let's say shares, that is also an asset. Bonds, that is also an asset. Land, house, right? All these are assets. So you purchase an asset to sell the asset in the market. Now imagine you purchased it at 1 crore rupees and you sold it at 2 crore rupees. In layman terms, in common man terms, we simply say you made a profit of 1 CR. Then in layman terms, we say you have right made a profit of 1 CR. But the government simply uses the term capital gains. They say this is a capital gain, not right a profit, it's a capital gain. But please understand, whenever you have purchased an asset at 1 CR, sold the asset at 2 CR, two important points here. Question is, how much taxes will you pay and on what amount you will pay? Let me start with the answer to the second question. On what amount you will pay the taxes? It will not be exactly 1 CR, it will be less than 1 CR. Why less than 1 CR? Can I simply say, if you purchase the asset in 2020, sell the asset in 2025, the purchasing power of rupee would be changed between 20 and 25. Correct? Purchasing power of rupee would be different. The value of the asset would be different. And that is the reason, please understand, there is a concept called as indexation. It was there in the last year's budget. Please make a note of this. When I say note, make a mental note of it. There is a process allowed which is called as indexation. Right? There is an index that is used which is called as a cost of inflation index. And this is published by the Central Board of Direct Taxes, CBDT. Central Board of Direct Taxes announces this indexation number. You'll be allowed to use the number, adjust the price of the asset. Let's say after the adjustment, it will become 1.3 CR. Now you will calculate it. 2 CR is today's price. 1.3 CR is the adjusted price. Instead of 1 CR, now the tax would be applicable on 70 lakh rupees. This is essentially the concept of indexation, concept of, right, let's say the capital gains. Now, first question was, on what basis the tax rate would be decided? Listen to me carefully. There are two types of taxes further under the concept of a capital gain: short term and long term. Now, how do I define what is a short term? How do I define what is a long term? There is no unified formula which is followed in India. Earlier, we had a uniform formula. What was the uniform formula earlier? If you purchase the asset, if you hold, they will use the term holding period. What do you mean by holding period? What is the period of ownership? What was the time period of ownership? When the concept of capital gains tax was introduced, the holding period was 3 years. It was uniformly 3 years. But over a period of time, we have changed it. For asset that is a land, it is different. For house, it is different. For shares, it is different. For bonds, it is a different. So that's a reason. Do not complicate it by memorizing the complete list. Waste of your time. Simply remember, based on the holding period, the capital gains would be divided into two parts: short-term capital gains tax and a long-term capital gains. That's it. Based on the holding period, you will divide that into short-term and long-term. And so that is essentially the discussion associated with capital gains tax. Let me go forward now. Concept of GAR. Concept of GAR. What is GAR? GAR stands for General Anti-Avoidance Rules. General Anti-Avoidance Rules. Right? This is point number one, GAR. What is the GAR? GAR essentially represents a framework. It represents a set of rules which are used by the tax officials to find out whether the company has avoided taxes. I'll repeat the statement here. GAR is a framework. It is a set of rules which are used by the tax officials to find out whether the company has avoided taxes. How have they avoided taxes? There's a technical term here. Please remember this. That is impermissible avoidance arrangement. Remember the term IAA, impermissible avoidance arrangement. Right? For example, right, listen to me very carefully now. For example, let's say I have a manufacturing unit in India. I will manufacture this product. I will sell this to one more product which is present within the special economic zone. All of you heard of special economic zone? Right? So I will sell this particular product to one more company which is present in the special economic zone. And this company is owned by me only. This is also owned by me. This is also owned by me. I'll call this as company A and company B. Now, this company B will export the product to a foreign market, generate profits. Now, tell me, can I simply say the main reason why both the companies are owned by me and why company A is selling why the company A is selling the product to company B is to essentially avoid taxes? Yes or no? It is essentially to avoid taxes. Sir, how? My dear, if you are present in the special economic zone for 5 years, you'll enjoy 100% tax exemption. Very simple. You'll enjoy 100% tax exemption when you're present in the special economic zone. I can directly export the product. Understand the logic here. I can directly export the product. But whatever profits I generate through the company A, I will have to pay 30% of that in the form of taxes to government. But by basically selling the product to one more company which is present in the SEZ, I'm generating certain profits in the SEZ. And when I generate profits in the SEZ, for 5 years, I will enjoy 100% tax exemption on these profits. Now tell me, is it not an arrangement between A and B which is tax avoidance? Think of it and do let me know. Is it not an arrangement between A and B to avoid taxes here? Of course, yes. These are called as impermissible avoidance arrangement. IAA. Impermissible avoidance arrangements. And as a tax official, you will look at it and you will say, sir, you are owning company A. You are only owning company B. Any particular commercial reason why A is selling to B? There is no commercial reason. The reason is to basically avoid the taxes. Now, what you will do is, because this is an IAA, you will basically impose the tax on the company B's profits and collect taxes on the B's profits as well. Whatever tax exemptions were given to company B, they will be denied, and company B, as usual, like any other company, will have to pay taxes to the government. This is essentially the concept of GAR. Everybody is okay? Everybody is okay with the concept of GAR here? So remember, it is a set of rules or framework which will identify tax avoidance. The tax officials will be using this to identify impermissible avoidance arrangements. And remember the name of the committee which recommended the implementation of this is Parthasarathi Shome Committee. Parthasarathi Shome Committee. Parthasarathi Shome Committee has recommended this, and from 2017, this has come into implementation. It has come into implementation. And suddenly UPSC might ask you, has it been implemented prospectively or retrospectively? Is it being implemented prospectively or retrospectively? It has been implemented prospectively. Right? What do you mean by prospectively here? After the law came into force, after the law was implemented, the transactions would be evaluated. Right? After the implementation, the transactions will be evaluated. And what kind of transactions have been covered under this? The threshold is 3 crore rupees. The threshold of the transaction is 3 crore rupees. That is, the transaction below 3 crore will not be covered. Above 3 crore will be covered under GAR. These are important points associated with the concept of GAR. Be very, very careful. Now, let me enter into indirect taxes. Direct taxes are done. Let me enter into indirect taxes. What are the important points? The most important type of indirect tax in India is GST. It is GST. But before the implementation of GST, please listen to me carefully. There was a law, or there was right, a type of a taxation. The central government would impose a tax on production. Center would impose tax on production, and they would simply call this as excise duty. Excise duty. And the state governments would impose a tax on the sales of the product, on the sale of the product, and that was essentially called as sales tax, right? Sales tax. So excise duty, sales tax. Right? There was an impact of both of these taxes, which was called as a cascading effect. Cascading effect. What do you mean by cascading effect? The taxes are being imposed on existing tax. Simple. The taxes are imposed on existing taxes. That is essentially the concept of a cascading effect. And whenever there is a cascading effect, the market price of the product will keep on increasing. The burden of taxation on the consumer will also keep on increasing. And that is the reason what the government did was, rather than having these kind of taxes, government proposed a tax by the name of VAT. The state governments came together, introduced the model of a VAT. What was the model of a VAT? Value added taxation. Under the model of VAT, essentially whatever taxes you pay in the previous step, I'll repeat the statement. Whatever taxes you pay in the previous step would be refunded to you, would be credited to you when you sell the product in the next step. Is the point clear to all of you? I'll repeat it again. Imagine I will purchase a product. I want to sell it further in the market. When I purchase a product, I'll pay taxes. When I sell the product further down the line, whatever tax I paid in the previous step would be given back to me, credited back to me. This model is called as input tax credit, ITC, input tax credit. Right? So ITC regime was essentially introduced the model of VAT system itself. But even after that, VAT system, under that, there was a cascading effect. Even after this also, there was a cascading effect. How so? Imagine this. I will purchase a product. I am in the state 1. Okay, I'm in the state 1. I'll purchase a product. I will move the product across the state. I will move the product across the state and I want to sell it in the second state. Here, whenever you move the product across the state, earlier there was a tax called as CST, Central Sales Tax. This CST was announced by the central government but was collected and utilized by the state government where production actually happened, where the good was produced, which essentially meant the CST would be collected by the state 1. Now I want to sell it in the second state. I will collect the CST. The person in the second state wants to further sell it to somebody else, let's say third person in the same state. Now this person who is in the second state, they will not get ITC. All of you able to understand? Imagine A is selling it to B is selling it to C. B is registered in the second state, but the CST has been collected by the first state. So, because B is from a different state, they will not get the input tax credit. They will transfer the taxes to the consumer, and that will essentially lead to the cascading effect. And that is the precise reason, mind you, the government of India wanted to address all of this and promoted and implemented a model called as GST, Goods and Services Taxation. So far, so good. The government of India introduced the goods and services taxation. Now, what are the special points or the specialities about the GST? Point number one, under GST, we follow, right, a model wherein at every step, there is an input tax credit. At every step, there is an input tax credit. Meaning what? Whatever the taxes that I've paid in the previous step, they will be credited back to me when I sell the product. At every step, there will be an input tax credit. So, Government of India simply says there will be no cascading effect under the model of GST. Second one, rather than having multiple indirect taxes in India, all these indirect taxes will be brought under only one tax, GST. All of them essentially will be brought under only one tax, that is GST. Second point. Point number three, India will follow a model called as a dual GST structure. They will follow a model called as a dual GST structure. What do you mean by dual GST? The GST will be having two components. One will be going to the central government, and second component will go to the state where the good has been consumed. Is it okay? Where the good has been consumed. Remember that. Right? So the GST will have two components, CGST and SGST. This anyways will go to the center. This will go to the state where the good is consumed. And that's the reason GST is also referred to as a destination based tax. It is also referred to as a destination based tax. Okay? Right? So, dual GST model has been implemented. Now, there is also a constitutional authority under GST. Constitutional authority. That is essentially GST Council. It has been set up under Article 279A. The GST Council will be headed by the Finance Minister. And have a look at this. There is also a proposal or a provision under the GST for having a vice chairperson. Right? There is also a provision to have vice chairperson. But right now, we do not have any kind of a vice chairperson. There is no vice chairperson as of now. Only chairperson is there, and that is a finance minister. Representation will be there from all the states, union territories, right? With council, with let's say the legislative assemblies. UTs with legislative assemblies will also have representation in the GST. What is the requirement of a quorum for this? 50%. 50%, right, is the requirement of a quorum. Voting, remember, the voting right is divided between the center as well as the state. One third of the voting right has been given to the center. Two thirds equally divided between the states and the union territories. And any decision that needs to be undertaken by the GST Council, you require at least 75% of present and voting votes. At least 75% of P and V. Done? So far, so good. GST Council. These are important points. Please make a note of this. Now, whenever you talk about GST, the product can be produced and consumed within the same state. In that case, GST is applicable. If the product is manufactured in one state, moves across the border, consumed or sold in the next state or in the third state, fourth state, in such cases, IGST is applicable. IGST is applicable, integrated GST. Integrated GST represents there is intrastate trade and commerce. Simply remember this, right? There is, interstate trade and commerce. Food is produced in one state, consumed in some other state. And why is this relevant? Because the GST is a destination based tax. GST is a destination. So you will have to understand whenever it is IGST, the GST component, that is SGST component, is going to some other state which is not a producing state here. It is being accumulated to some other state. Okay. So cascading effect, we want to eliminate that. National market, we want to create that. What is a national market? National market essentially means the good can be sold in any part of India. GST rate applicable is one and the same. GST rate applicable is only one and the same. That is the national market. What are the slabs? The most important slabs are 0, 5, 12, 18, and 28%. 0, 5, 12, 18, and 28%. Okay. Earlier, there was a concept of compensation. Now, there is absolutely no compensation. Compensation has been stopped after June 2020, right? 2. After June 2022, there is absolutely no GST compensation paid by the center to the states. Why? It was supposed to be given only for 5 years. GST came into force from the 1st July 2017. 1st July 2017, add 5 years, you will essentially reach June 2022. After that, absolutely no. Okay. GST network, it is 50% owned by the government and 50% by the states. Essentially, the importance of the GST network is it is an authority which is owned by the center and state to provide supporting services for the implementation of GST. For example, registration of the taxpayers. For example, right, let's say collection of all the documents of the taxpayer. Right, for example, processing the right refunds to the taxpayers, etc. It will provide the backend support, backend infrastructure for the implementation. Okay, and the last point is associated with National Anti-Profiteering Authority. Please remember, National Anti-Profiteering Authority earlier was set up by the government. It has been closed now. It was to address the issue of profiteering by the companies. What has happened is now the profiteering cases or anti-profiteering cases, all of them will be transferred to the GST Appellate Tribunal. GST 80. GST Appellate Tribunal. Earlier, it was handled by the, let's say, the NAA. Then it was transferred to CCI. Some of you are saying CCI. My dear CCI, yes, it was transferred. Now, starting 1st April 2025, all of these will be handled by the GST Appellate Tribunal. This I've discussed even in the current affairs class. This I made a discussion on this in the current affairs class as well. It will be handled by GST Appellate Tribunal now. Okay. Right, so these are certain important points associated with the goods and services tax. Questions have been asked in the past regarding GST. Be very careful. Next one, concept of Laffer curve. Idea of a Laffer curve. What do you mean by Laffer curve? Listen to me very carefully. Laffer curve basically provides a connection between the tax rate and the amount of taxes collected by the government. I'll repeat the statement. The Laffer curve provides a connection between the amount of taxes collected by the government and the tax rate. That is essentially the Laffer curve is represented in the form of a inverted U curve like this. Is it okay? Inverted U curve. Right? What is this inverted U? Instead of writing upright U, alphabet U, now it is a inverted U. Along the x-axis, you will represent the tax rate, and along y-axis, you will represent amount of taxes collected. Amount of tax revenue or taxes collected. Now, what is the connection here? Point number one, listen to me carefully. This is a policy, or this is basically a theory which was recommended by an economist in USA by the name of Arthur Laffer. Arthur Laffer. And what is the context of this, right? Let's say the Laffer curve. Generally, when the governments want to reduce the tax rate, they will quote Laffer curve. I'll give you an example. When the government of India reduced the corporate tax rate from 30% to 22% earlier, they quoted Laffer curve. They simply said, right, look at the Laffer curve. If the tax rate is reduced, amount of taxes collected will become more efficient. We will be able to collect more and more taxes. How so? Let me explain this. Please listen to me very carefully. If the tax rate is 0%, how much will be the taxes collected? 0 rupees. Because you are at origin. Correct? I'm talking about x-axis and y-axis. If the tax rate is 0%, you are at origin. How much will be the taxes collected? 0 rupees. If the tax rate is increased to, let's say, 10%, now you will realize that the amount of taxes collected has increased. If the tax rate is further increased to, let's say, 18%, you will realize that amount of taxes collected has further gone up. So as you keep on increasing the tax rate, there will be a particular point. You will reach a particular tax rate wherein or at which point amount of taxes that you collect will be the highest. Is the point clear? And I'm not writing any number here. Please don't ask me, sir, what is this particular point? Is it 50%? Is it 42%? Is it a 58%? Right? How much? There is absolutely no formula to calculate this. There is absolutely no formula. Right? What he basically stated was there will be a point at one rate your amount of taxes collected will be higher. And how do you understand that? If you further increase the tax rate, you expect the tax collection to increase. Rather, the tax collection will decrease. So the previous rate was the optimal tax rate. Is it okay? The previous one was the optimal tax rate at which the amount of taxes collected will be highest. So argument was, right, this is the optimal tax rate. You keep at this level, your taxes collection will be highest. If you further increase it, you keep on increasing it with the objective of collecting more taxes, you will not collect more taxes. You will collect lesser and lesser tax. This is essentially the concept of a Laffer. This is essentially the concept of a Laffer curve. Is it applicable in all the cases? No. Does it have loopholes? Yes. Lot of loopholes. Argument is when you collect the taxes, when the government imposes taxes, tax rate is not the only factor which will influence the amount of tax receipts collected by the government. I'll repeat the statement. It is not just the tax rate that will influence how much taxes will be collected by the government. There are so many other features. So I hope you understand this. I hope you understand this. There was a loophole or there is a loophole. But essentially, these kind of arguments are used by the governments whenever they will reduce the tax rate. They'll simply say, right, look at the Laffer curve. Because I've reduced the tax rate, I will collect more and more taxes. And before I go forward, somebody is going as expected. Right? Ram Singh is asking this question. Why the taxes will become lower? My dear, if the tax rate is 100%, you tell me. If the tax rate is 100%, why will you work? If the tax rate is 90%, why will you work? Your argument will be, most of my income I'm paying to government. What is the point of earning then? Right? The workers will start replacing work with leisure. They will start working less and taking more rest. And that is a precise reason, right? Essentially, with the higher tax rate, beyond the optimal tax rate, the amount of taxes collected by the government will not increase, will keep on decreasing. And everybody is okay with the concept of Laffer curve here? Everybody is okay? Right? So these are certain things I wanted to discuss in the context of taxation. Now, before I go forward, before I go forward, certain more important points in the context of taxation. One is, right, essentially the word tax expenditure. Remember this. One is the word tax expenditure. What do you mean by the term tax expenditure? A lot of you will basically say, so tax expenditure means expenditure incurred by the government to collect taxes. No. Tax expenditure basically refers to amount of tax money that is sacrificed by the government. or the tax revenue that is foregone, that is foregone by the government. How so? Government will provide lot of tax rebate, government will provide lot of tax exemptions, etc. And when government will provide you all of this, government should have collected this, but because of these exemptions they will not be able to collect it. That's the reason the amount of tax revenue that is sacrificed, that is foregone, is called as a tax expenditure. Everybody is okay with this? Next one, tax to GDP ratio. Tax to GDP ratio. Okay, what is the concept of a tax to GDP ratio? Tax to GDP ratio essentially represents the ratio of total amount of taxes collected divided by total value of GDP. Amount of taxes you are collecting divided by the GDP of the country. That will be basically providing you the tax to GDP ratio. And what is the need to calculate it? If the tax to GDP ratio is very less, it simply means government is not able to collect a sufficient amount of money. I hope you understand. Government can collect money by selling assets. Government can collect money by borrowing from the market. Government can also collect money by collecting taxes. Which of the three is much better for the government? Think of it. Which of the three options, selling companies, taxation, or borrowing, which of the three options are the best for the government? Taxation. Because there is no liability on the shoulders of the government. I hope you understand. There is no liability on the shoulders. If you sell asset, your assets will go down. If you borrow, there is a liability. But taxation, there is no liability. It is basically one-sided transfer done by the taxpayer to the government. And there are no conditions also. Government can use the tax money to construct a road. Government can use this, right? Let's say to construct an airport. Government can use this to launch a welfare scheme. That is the decision of the government. So I hope you understand. A lower tax to GDP ratio puts a higher burden on the government to borrow more. Simple. A lower tax to GDP ratio will put more burden on the government because the government anyways will have expenditures. If they are not able to collect money sufficiently in the form of taxation, government will be forced to borrow more and more from the market. That is tax to GDP ratio. Third one, tax buoyancy. Third one, tax buoyancy. What is the meaning of a tax buoyancy? Please understand this. In tax buoyancy, we basically measure what is the change in the taxes collected divided by change in the GDP. Is it okay? I'll write change here. Change in the taxes collected divided by change in GDP. That is, let's say from last year to this year. By how much percentage the taxes collection has changed? Divided by how much percentage GDP has changed. That is essentially the tax buoyancy. And please remember this, compared to last year, this year, would you want to collect more and more amount of taxes? Would you want a higher rate or higher growth in the collection of taxes? Answer is yes, by the way. That's the reason we always prefer to have a higher tax buoyancy. That okay? That's the reason we always prefer to have a higher tax buoyancy. For example, very often in the newspaper, you'll come across this. The direct taxes, the tax buoyancy is 1.2. What does it mean? From last year to this year, the GDP, if it has increased by 1%, the taxes collected have increased by 1.5%. That is the meaning, right? So, tax buoyancy, you require a higher tax buoyancy, which will basically mean from last year to this year, you're collecting more and more amount of taxes. Everybody is okay, right? Everybody is okay so far. And finally, the tax elasticity. Tax elasticity, right? What do you mean by tax elasticity here? What is the change in the taxes that you're collecting with the change in the tax rates? Understand this very carefully. What is the change in the taxes that you're collecting with the change in the tax rate? That is called as a tax elasticity. And understand where you can apply all of this, or where should I apply all of it? Let me ask you a very simple question. Between two types of goods, for example, those goods which are habit forming, or let's say those goods which are essential in nature, or those goods which are luxury in nature, don't you think tax elasticity will be much better in case of the first set of goods? Even when you change the taxes, you'll be able to collect more and more taxes because, right, these are essential commodities. These are habit forming goods, etc. Correct? All of you able to understand this? I'm not talking about Veblen goods. Veblen goods are high-end luxury products. Again, please listen to me carefully. I'm not talking about Veblen goods. Right? You are making a mistake here. Veblen goods are high-end luxury products. High-end luxury products, not just luxury. High-end luxury product. Done. I'm simply talking about a luxury good as well as a right essential good. So if it is a habit forming good, if it is an essential good, the government will impose a higher tax rate. Government will increase the tax rate. Will the people stop consuming it? Let's say, for example, petrol. If government will impose a higher tax, will you stop consuming it? No. It is essentially a type of good that will keep on consuming only. What about tobacco products? Saturday evening. What about alcoholic products? I hope you understand the demand is inelastic there. The demand for these kind of goods is inelastic. So government will be having a higher elasticity because basically the amount of taxes that they will collect will be much. Done? Everybody is okay? Again, I'll repeat this. Those who are listening, please listen to me very carefully. Listen carefully. You people are not listening. What is the percentage change in the tax? As a result of this, what is the percentage change in the taxes collected? That is called as tax elasticity. Okay, done. So we are done with the taxation chapter now. Everybody is okay? Please do let me know. We are done with taxation chapter. Can I go forward now? Can we move forward? Great. Those who are present, at least two people answer. Those who have questions, hold on to your questions. I'll take up your questions after some time, not now. Okay. Next one, agriculture sector. Next chapter, I will be discussing important part of the chapter. I'm sorry, important topic, that is agriculture sector. Let's go one by one. The first area I want to discuss in the context of agriculture sector is MSP. Right? MSP, current affairs, static portion. You can put it anywhere you want to. It is MSP. Point number one. Listen to me carefully. MSP, minimum support price, was announced mid 1960s in India. 1966. Okay. Initially, the MSP was announced for a period of, for one product, wheat. Later, it was expanded. It was expanded to cover multiple commodities. The CACP website, CACP stands for Commission for Agriculture Cost and Prices. The CACP website says it is announced for 23 crops. It is announced for 23 crops. But please understand, out of 23 crops, one of the crop is sugarcane. One of the crop is a sugarcane. So for sugarcane, the term used is not MSP, rather it is FRP. Fair and remunerative price. It is not MSP, but FRP. Okay, done. So point number one, it was announced in the beginning of 1960, right? Only for one crop. Later, we have expanded this to cover multiple crops. Today, we cover more than 20 crops. Okay. Point number two. The announcement of MSP, the process followed is very simple. Right? Like I said, there is an entity, there is an authority which functions under the Ministry of Agriculture, Commission for Agriculture Cost and Price. The CACP will do the calculation and give the recommendation to Cabinet Committee on Economic Affairs. What are the parameters which are considered by CSEP? They will consider what is going to be the demand, what is going to be the supply of this particular crop, what is the cost of the inputs that are consumed, right? What will be the supply of this crop compared to other crops in the market, not just in India, but also in the international market. They will consider additional 50% income for the farmer also. So, multiple factors are taken into consideration and they will give the recommendation to the Cabinet Committee on Economic Affairs, the CCEA. Now, the Cabinet Committee on Economic Affairs will announce the MSP. Right now, the MSP that is announced, please remember this, MSP that is announced is 150% of cost of production. 150% of cost of production. And when you say cost of production, the government uses, right? The government uses simply the A2 plus FL cost of production. Right? 150% of A2 plus FL cost of production. So far, so good. Next one. When is the MSP announced? When do we announce the MSP? Just before the sowing season starts. Just before the sowing season will start. Just before the onset of the Rabi season or Kharif, etc., the government will just before the sowing season begins, government will announce MSP for the crops. What is the objective? Government wants the farmers to take a call based on the relevant information. The farmers should know which crop will fetch them how much MSP. Right? That is the reason just before the onset of the sowing season, the Cabinet Committee on Economic Affairs announces, decides, and announces the MSP. So far, so good. Next point, I expect this to be checked in the preliminary examination. I expect the question to be asked on this. Is there MSP which is legally backed in India? Is there any law guaranteeing MSP to the farmers? Is there any provision guaranteeing MSP to the farmers? Right now, absolutely no. Absolutely no. There is no law in India which provides, right, let's say the MSP to the farmers. Absolutely no law. And that has been one of the demands of the farmers. The farmers have been demanding, we want MSP because there is no legal backing. The government at any point of time can announce, right, withdrawal of MSP at any point of time because it is done under the executive authority. Is it okay? Right. So these are certain important points associated with the concept of MSP. But before I go forward, couple of more points. The center announces MSP, the state announces bonus. Remember this. The center announces MSP, the state announces bonus. The bonus is announced by the state governments, MSP is announced by the central government. And remember one more point here. The market price could be anything. The market price could be above MSP, much below MSP, much higher than MSP. Doesn't matter. If the government of India has announced MSP, then whenever the government will purchase this crop, government of India has to pay this price itself. Is it okay? The government of India, whenever they announce MSP, whatever could be the market price, it could be higher or below the MSP. The government, whenever they procure through the agencies, they will have to pay the MSP itself. They cannot simply adjust the MSP and say, the market price is lesser, I will pay lower MSP. Not at all allowed. They will have to pay MSP. Okay, so these are certain important points associated with the model of minimum support price. Right, so these are certain important points in the context of preliminary examination. Let me go forward now. Public distribution system. PDS, public distribution system. This idea of a public distribution system. The government of India, even before the independence, mind you, even before the independence, had the model of, right, the public distribution system, where a lot of these particular crops as well as many other things were given to common man. And initially, when it was introduced during the Second World War. And the model was essentially to provide welfare to the people. We had a universal coverage. Universal coverage essentially means all the people can get access to these commodities which are distributed right through the fair price shops, that is under the public distribution system. But over a period of time, the government of India realized, over a period of time, the government of India has realized that we cannot continue to provide universal coverage. And that is the reason, from the concept of universal coverage, we have shifted to targeted coverage. Right now, the PDS that we are following is essentially called as targeted PDS. Remember this, right? It is called as a targeted PDS. Right? What do you mean by targeted PDS? Can I go to a ration shop, get food grains from the ration shop? Government will not allow that. Can I go to, right, let's say fair price shop, try to purchase 5 kgs of food grains? Government will not allow that. Why? Government of India simply says, now, if you are part of the BPL population and you're part of, let's say, above poverty line population, but you're identified as a beneficiary. If you're identified as a beneficiary, even though you're part of APL, if you're identified as a beneficiary, a ration card has been issued to you by the government. Such cases only you will be able to get access to food grains from the ration shop or fair price shops. Is the point clear to everyone? Is the point clear? So right now, the model that we are following is not a universal. It is not a universal coverage. It is a targeted public distribution system. My dear Ram Singh, it, all of these we have discussed earlier, right? What is a bonus? What is FRP? All of these things we have discussed. Have you forgotten all of it? And you can check my videos earlier also. We have discussed all of this. It is just a revision of whatever we have discussed. Okay. Now, before I go forward, there is somebody who says, sir, but in some states they follow universal public distribution system. Yes, the states can do that. The states can do that. For example, central government announces, let's say, 5 kgs of free food grains. But you must have seen certain states, they will not give 5, they will give you 8 kgs. Correct? In certain states, they will give you 10 kgs of free food grains. That's allowed. Why? Center will basically bear the burden of only 5 kgs. That's it. Center will bear the burden of only 5 kgs and only for the people who are supposed to be covered under, right, let's say, targeted public distribution system. If the state government wants to give it to everybody in the state, let them do that. But the financial burden will fall on the state government. Simple. Okay, the financial burden will simply fall on the state government. Because listen to me carefully, there is a point food security here. There is a law in India, National Food Security Act of 2013. Under National Food Security Act of 2013, we are supposed to provide the food security to totally two-thirds of India's population. Totally two-thirds of India's population. That will essentially translate to around 81 crore people. And two-thirds of which population? 2011 population. Okay, two-thirds of 2011 population, which translates to around 81.3 crore people. Now, Government of India has allocated a quota for all the states. Quota means a certain number. Karnataka will get so many people, that is beneficiaries, right? Let's say state of Punjab will get so many beneficiaries. Again, based on what? Based on census data. The state of UP will get so many beneficiaries. Quota has been allocated. And please understand, let's say for state 1, the allocation of beneficiaries is 3 crore. Now listen to me carefully. Center has decided the quota. But who will decide who will be these 3 crore people? Right? Who will decide who will be the 3 crore beneficiaries? It is done by the state government. It is done by the state government. So the quota is decided by the center. Identification of the beneficiaries is done by the state government. And the formula, or let's say parameters which are used by one state, will vary from another state. Right? Some states which are hilly states will have different parameters. Some states which are very well developed states will have different parameters. So essentially, the states will identify the beneficiary. Now listen to me. The center will basically bear the burden of subsidizing the food grains only for 3 crore people, only for 5 kgs. If you are a priority household, and there are two types of beneficiaries here. If you're a priority household, per person 5 kgs of food grain. If you are Antyodaya household, if you are a Antyodaya household, it will be 35 kgs per household. The center will basically bear the burden only for these numbers. That's it. Only for these numbers. Can the state government provide, right? Let's say instead of 5 kgs, 8 kgs. Let them do that. Let them provide 10 kgs. Center will not be bearing the burden of additional 5. It has to be borne by the respective state government. Can the state government expand the coverage rather than 3 crore people? Can they provide this benefit to, let's say, 8 crore people? Let them do it. But who will bear the burden of the additional 5 crore food grain worth of subsidy? Respective state government, not the central government. Then every should be clear regarding this kind of a implementation of a policy. Okay, done. So NFSA 2013 free food grains has been announced. This policy has been announced by the government. Now we are providing 5 kgs, or let's say 35 kgs if you're Antyodaya card holder till 2028. It was implemented during the period of pandemic. That is a Pradhan Mantri Garib Kalyan Anna Yojana. It was extended. Now government of India realized after pandemic, we have NFSA, we have Pradhan Mantri Garib Kalyan Anna Yojana as well. So double benefits which we are providing. Why double benefits? Bring PMGKAY coverage under NFSA. Right? But rather than charging, I repeat, rather than charging under NFSA, provide the food grains free of cost. Because listen to me carefully. Under Pradhan Mantri Garib Kalyan Anna Yojana, anyways the food grains were given free of cost, 5 kgs. But under NFSA, there was a issue price. There was a concept of issue price. What is the issue price? In case of NFSA, for rice, the government used to charge 3 rupees per kg. For wheat, the issue price was 2 rupees per kg. And for coarse grains, the government used to charge, right? The government used to charge 1 rupees per kg. That is essentially you give 1 kg of rice, the beneficiary has to pay 3. That is the meaning of issue. But now under NFSA, the issue price has been reduced to 0 rupees. No separate entitlement under NFSA as well as PMGKY. PMGKY benefits have been brought under NFSA. 5 kgs free of cost till the end of 2028. Till the end of 2028. These are certain important points. Everybody is okay? Please do let me know. I've covered PHH, priority household, Antyodaya, 5 kgs of food grain. Now regarding PDS, listen to me carefully. Okay? Regarding PDS, argument is we have an agency. The most important central government agency. The most important central government agency we have for procurement of food grain is the Food Corporation of India. Food Corporation of India, FCI. And remember this again and again, whenever I've discussed agriculture, I've told you this. This was the time period when the agriculture sector was highly promoted by the government. How so? We had, right, FCI being set up in 1965. We had Commission for Agriculture Cost and Prices, which was also set up at the same point of time. Although CSEP earlier was called as Agriculture Prices Commission. At 1965, it was called as Agriculture Prices Commission. 1985, it was renamed as Commission for Agriculture and Cost. Is it okay? Right? Earlier APC, then CSEP in 1985. So this is also very important in the context of agriculture. And FCI is also very important in the context of agriculture. So Food Corporation of India is a statutory authority. It has a statutory backing, meaning what? The government of India passed the FCI Act of 1965 and then set up, sorry, FCI Act of 1964 and then set up Food Corporation of India. And it is this Food Corporation of India which essentially is helping government of India by procuring the food grains and ensuring that the farmers are getting the MSP paid. Is everybody okay? Please remember FCI, it was there in the newspapers also. I'll tell you the context. Government of India has infused capital of more than 10,000 crore rupees, right? More than 10,000 crore worth of capital has been, right, basically infused by Government of India in the Food Corporation of India. It was there. I've discussed a current affairs article as well as a question related to FCI earlier. This is the background information. Please make a note of it. Okay. Public distribution system in case of India is being implemented by using the fair price shops. Fair price shops. The fair price shops essentially are the ration shops. You must have heard of the term ration shops. So the fair price shops are essentially the ration shops. The license to set up a fair price shop is issued by the state government. The state government will decide how many fair price shops we should be having, where we should set up, right? Who should be given the license to set up, etc., etc. Okay, so that is determined by the state government. Please remember that. We use the network. We essentially use the network of all of these ration shops to ensure food grains are procured, food grains are distributed. The ration shops will come into picture at the distribution level. Right? The process is very simple. Listen to me carefully. Here is the farm gate. From the farm gate, or let's say market, from the market, the procurement is done. Then you warehouse it, basically store it. And after storage, you will basically send it to, right, let's say, the fair price shop. And it is at this particular step where individual beneficiaries are distributed the food grains. This is a very simple flow chart of how the procurement is done and how the distribution is. So here it is the duty of the state government. Here it is the duty of the central government plus state government. Here that is the procurement is the duty of the central government as well as the state government. How so? Please listen to me very carefully. Whenever you talk about the procurement, whenever you discuss the idea of a procurement in India are done essentially through in two ways. Procurement is done in two ways. One is called as a centralized procurement, and the second one, right? Obviously, if it is centralized, the second one has to be decentralized. Is it okay? One is a centralized procurement, and the other one is decentralized. What is done in centralized? The Food Corporation of India will directly procure, or it will ask the state government agencies to procure and transfer it to FCI. Simple. All of you able to understand this? I'll repeat it. Do not worry about dinner. Focus on the discussion now. A lot of you will be worried about dinner. Saturday evening, your friends will be asking, right? Come to party. Let's go outside. Full day you have learned economics. Forget about economics. UPSC will not ask you, etc., etc. Focus on the discussion. Leave others. Tomorrow you'll become IS officer. They will keep on, right? Enjoying. Don't worry about that. So listen to me carefully. Okay. So centralized Food Corporation of India will procure, or else Food Corporation of India will ask the state government agencies to procure, give it to FCI. And all of this is called as a central pool. Remember this. All of these food grains are called as central pool. From the central pool, the food grains will be sent to either the same state or other states. Allocation will be done either to the same state or to other states. So far, so good with the concept of centralized. And some of you might be thinking, sir, why will the state government be involved here? Is there any benefit for the state government? What is the logic behind it? The state government will be paid certain commission. The state government will be paid certain commission by the central government for conducting the operations on besides because of the, let's say, the procurement that they require. And so central government will pay certain commission. That's it. Next one, decentralized. What happens in decentralized? Very simple. FCI is not involved. The procurement is done by the state government and allocation is done by the state government. Simple. The state government will procure food grain and the state government will allocate the food grains for distribution within the state. That is a decentralized procurement. And this practice of decentralized procurement right now it is becoming very famous because the central government wants the state governments to decide what they want to procure, what they want to distribute, how much they want to procure. Center is asking the states to decide. And the benefit of having a decentralized procurement for the state government is according to their requirement, they will procure. And second, the center will provide certain commission to the state governments for having conducted all of these operations. The center will basically provide commission to the state governments for doing all of it. And so the procurement is either done by the central government or the state government agencies through a centralized procurement or a decentralized procurement. So the process is very simple. Right? Essentially, from the market, you procure, you store, and then you distribute by basically using the ration shops or the network of fair pressure. This is essentially the model of the public distribution system that we are following. Everybody's okay? Please do let me know in the chat section. Everybody's okay. So MSP policy, the public distribution system, the food security. These are the three things that I've covered so far. Can I go to the fourth point? After this, I'll take up your questions. Don't worry. A lot of you have been asking question. After this, right, reserve your questions. I'll address your question. Okay. Warehousing. In case of warehousing, listen to me carefully. At the central government level, we have multiple agencies. Right? We have multiple agencies. For example, we have Central Warehousing Corporation. We have Food Corporation of India. We have multiple agencies at the central level which are involved in the procurement as well as warehousing. Warehousing means storage. At the state government also, at the state government level also, we have multiple agencies. For example, lot of the state governments have state warehousing corporations, SWC, state warehousing corporation. So warehousing is done by both the central government as well as the state government. Does it mean there is no private warehousing in India? Yes, even the private warehousing is present. The best example is, I'm pretty sure all of you heard of the company ITC. Do let me know. Pretty sure you must have heard of the company ITC, Indian Tobacco Company. Very famous company for tobacco products. They have basically shifted away from tobacco now into agriculture sector. So warehousing is done by the private sector also, by the center also, by the state as well. Point number one. Point number two, in the context of warehousing, specifically talking about the Food Corporation of India. Specifically talking about the Food Corporation of India, remember the name of a committee, Shanta Kumar Committee. Remember the name of the committee. There is a committee recommendation, Shanta Kumar Committee. And what are the important recommendations of the Shanta Kumar Committee? Point number one, the committee recommended that whenever you procure food grains, there has to be a rationality. There has to be standardization when you procure the food grains. Don't simply keep on procuring for the sake of procuring. Based on the requirement, you procure the food grain. And any particular state announces a bonus, very high amount of a bonus, do not procure excess of food grains from that. Do not procure surplus food grains from that, because that will create a destabilization. It will create a destabilization in the markets of different states. It will create destabilization in supply and demand in the market. It will hamper the market prices. In particular states where the state governments have invested money, they have developed the infrastructure, for storage, for distribution, etc. Let's not have FCI in that. Let's not have FCI operations in that. Let's basically hand over all of these operations to the state government. Let the state government procure, let the state government distribute, etc. Let them do that, provide commission for that. It also recommended that we need to cut down on the food security coverage. The food security coverage is 67%. It recommended that we should reduce it to 40%. And instead of 5%, we should increase the allocation. Increase the allocation, reduce the coverage. In particular cities which will have a population of more than 10 lakh, that is a million, introduce the concept of a cash subsidy or cash transfer instead of providing subsidized food grain. It recommended that we should focus on the procurement of oil seeds as well, pulses as well, because right now the focus is always on the procurement of paddy and wheat. It recommended that we should promote NWRS system, negotiable warehouse receipt system, so that the farmers will not face the issue in terms of getting access to institutional credit or collateralized borrowing by pledging the food grains that they have cultivated. So these are some of the recommendations associated with the Food Corporation of India, which has been recommended or which have been recommended by Shanta Kumar committee. Okay, remember, important, UPSC can ask you the recommendation. Okay, finally, under the agriculture sector, concept of marketing. Right, concept of marketing under the agriculture sector. Right, there are two concepts that you need to remember. One is the APMC and the second one is the ENAM. What is APMC? Please understand, agriculture marketing. Write it here. The agriculture marketing is a state subject. Simple. It is a state subject. And that is a precise reason. What we have seen is the state governments, the respective state governments will bring in a law and basically promote mandi system. Will promote mandi system. That is agriculture markets. Across India, multiple states have done it. But please understand, there are also certain states which are not in favor of the mandi system. That is essentially state of, let's say, Bihar. They have abolished, right, the model of APMC, Agriculture Produce Market Committee. State of Kerala doesn't have a mandi system. So argument is because it is the power of the state governments. The idea of having a APMC is the power of the state governments. There is absolutely no compulsion on the states to have a mandi system. It is entirely their prerogative. Entirely the prerogative of the states whether to have a mandi or no mandi. But once a state has a mandi, once the state has a mandi, what is the impact of it? They will demarcate the area under which or which will be covered under the mandi system. They will basically notify the crops which will fall under the mandi system. Now, these crops, when they're cultivated, the sale of this has to happen within the mandi itself. The sale of this has to happen within the mandi. That is essentially the model of a APMC, Agriculture Produce Market Committee. Right, so government of India, the state governments, multiple state governments have a mandi system. It's not compulsory, remember that. But please understand, at the same point of time, the mandis also have certain issues. They also have certain drawbacks or certain problems. For example, the mandis which are set up in a particular state, the farmer is not able to get access to information from, let's say, other mandis. Because the information is required regarding supply, regarding demand, so that the prices discovered in the mandi are transparent. So that, right, better price discovery can happen. That is not happening in India. The farmer is taking the crop to the mandi, sufficient infrastructure is not present in the mandi. The farmers, right, are not getting the benefit of the crops which are being sold because the middlemen are forming a cartel. They are ensuring that the buyers are getting prices, not the right buyers are getting better prices, not the farmers who are the sellers. So there are a lot of problems which are basically holding back or which are plaguing the model of a mandi system in India. And not to forget, when you want to operate, imagine you're a buyer. You want to operate in multiple mandis in India. You want to operate in multiple mandis in India, you need to have multiple licenses. Right? So there were multiple problems. In order to address these particular problems, Government of India has implemented a model called as ENAM. Government of India has implemented a model by the name of ENAM, E-National Agriculture Market. ENAM is E-National Agriculture, that is Electronic National Agriculture Market. What is the importance of ENAM? Please understand, ENAM is not a separate marketing of agriculture commodities. It is nothing else but connection of APMC. Is it okay? ENAM is not a separate marketing committee. It is essentially we are connecting APMCs on the same platform. We are bringing the APMCs on the same platform. We are interconnecting all of these APMCs. That is essentially the model of the ENAM. The Small Farmers Agri Business Consortium, SFAC, Small Farmers Agri Business Consortium is the implementation agency. And under the SFAC, the Government of India has allocated funds also. If SFAC feels that certain mandis require assistance, financial assistance, to have, let's say, a system, to develop infrastructure, to have, right, let's say, a process where farmers need to get registered, the crop of the farmers need to get listed on the platform, etc. To develop this model, the government also promotes the SFAC to provide financial assistance to the participating states or to the participating mandis. But what is the benefit? What is the most important benefit of having a ENAM model? Now, farmers are not just selling their product in the same market, they'll be able to get access to multiple buyers from different states. All of you able to understand? Until now, you are basically selling to one market, right? That is essentially this APMC mandi. The buyers have to come here. But now it will not happen. The buyers can be sitting in any other state in India. They will be able to bid for your crop. You will be able to sell the crop to different buyers from different states. And from the buyer's perspective, the benefit is the buyers are not required. The buyers need not have multiple licenses. The buyers can have simply one license, national license, to participate on the ENAM platform. Instead of getting multiple licenses from different states, only one license sufficient to bid for any crop in India, to purchase for, right, to purchase all of these crops which are listed in the ENAM. So from the seller's perspective as well as the buyer's perspective, ENAM model is functioning better. Done? Right. So these are certain important points I wanted to discuss in the context of agriculture sector, covering the right marketing through APMC, ENAM, warehousing, food security, PDS, as well as MSP. I know, is this the complete coverage of agriculture sector? No. Agriculture sector will have, let's say, food processing. But food processing is not relevant for prelims. Agriculture sector will have, right, let's say, technology usage in agriculture. Is it relevant for prelims? No, it is relevant for mains. And when the prelims will get over and when you are preparing for mains, we'll have a look at it later. Don't worry. Okay, let me know. Any doubts? There was one student who was asking, where is the PPT available? Right? Where is it there, etc. My dear, for the, I think, sixth time today, for the sixth or seventh time, all of this will be available in this Telegram channel. Okay. So it will be available on this particular Telegram channel. All you need to do is essentially search for the Telegram channel. You will get it. After the session is over, I will upload the document. Do not worry. I will upload. That is my headache. You please don't worry about this. Ha. Shripad Mishra says, sir, ek gana ga dijiye chota sa. No, my dear. Not now. Ah. Question one. What is okay? Question one from your side. Small Farmers Agri Business Consortium, SFAC, not SFAM. right? Small Farmers Agribusiness Consortium. That is essentially a cooperative which has been set up or which has been made as the entity or the authority responsible for the implementation of ENAM model. Okay. Has the class ended? No, my dear, class is not ended. I am there here. Other students are there. Shripati is there. Right? How can you simply say, right, the class has ended? No, it has not ended. Huh. Is windfall tax part of capital tax? No, my dear. Windfall taxes essentially were implemented in the form of indirect taxes. Different types of indirect taxes, that is basically additional customs duties, were implemented, right? Cesses were implemented as a part of windfall tax so that the amount can be collected used for specific I'm sorry, can be collected in order to ensure supply will be there in the domestic market. And that was implemented in 2022, withdrawn now. Okay. Aditya Singh, sir, you look like Setupati. Okay, good. Setupati Vijay. Ah, Ishwaryan, any difference between ENAM and APMC? My dear, APMC is a physical infrastructure. It is a physical infrastructure. Whereas ENAM is the connection. And basically, for example, if you want to imagine this, Flipkart, correct? All of you used Flipkart, and somebody will say, no, sir, I've not used Flipkart. I've only used Amazon. My dear, right? What does Amazon do? Just a second. Okay, I can see the comments now. What does Amazon do? Amazon will basically bring all of these particular sellers, all of the sellers on the same platform. You, as a buyer, can search for a product. Whatever product you want to search, you will place an order for that. Here, at the same point of the same model you apply to essentially the farmers and the buyers. Farmers from the different states will get registered on the ENAM. They will register their crops on the ENAM. The buyers across India will start bidding for it, just like IPL. You must have seen how the players in the IPL would be, right, basically bid by different, let's say the agencies, or let's say different teams like this. The same model will be followed in the ENAM. Okay. Huh. Next question. Uh, can I see? What is rebate? HRX Spark. I believe you asked this question and somebody answered also in the comment section. Rebates are essentially the refunds which are provided by the government only for specific purposes. That is, let's say, if your income is up to 5 lakh rupees, just a hypothetical idea I'm explaining here. If your income is up to 5 lakh rupees, whatever taxes you pay, the government will refund it back. That is basically called as a tax rebate. This has been expanded in the very recently announced budget. Okay. What is Ricardian equivalence? Okay, I'm sorry, the bigger economic concept. Ricardian equivalence, please understand, generally says that if let's say the government will reduce the tax rate. Why does government cut the tax rate? Because the government wants people to increase the expenditure. Simple. Why will the government cut the tax rate? Because government wants you to spend more. But what generally the Ricardian equivalence says is, when the government will cut the taxes in expectation of higher expenditure from the people, it may not happen. That may not happen. Why? Essentially because the people will realize that today if the government has cut tax rate, tomorrow it might increase. Tomorrow the government might increase the tax rate again. So in the hope that tomorrow or in the future the tax rate might increase, I will start saving money now. That is essentially the concept of Ricardian equivalence. Okay. So can per capita income also impact exchange rate? My dear, per capita income is basically an average. Per capita income is derived using what? Individual incomes. Right. So if the individual incomes are having an impact, and that is the higher, that is a better way to say it will have an impact on exchange rate. Per capita income is essential and average. Okay. Sir, can you write the full form of SFAC? Small Farmers Small Farmers Agribusiness Consortium. Small Farmers Agribusiness Consortium. Okay. Huh. Did the government end the collection of compensations? No. Listen to me carefully. The government has stopped paying compensation to the states. Government has stopped paying compensation to the states. Government has not stopped collection of the compensation. Reason being, during the pandemic, the government of India had to borrow money to pay compensation to the states. Around 2.7 lakh crores. Around, I'm saying around, because I know exactly it is 2.69 lakh crores. Somebody will search in the Google and say, sir, you said 2.7, but the Google says 2.69, which is correct? Google is correct. I'm rounding off around 2.7 lakh crore rupees. Government borrowed this money. Now, who will repay this amount of money? Government says after June 2022 till 26 and 27, I'll continue to collect the compensation. I will use the compensation to repay the loans. I'll use it to repay loans. Right? That's the reason compensation says is collected even today. Okay? Huh. All the questions I've addressed now. How price is decided on ENAM? My dear, it is basically a competition. It's an auctioning. Right? If you're a farmer, you have listed your crop, multiple buyers are bidding on it. Right? So essentially, you will agree to a particular price. Let's say it will hit a particular highest level. After that, nobody is bidding. You're happy with that. Basically, accept that particular price. That's it. Okay. Aman Barnwal. Sir, suppose inflation is low and GDP growth is high. Does it have a negative connotation? If it is so, it seems a positive sign of the economy. My dear, if inflation is very less and right, let's say the GDP is very high, it is good for the economy. Good in the sense, despite having higher GDP, the demand for the goods and services is not increasing at a very faster pace. If it starts increasing at a very faster pace, that is always a danger. It is always a danger. Okay. Sam Sundar. The name is Sam Sundar. My name is Sham. His name is Sam. One request. Can you please tell Abhishek sir to upload the PPT of yesterday's class? Should I call him now? I'll tell him after the class. Okay. Don't worry. If he has not uploaded, he will upload it on your behalf. Sam Sundar, on your behalf, I will remind it to Abhishek sir. Do not worry. I will do that. Ah, Sripat Mishra. It will be sorted after you will see PDF from sir. Okay, you're answering to somebody else. Is it necessary to go to APMC to get registered for listing the commodity? Yes, my dear. You have to go to APMC market because the system is set up in the APMC market only. Right? That is the reason you will have to go there and list the crop. Okay, done. Uh, Vishaka Baghel. Sir, sorry for interruption, but can you please tell how long the class will run? My dear, we are done with agriculture. Next is investment model. After that, there is certain important basics I want to cover. A lot of times questions have been asked from this particular slide itself. You can see this. After that, we'll discuss employment. After that, inflation. After that, after inflation, budgeting. After budgeting, national incomes. After that, right, certain important indicators, industries. Then IMF. Then I think, right, certain points from economic survey. That is essentially the coverage that I want to have in today's session. Most probably it will go up to 11 to 12. Okay. Done. Everybody is okay. Can we move forward now? Can we move forward? गलती कर दी पूछ के. Don't worry. Right? Don't worry. Get used to all of this. Get used to the concept of, right, let's say sitting for longer duration. Trust me when I say this. Get used to it. I'll tell you why. When you write a mains examination, you're supposed to sit continuously for 3 hours, not just for one session, two sessions. Two sessions. right? So it will become very difficult for you. Trust me when I say this, it will become very difficult for you if you do not have the habit of sitting for longer duration. Okay, done then. Let me go forward. Investment models. Let me go forward. Concept of investment models. What I'll be covering under the investment models? FDI, FPI, special economic zone. This is already covered. Infrastructure, investment trust, right? Fifth one, ADR and GDR. Sixth one, P notes. And the seventh one, bilateral investment treaty. Let's start with the first one, FDI. Now listen to me very carefully. Whenever you receive investments from the foreign market, whenever you receive investments from the foreign market, essentially the investments can be done in physical assets. It can be done in physical assets. What do you mean by physical assets? A foreign company will bring dollars into India, invest, right? Invest and set up a company in India. Purchase an Indian company, have a joint venture with Indian company. That is essentially creation or investment in the physical assets. On the other hand, a foreign company can bring in money into India. They can simply invest in the stock market. Possible? Please do let me know. Both are possible, right? So, whenever you see there is an investment in the physical assets, remember that will be classified as FDI. That will be classified as FDI, foreign direct investment. Second, whenever you see the foreign investments going to the stock market purchasing equity, that is essentially called as FPI, foreign portfolio investment. Then everybody is okay. Please do let me know in the chat section. Be alive, be awake, and give me, right, keep on giving me confirmation that you're also present. And I'm not teaching the concepts to myself. Do let me know. Keep on giving me, right, let's say confirmations. So FPI. And I know a lot of you will basically say, sir, what is the difference between FPI and FII? My dear, listen to me carefully. The FII is essentially considered to be part of FPI. Foreign portfolio is a bigger term. Foreign institutional is a part of, right? It is essentially under FPI, right? So one is FDI, another one is FPI. FDI, like I said, investment is done in physical assets. And whenever you talk about FDI, please remember this. Which sector will be covered how much? Whether the sector will attract or will be open for 26% FDI, whether it will have 49%, right, FDI, whether it will have 100% FDI, who will decide all of it? It will be decided by the government of India. The FDI policy is decided by government of India. Okay, that is point number one. Point number two, all the countries also will not be uniformly covered under FDI policy. All the countries are not uniformly covered under the FDI policy. What generally happens is the government of India now says those particular countries which are sharing border with India, which are border sharing, which particular country has a border with India, that is a land border with India. Remember this, for them, there is a different process altogether. For them, there is a different process. I'll come to this. But other countries, there are two options which are available for them to bring in FDI into India. Also, listen to me carefully. Under the concept of FDI, you're allowed to bring in money into India either through automatic route, or through approval route. Either through automatic route or through approval route. Now, in the context of those particular countries which share border with India, are having land border with India, no two routes, only one route. And that will be approval route, also referred to as the government route. Also referred to as a government route. So far, so good? Now, what is this approval route or, right, let's say the automatic route? Which sector or which industry will fall under which of the two is again determined by government. Government in recent times, what it has done is a lot of these industries which were earlier under the approval route now have been brought under the automatic route. A lot of them are under the automatic route. But what is the meaning of automatic route? Here, you do not require any approval. You do not need to take any kind of a permission. All you need to do is simply bring in investment, invest in India, and in the next 30 days, inform Reserve Bank of India. Is the point clear? I'll repeat it again. In case of automatic route, you do not have to get any kind of permission. Bring in the money, invest, and in the next 30 days, simply inform Reserve Bank of India. That is essentially called as automatic route. What about approval route? Under approval route, again, there are two types. Under the approval route, there are two types. One is essentially if your investment, I think I've given it here. It is there. One essentially, if your investment is up to 5,000 crore rupees, up to 5,000 crore. And second, if your investment is above 5,000 crore, up to 5,000 crore and above 5,000 crore. If your investment is up to 5,000 crore, you will have to get the approvals from a portal. There is a portal, Foreign Investment Facilitation Portal. Remember the name also, FIFP. Foreign Investment Facilitation Portal. Earlier, there was an authority, right? There was an authority which was set up post 1991 reforms. Foreign Investment Promotion Board, FIPB. When Mr. Arun Jaitley was a finance minister, the government of India decided there is no need for a board now. There is no need for having any kind of authority. Why? Most of the sectors, most of the industries are covered under automatic route. What is the need for having an authority? That's the reason we have dismantled, we have abolished FIPB, and we have an authority, we have a portal. Right? We have a portal by the name of Foreign Investment Facilitation Portal. So far, so good. Now, if your investment is above 5,000 crores, if you want to invest more than 5,000 crores, you're allowed to invest, but not in the not through the FIFP. You'll have to get the approval from the Cabinet Committee on Economic Affairs. Everybody is okay, right? You will have to get the approval from the Cabinet Committee of Economic Affairs, right? So these are the two important routes. These are the two important routes which are used in India: automatic route and approval route. In case of the countries which will share border with India, no option, only the approval route or the government route. In case of other countries, based on the industry, based on the sector they want to invest, either it will be automatic or approval. It will be decided by Government of India. Right, so this is essentially the concept of FDI so far. Now, there is a committee name, please memorize this, Arvind Mairam Committee. Arvind Mairam Committee. What is this Arvind Mairam Committee? Arvind Mairam Committee has given a definition to distinguish between what is FDI, what is FPI. Remember this. And the Government of India uses this definition. And the Government of India set up a committee, Arvind Mairam Committee, and based on the recommendation of Arvind Mairam Committee, right now, how can I distinguish between FDI and FPI? If it is a listed company, remember this, if it is a listed company, if the foreign investment will be used to acquire 10% or more than 10%. 10% or more than 10%, in such cases, this will be classified as FDI. This will be classified as FDI. And there is an exception also. What is the exception? If you acquire 9% today, but you promise to the government that in the next 12 months, you will increase it to 10 or more than 10. In such cases also, this will be classified as FDI. Simple. Everybody is okay with the definition here. In a listed company, this will be FDI. And if your investment in the shares is less than 10%, let's say you go to the stock market, purchase 7% equity of a company, you purchase 6% equity of a company. In such cases, it will be classified as right FPI, less than 10%. This is in case of a listed company. What about unlisted company? In case of unlisted company, if the foreign investment, right, if the foreign investment is done in purchasing equity, any amount, if it is an unlisted company, then in that case, this will be classified as FDI. It will be classified as FDI. Everybody is okay with the definition. This is the definition given by Arvind Mayram Committee, and today we are using this particular definition itself. Can we move forward now? Please do let me know. Can we move forward? Okay. Right. So FDI definition is done. The roots are done. The ceiling essentially means how much percentage is allowed. 26%, 49%, right? 100%, etc. That is ceiling. Okay. That is also done. So this is the coverage of foreign direct investment. Time is almost 8 o'clock. If you have any questions, do let me know. I'll address your questions and then we can take the dinner break. Questions now. Tarak Yen. Then, sir, AP government gave 21 acres for 99 paisa, saying the company will invest 5,000 crores, but they register in FIFP. My dear, I don't know which company you're talking about. Whichever concept it is, don't worry. Investment will be done through FIFP. But please understand, you're talking about a land acquisition. I hope you understand. You're talking about land acquisition. Land acquisition will always come under the state government. Land acquisition will come under the state government. I can give you n number of examples in that particular context. Right? For example, in the state of Kerala, there was a discussion regarding a silver line project that was approved by the state government. They wanted to implement the project. Farmers opposed, they cancelled the project. Or best example, Tata Nano project. Tata Nano project. Right, what happened? It was supposed to be implemented in right Nandigram, that is West Bengal. State government opposed it and that was shifted. I hope you understand. You are talking about land acquisition. It will come under the purview of the state. Okay. What are the benefits of approval to the FDI? What do you mean by that? Should you not have a process where you want to regulate how the FDI will come into India? And I've told you, most of the sectors now are under the automatic route. Only limited sectors where the government of India wants to control who will come, right? Which kind of investment is coming, which company is coming into India. If the government feels it is strategically important, that's a reason it is keeping these segments under the approval route. Otherwise, most of it are under the automatic. Okay. Uh, One question I was not able to see. Just a second. Please explain FDI limit of unlisted company. There is no limit in right unlisted company. Any foreign investment that is done to purchase equity. I repeat, any foreign investment that is done to purchase equity in unlisted company, it will be classified as FDI. It will be classified as FDI. Okay. Sir, is a debt financing and equity financing capital receipt? I'm yet to take that. Don't worry. I'll not discuss budgeting now. Okay. Sectors under automatic route. My dear, there is a big list. Why do you want to remember all of it? In recent times, if you're reading newspaper, you will know that. Insurance sector. Very, very recently it was there in the newspaper. Right. Let's say the satellite manufacturing. Very recently it was there in the newspaper. Okay. Question on inflation, my dear, hold on to your questions. I'm discussing the topic investment model. You're asking me about inflation. Please hold on to your question. I'll address them. Not now. Let me discuss inflation, then I'll address your question. Rahul Singh, do take break after completing this topic. Okay. FDI is under CCA and RBI and Ministry involved, DPIIT, Department for Promotion of Industries and Internal Trade. DPIIT, right? That is essentially handling this idea of a FDI policy. Okay. What is the difference between participate or not? I meant to discuss that. I will not answer now. I meant to discuss that. Okay. Okay, done. Let's take a break then. Let's take a break. We will take a break. Time is 8 o'clock. Let's say 40 minutes or 45 minutes. Is it okay? Right, let's restart the discussion at 8:45. Please do let me know. Done. Let's restart the discussion at 8:45. Okay, welcome back. Before I start the discussion, please do let me know that I'm audible and visible for all of you. Audible and visible. Only two people have replied. Others? Okay, great. I believe all of you have had your dinner now. Let's continue the discussion. So, before the break, what we were essentially discussing, we were discussing the concept of FDI, foreign direct investment. That is done. We need to continue the discussion with FPI now, foreign portfolio investment. What is the essential idea of a foreign portfolio investment or basic definition of foreign portfolio investment? If you take the definition of Arvind Mayram committee, in case of a listed company, if it is up to 10%, that is you invest, foreign investors will purchase up to 10%. And in the stock market, in a listed company, that will be called as a foreign portfolio investment. Now, a lot of you will be considering why is there no definition for foreign portfolio investment in an unlisted company? Can anybody tell me in the chat section why Arvind Mayram committee has not given a recommendation or a definition regarding foreign portfolio investment in an unlisted company? Because if you remember, I think I've written the definition here. Ah, the definition which is given by Arvind Mayram committee is only associated with listed company, that is FTI and FPI. Right, is there in, right, let's say the listed as well as unlisted. What about unlisted company? Please understand, FPIs generally invest in equity. When you talk about in equity investment, FPIs invest in the stock market. And when you say stock market, unlisted companies, the shares are not available in the stock market. Simple. The shares of the company which is unlisted are not there in the stock market. So there is no question of any confusion there. Right. So argument is very simple. Arvind Mayran committee gives a very solid definition, comprehensive definition for listed companies. For unlisted, there is no confusion of whether it should be classified as FDI or FPI because the company's shares are not there in the stock market. And FPIs, when they want to invest in equity, they go to stock market. Done? So that is a basic idea. Remember this. Now, what is the classification of FPI? How do I classify FPI? There are two classification or there are two categories of FPI. FPI category 1, FPI category 2. Until recently, there were three categories. Now it has been merged into only two categories. If you talk about, let's say, sovereign wealth funds, pension funds, or insurance companies, etc., all of them are categorized under category 1 FPI. Whereas individual investors, or for that matter, let's say family offices, limited partnership, etc., all of them will be classified as category 2 FPI investors. So simply remember F- FPI, two categories, category 1, category 2. And if you ask me, sir, who will provide this categorization? Who will recommend this categorization? Categorization is provided by SEBI. SEBI has provided this particular category for FPI. So classification, category 1, category 2. What are the different ways through which FPI can come into India? What are the different routes through which FPI will flow into India? Everybody is awake? Please do let me know. Lot of you have gone dormant. As far as I can see, lot of you have gone dormant. Everybody is able to follow the discussion. Do let me know in the chat section. Right? Please understand last part of the session. Right? So last part of the session, I know a lot of you will be feeling difficult. Lot of you will be already feeling sleepy. Lot of you would be already snoring also. But be awake. Listen to me. Okay. Now, what are the different routes through which FPI will come into India? One is called as a MTF, a medium term framework, which was introduced in 2015. Another one is a voluntary retention route. And the third one is a fully accessible route. Right? Essentially, the argument of MTF, VRR, or for that matter, FAR is that certain restrictions will be imposed by the Reserve Bank of India whenever FPIs will bring in the investment and invest in the market. Reason why we are imposing restrictions is, if you remember when I discussed regarding balance of payment, that is specifically under the capital account. If you remember under the capital account, I said there will be restrictions imposed by Reserve Bank of India. Why? We do not want free flow of the investment to come into the market, let's say into the bond market, and suddenly there is a volatility, lot of the investment will go out of India. This will create lot of volatility. This will create lot of uncertainty, right? So that is the reason. Okay, that is the reason restrictions have been imposed. Under MTF, generally there is a restriction. Again, multiple types of restrictions are there. I'll just give you one example. If a foreign portfolio investor brings in, let's say, 100 crore rupees, 30% of this, not more than 30% of this, can be invested into only one instrument, right? Because if they invest, let's say, 100 crore, all of that 100 crore into only one instrument, if they sell all of this, suddenly 100 crore will flow out of India. So in order to address these kind of issues, lot of investment limits are imposed under the medium term framework, that is MTF. It has come into force from 2015. Second one is voluntary retention route, and the third one is fully accessible route, which are very, very recent, 2019 and 2020 respectively. These have come into force. Now, what is the basic idea for VRR and EFAR? Voluntary retention route and fully accessible route. Let me explain this. Please listen to me very carefully. Voluntary retention route and fully accessible route. Under these routes, the restrictions which were imposed by RBI earlier, the restrictions which have been imposed by Reserve Bank of India earlier, these restrictions to a very great extent have been relaxed. These have been relaxed. Relaxed means what? How much you are allowed to invest in the stock market, how much you are allowed to invest in the bond market. These kind of restrictions are there. These restrictions, especially in the bond market, have been relaxed by Reserve Bank of India. Now you can invest a higher amount of money under the VRR route as well as EFAR route. And why is this required? Why has this kind of a relaxation been provided? Please understand, there are certain long-term investors in the market. Example of long-term investors are pension fund investors, insurance fund investors. These are generally very long-term investors. The concern earlier was that because we have imposed a restriction, these long-term investors will not be able to invest a large amount of money in India. And these are very big investors. These want to invest for a very longer period and higher amount of money. So essentially what has been done by Reserve Bank of India under VRR and FAR to attract these long-term investors, relaxations have been provided. How so? Under the VRR route, if you are a foreign investor and you want to invest, let's say, in the corporate bond segment, or you want to invest, let's say, in government bond segment, you do not have to stick to the restrictions. The restrictions have been relaxed. But please understand, there is a condition here. What is a condition? Under the voluntary retention route, the foreign investor voluntarily has to basically promise Reserve Bank of India that at least 75% of the investment that they do under VRR will be there in India for at least 3 years. Is my statement clear to all of you? I'll repeat this again. Under the voluntary retention route, RBI will give you relaxations. You do not have to stick to the limit. You can bring more amount of money, invest in India. But this investor has to guarantee Reserve Bank of India that at least three-fourth of the investment that they are bringing into India will stay in India for at least 3 years. In essence, RBI is ensuring that some amount of the investment will stay in India for a longer duration. Today it will not come, tomorrow it will not simply flow outside. That is the voluntary retention route. Everybody is okay? Please do let me know. Now, what about the fully accessible route? FAR, fully accessible route. Under the fully accessible route, only the government bonds are covered. Only the government bonds. Not all the instruments, not all the bonds, only specific government bonds. And who will decide what kind of government bonds will be covered under FAR? It is decided by Reserve Bank of India. RBI will decide what kind of government bonds will be covered under the FAR. it will be decided by RBI. I'll just connect it to current affairs. Until very recently, the 14-year government bonds and 30-year government bonds were classified under FAR. They were covered under FAR. Reserve Bank of India very recently has announced the new issuance of these 14-year and 30-year bonds will not be covered. These will not be part of FAR now. What kind of bonds are covered then? 5-year government bonds, 10-year government bonds. These kind of bonds are covered under the concept of fully accessible route. And the foreign investors do not have to stick to the limits. There are no restrictions on them. They can bring a larger amount of money, invest in the government bonds under the route called as fully accessible route. Is everybody okay with this? Please do let me know. So, medium term framework. Second one is a fully accessible route. Third one is the voluntary retention route. These are the different routes through which FPI flows into India. So, FDI is done. FPI is done. Let me go to the next one. Special economic zones. What is the basic idea of a special economic zone? The special economic zone, the government of India introduced an act. The SEZ has been introduced in India with the passage of an act, that is SEZ Act of 2005. Under the Special Economic Zones Act of 2005, the government of India will notify certain region as a special economic zone. Certain region will be notified as a special economic zone. And the region outside SEZ, any region outside SEZ will be referred to as domestic tariff area. And one is within SEZ, right? That is special economic zone. Anything outside SEZ will be called as a domestic tariff area. Now, what is the benefit of declaring a region as a special economic zone? Any economic activity that will be conducted within SEZ will be provided with lot of tax benefits. The government will provide lot of tax benefits to those entities which are present in the region which is classified or notified as a special economic zone. What is the idea, right? What is the benefit here? For example, let's say you import anything into special economic zone, you do not have to pay any customs. Then you don't have to pay any customs. You export, no taxes are applicable. You earn profits. For the first 5 years, you earn profits, right? 100% tax exemption will be provided. For the next 5 years, 50% tax exemption will be provided. The SCZ's infrastructure will be developed by a private developer. All these are the very important provisions which are associated with the special economic zone. Beyond this, do not worry about how many SCZs are operating in India, how many are operational, how many have been approved, how much is the export, etc. All of that is needed not for prelims but only for mains examination. And everybody is okay. And the SEZ model is regulated. It is basically under the Ministry of Commerce. Then can we go forward now? Do let me know. Can we go forward? So FD is done, FP is done, SEZ model is done. Next one, INVIT is already taken care of. Let me go to the next one, ADR and GDR. Next concept is ADR and GDR. What is the ADR? ADR essentially stands for American Depository Receipts. And GDR stands for Global Depository Receipts. What is the basic idea for ADR and GDR? Please listen to me carefully. A lot of you will be having confusion regarding this. Let me explain this. What is the concept of an American Depository Receipt? Let's say there is an Indian company. Okay. Let's say there is an Indian company. If this Indian company wants to get listed in the USA market, it can do that. It can get listed in the USA market. But the process that will be followed, the amount of time taken, the amount of documentation that will be needed, very high. Is there any alternative to this? Is there any alternative so that the company will be able to issue instruments in USA, get listed in the USA, at the same point of time doesn't have to take this longer route? There is a route by the name of American Depository Receipt. What happens under ADR? The Indian company will take its listed shares, approach a depository in India, submit these particular shares. Now, this depository has a tie up with another depository in USA. This information that the company in India has already submitted the shares will be transmitted. Now, this American depository, generally these depositories are banks or other financial institutions. So, this American depository now will issue instruments, list them in the stock market. Will issue instruments which will be listed in the American stock market. And let's say you're an American investor, you purchase the instrument in American stock market, it is as good as purchasing the shares of Indian company. All of you okay with the model of ADR? Do let me know. All of you okay with the model of ADR? So here, the Indian company is not properly following the normal listing process. It is listing the securities, listing certain instruments which are representing the shares of Indian company. It is as good as you're purchasing the shares, but you're purchasing instruments that are representing the shares of Indian company. And because, right, listen to me carefully, because this is listed in America, these are called as American Depository Receipts. Rekha, my dear, I'll explain the concept of P notes and the difference also. So far, so good. Because it is listed in America, it is called as American Depository Receipt. What if it is listed in, right, let's say European market? What if the instrument is listed in the European market? Then that is called as Global Depository Receipt, GDR. In America, ADR. Outside America, GDR. Just think of this. Can the same process be followed by an American company to list instruments in the Indian stock market? Let me know. Don't you think the same process can be followed by American company to list instruments in the Indian market? Of course, yes. In that case, it will be referred to as Indian Depository Receipt. Everybody is okay with the concept of ADR, GDR and IDR? Let me know. Everybody is okay with the concept of ADR, GDR and right, let's say IDR? These are the depository instruments. Before I go forward to the next model, some of you are commenting, or earlier also, there was a comment that what about gift city? What is this gift city? My dear, please understand, gift city is a model of SCG only. Simple, gift city is an SCG only. But what is the speciality of gift city? In the gift city, within that region SCG, the focus is on not on the production of goods. The focus is not on producing goods which you want to export. No. Rather, the focus is on setting up entities which will provide mainly services. Lot of services. What kind of services? Stock market. The banks, right? Let's say insurance companies, pension companies, right? These kind of financial services entities are present in the model of a gift city. Same idea in the sense tax benefits are given there also, right? It is also an SCG. But what is the speciality of gift SCG? Nothing. It is focused on financial services. It is focused mainly on, right, financial services. Stock market is present, IIBX, etc. So many things are present in the gift IFSC. But model is basically to promote more and more financial services. Okay. Now let me go forward. P notes. P notes. Now listen to me very carefully. What is a P note? P note, first and foremost, represents a participatory note. What is a P note? It represents, right, or it means a participatory note. Now, what do you mean by participatory note? Let me explain that. What do you mean by a participatory note? Let's say there is a foreign investor. Say there is a foreign investor who wants to invest in the Indian market. They want to invest and purchase a lot of shares in the Indian stock market. Now, before they can invest in Indian stock market, they will have to take the approval from SEBI. They will have to go to SEBI, register with the SEBI, get the approval from SEBI. Then this will take time. For this, you will have to submit lot of documents. Again, same idea, right? It's a time-consuming process, right? It requires lot of resources, etc. Is there any alternative? Is there any alternative? Yes. What is the alternative? Imagine there is a foreign portfolio investor which is already registered with SEBI. Then there is a foreign portfolio investor which is already registered with the SEBI, which means they have the right to invest, or they have the right, let's say, the authority, or they have the approval to invest in the Indian market. Now, what this FPI will do is, it will issue an instrument to the foreign investor, and the foreign investor will give the money to FPI to invest in the Indian stock market. So look at this. The foreign investor is not registered with SEBI, but they are investing in the Indian stock market, not directly, but indirectly through FPI. That is, understand this route is used by foreign investors. But what is participatory note here? Participatory note is, imagine the foreign investor has given 100 rupees to FPI. I'm taking a simple example, okay? The foreign investor has given 100 rupees to FPI. Now, FPI has issued an instrument which is called as a participatory note. Look at the arrow mark. The FPI has given one instrument to the foreign investor which is called as a participatory note. And the FPI will take 100 rupees and, let's say, will purchase the shares of the company Paytm. I know, lot of will basically say, sir, who will purchase the shares of Paytm? Nobody should purchase, etc. Again, don't worry about the share market, etc. Not, that is not the point. So the FPI has taken 100 rupees and has used the 100 rupees to purchase a share. Now, is it okay if I say this this P note will derive its value from the share price of the Paytm company? Yes or no? Think of it. And if you are the foreign investor, I've given you one P note, I've taken 100 rupees, I will invest in the share of Paytm company, and I'll tell you, this is what I've done. Your 100 rupees is in the share of Paytm company. Now, don't you think the P note will derive its value from the share price of the Paytm company? So now listen to me carefully. Can I define a participatory note as an offshore derivative instrument? Let me see how many of you will understand. I'll repeat the statement. Can I define the P note as an offshore derivative instrument? Offshore means outside India. Derivative means this P note is deriving value from something else, that is the share of Paytm company, and it's a financial instrument. Offshore derivative instrument, that is P notes for you. And here the foreign investor is not registering with the Indian stock market regulator. They are not investing. They are basically investing through somebody else who is already registered with SEBI. So far so good? Do let me know. So far so good. Now, what is the comparison between a P note and ADR GDR? Are they both one and the same? And if no, what is the difference, etc.? Please listen to me very carefully. P note is a derivative instrument, whereas ADR GDR represent shares of an Indian company. Is the point one clear? It's a derivative instrument. This is equal to share of an Indian company. Point number two. P notes do not require to register in India. No requirement of registration, right? Whereas, right, in case of ADR, GDR, if these are issued in the USA stock market, they are supposed to be registered. They are supposed to be regulated by the USA stock market regulator. If these are issued, listed in the European stock market, European regulator is there. Right? So I hope all of you are able to understand the difference between these kinds of instrument. Both are not one and the same. Both are different. P note is just a derivative instrument, whereas ADR GDR is as good as you're holding the share itself directly. Done? So these are certain important points regarding ADR, GDR, P note. Now what is left out at the end of the topic here? That is essentially bilateral investment treaty. BIT. Bilateral investment treaty. What is this idea of a bilateral investment treaty? Now listen to me carefully. This was there very recently in the context of India, UK as well. Bilateral investment treaties are essentially agreements between countries. These are agreements between the countries. And right, what is the benefit of these kind of treaties? Imagine now investors from the USA will come to India and will invest, set up a company in India. Suddenly, if the government of India changes the policies, will this not have a negative impact or a limiting impact on the functioning of the USA companies in India? What if government of India will suddenly change taxation policy? What if government of India will suddenly take this segment, put it under the automatic route now, or nationalize the whole sector now? So the policies of government of India should not be harming the foreign investors. There should be certain protection which should be provided to the foreign investors investing in India. And that is made possible by agreements which are signed between the countries. These agreements are called as bilateral investment treaties. BIT, bilateral investment treaties. Now, historically, if you see, the government of India has signed multiple BITs. The government of India has signed multiple BITs with multiple countries. But essentially, what happened was there was one case which became very famous. Again, don't worry about the case as of now. Essentially, there was one case which actually led to, right, let's say a company, foreign company, dragging Indian government to an arbitration where government of India lost and the foreign company won the case. And that was because of a certain taxation policy of the government. Now, understand the argument here. In such cases, the government of India simply says the taxation policy should be a sovereign right. I hope you understand the argument. The taxation policy of the government of India should be the sovereign policy. That is, it should be decided by the government. The right should be there to the government of India to decide whatever taxation policy they want to decide. Whereas in this case, government of India was a drag to international arbitration. India lost the case. And this was not just an isolated case. There are multiple such cases. Of course, I'm talking about retrospective taxation policy, which was announced by, right, let's say the government of India when UPA was there. Mr. Pranab Mukherjee was the finance minister. Again, all of that story is not required for UPSC preliminary examination or for that matter, mains examination. So what happened was government of India realized all of this is happening because I am guaranteeing this in the bilateral investment treaty. All of this is happening because I'm guaranteeing this in the bilateral investment treaty. And that is what these foreign companies are doing. They're dragging me to international arbitration, citing provisions in the BIT. What did government of India do? Cancel all the existing BITs. Simple. Cancel all the existing BITs. And from 2015 and 2016, introduce the new model of a bilateral investment treaty. So far, so good with everyone. Please do let me know. Right. So argument is the new BIT model has been implemented. Hardly around 8 countries have accepted this. Hardly around 8 countries. Out of that, right, only 2 countries which have signed BIT, we have completely implemented the model of BIT. But what is the concern? Why the countries are not accepting BIT? Why? Right, let's say, for example, India UK FTA. Very recently, India signed a full-fledged FTA with UK. Why BIT? Sorry, why BIT was not part of that? Argument is there is one provision which is not acceptable to other countries. That is essentially the provision of the government of India simply says if there is any dispute between the government, that is the state, and the private sector company, the private sector company will have to exhaust all the legal provisions in India first. They have to wait for 5 years, exhaust all the legal provisions in India, and then if you want international arbitration, that will happen only after 5 years. Yes, many of the countries do not accept it. They do not want to wait 5 years. If there is a issue, any dispute between the state and the private sector, they want to approach an international arbitration, try to resolve it as soon as possible. But government of India says no, we don't want it. You'll have to exhaust domestic opportunities first, and you'll have to wait for 5 years, and then you can take me to international arbitration. That is the precise reason lot of these BITs which are there in the discussion have not been signed. Even signed have not been implemented. Only 2 BITs so far has been accepted and implemented. Everybody is okay, right? So this is also there in the newspaper. Please be very, very careful. Please be very careful. So these are the things I wanted to discuss in the context of, right, let's say, investment models. Let me go forward. Next one is certain important basics, basic points. Important. I'm not covering all of these, right? Let's say basics, important ones, which have been targeted by UPSC. First one, factors of production. First one is factors of production. There are 4 factors of production. Please remember all the 4. It was there in the newspapers because the finance minister spoke about it. Capital is very often there in the newspaper. Focus on that also. That is essentially, I've told you this earlier. The capital are 2 types. One is a working capital, second one is the fixed capital. If right, UPSC will ask you a question on the basics, I think this is one important area that you need to be worried about. Past there was a question, again there can be a question. Okay. Now in the context of capital, there is one more term, capital formation. Capital formation. What is the meaning of the capital formation here? From one time period to the another time period. From one time period to the next time period, how much capital has been accumulated? Is it okay? How much capital has been accumulated? That is essentially called as capital formation. Is everybody able to understand? From one time period to the next time period, how much capital? Capital here is essentially the assets which have been created by us. How much is the accumulation over a period of time? That is essentially the idea of a capital formation. And what is the formula? How do I calculate the capital formation? The formula is gross capital formation. Gross capital formation is equal to investment. Investment divided by GDP, gross domestic product, into 100. Gross capital formation is equal to investment divided by GDP into 100. And I hope you understand. Many of you will simply ask me, sir, what is this gross capital formation? Why are you writing gross capital formation? Why not directly capital formation? Reason is very simple here. Can anybody tell me what is the difference between a gross capital formation and a net capital formation? Let me see. Can anybody tell me what is the difference between a gross capital formation and net capital formation? The difference is essentially depreciation. I think, okay, couple of people have answered. Very good. Depreciation. From the right total capital formation that has taken place, find out how much is the depreciation. Depreciation is how much capital is used for replacement of old worn out capital. Right? Remove that, you will get net capital formation. Let me ask you one more question. In the calculation of GDP, will you consider gross or net capital formation? In the calculation of GDP, will you consider gross capital formation or net capital formation? It has to be gross capital formation. Remember this. It has to be a gross capital formation. These kind of statements can be used in the prelims. Be very, very careful. Okay. So, gross capital formation is equal to total investment divided by GDP into 100. That will give you the formula for capital formation. Remember the formula as well. Okay, so this is one basic. Second one is the concept of economic activity. The concept of economic activity. Economic activities, there are two classifications. One is the classification of primary, secondary, and tertiary. Second one is the classification of market and non-market economic activities. What is essentially the difference? Market and non-market mean in market, whatever is produced will be sold. Whatever you are producing, either a good or a service, you are selling that. It is called as a market economic activity. Non-market economic activity, for example, a farmer cultivates crops. The crop will be used by the farmer for self-consumption. Or if you're able to understand, the farmer is cultivating a crop but will be used for self-consumption. So in case of non-market activities, those economic activities which are not being sold in the market, which are not monetized in the market, are called as non-market activity. Right? Market as well as a non-market economic activity. One more classification is primary, secondary, and tertiary economic activity. What is primary? Right? I'm pretty sure all of you know this. Primary essentially talks about agriculture sector. Agriculture sector. But how do you define a primary activity? How do you define what is a primary economic activity? Anything that is associated where you use the natural resources. I'll repeat, where you use the natural resources, that is called as a primary economic activity. Primary economic activity. What about secondary economic activity? Wherever the manufacturing happen, wherever the production happens, that is called as a secondary economic activity. You use the output of primary, use, right, essentially use it to produce something else, that is secondary. That's the reason industries are present. Right? The best example for the secondary is industries. Some of you are saying buffering. My dear, from my side, there is absolutely no buffering issue. Or only one person has put it twice. Buffering. No, from my side, there is no buffering issue. From your side, there is some problem. Third one is the tertiary. Right? Anybody knows why this is called as a tertiary? Do let me know. Anybody knows why this is called as a tertiary? Any particular reason? Listen to me carefully. NCERT has the answer to this. NCERT says this is a tertiary because in tertiary sector, on its own, most of the times, nothing is produced. I hope you understand. On its own, nothing is produced. It will provide the supporting service to other sectors so that the production happens. Is it okay? Right? Why this is called as a tertiary? Most of the times, not in all the cases, most of the times. The services, right, that you talk about, on its own, they are not the output. These are generally used for something else to produce in the primary and secondary. That's the reason this is called as a tertiary. But again, please listen to me very carefully. Everything in the tertiary is always supporting. Anything that is there in the tertiary, which is a product or a service on its own, yes, there are examples also. For example, right now, I'm teaching. Correct? Right now, I'm providing a service. Don't you think this on its own is an output? It is not providing support for the any other production. On its own, it is an output. Everybody is able to understand, right? So generally it says it is not an output on its own. It will provide support to primary and secondary so that there is some output. But there are examples within the tertiary also which can be referred to as an outcome or an output on their own, such as education. Then everybody is okay. So primary, secondary, and tertiary. Now, next concept is economic agents, right? Economic agents. Right? What do you mean by an economic agent? What do you understand by the term economic agent? Economic agents are the decision makers. Remember this. Decision makers of what? Decision makers in terms of, let's say, decision makers in terms of what should be purchased in the market, what should be consumed from the market. Right? These are those kind of decision makers. And who are the economic agents? Remember three terms. One is the households, that is you and me. Second one is the companies, which are producers. And the third one is the government. Right? The government, again, RBI will be part of government only. Government. Second one is the firms or the companies. And the third one, essentially, individuals, households such as you and me. Done? So these are economic age. Now, there is one more concept. A lot of students are generally confused with this: stock and flow. A lot of students are confused, right, between stock and flow. Now, listen to me very carefully. I'll take one example here. All of you have the wallet. Wallet is nothing but a purse. If you open the wallet, there will be certain amount of money right now. Whatever the amount is, don't worry. And I'll not ask also, don't worry. There will be certain amount of money right now. That, my dear, is called as a stock. That is called as a stock. When you measure anything at one point of time, at a certain point of time, when you measure it, that is called as a stock. Everybody is okay with this? Please do let me know. Everybody is okay? Somebody says there is a fly. Okay. Fly is your stock. Right? It could be 500 rupees. It could be 20 rupees. It could be 5,000 rupees. Anything could be there. That, my dear, is a stock. So whenever you measure anything for, right, let's say at a specific point of time, that is called as a stock. Sir, give me one more example. My dear, when you measure indicators in the market, I'll give you certain indicators. Let's say unemployment. Please do let me know. Unemployment. When you measure unemployment, don't you think when you collect the data at that point of time, what is the unemployment? That is your database for unemployment. Yes or no? Please do let me know in the chat section. I'll give you opposite of this. What about GDP? Think of this. What about GDP? GDP is published at the end of the quarter. Yes. GDP is published at the end of the financial year. Yes. But are you measuring at the end of a time? Are you measuring at a particular point of time, or are you covering a full financial year? That is over a period of time. Are you able to understand this? Whenever you measure anything for over a period of time, that is, let's say, for one full quarter, for one full financial year, for half a financial year, that is essentially called as a flow. Is it okay? That is called as a flow. Somebody says stock here also. When you measure for a certain time period, that is called as a flow. If I take the example of your wallet itself, if I measure in the last 1 year, how much money was kept in the wallet? What was the total amount of money kept in the wallet in the last 1 year? That is essentially flow. But when you open the wallet right now, what is there in the wallet right now? That is called as stock. Everybody is able to understand the difference between a stock and a flow? Do let me know. Bhanu Prakash says bank account. Exactly correct. In bank account, if you basically measure in the last 1 year how much money you deposited, that is a flow. But if you look at the bank balance right now, that is essentially, right, the stock. Everybody is okay? Can we go forward now? Right, everybody is okay? Stock and flow. This can be asked in the preliminary examination. Please be very careful. Be very careful. They will give you certain indicators. Unemployment, is it a stock or a flow? They will give you GDP, is it a stock or a flow? Right? They will basically give you other indicators. Let's say they will give you indicators of inflation, stock or a flow. Right? So these kind of indicators will be asked in the prelims. They can ask you a question on the idea of a stock and flow. Be careful. Okay, let me go forward. Concept of sectors. There is a real sector, there is a financial sector. There's a classification of real and financial sector. How do I differentiate between real and financial? Listen to me carefully. Whenever you talk about production of goods and services, it is real. Right? Whenever you talk about goods and services production, it is real. Whenever you talk about financial instrument, for example, you take a loan from a bank. Is it a financial instrument? Yes. A company takes a loan from a bank. Is it a financial instrument? Yes. So, whenever you are talking about, let's say, financial instruments such as loans taken, loans given, bonds issued, etc., all of that are financial sector transactions. So, be very careful. In the past, also, questions have been asked, and in the upcoming exam, also, that can be asked. Everybody's okay? So these are certain important basics. Please make a note of them. Questions have been asked in the past. They will be asked. I'm pretty sure they will be asked. Okay. Next, the area of employment. Right? The segment of employment. Now, in the employment, what are the important basics you need to understand? Important basics. Because I can discuss about schemes that has already been covered by Asta ma'am in the scheme, let's say video. We can discuss about current affairs. I've already covered the employment related current affairs in my, right, let's say the current affairs video marathon session. So let's focus on the basics. And there are certain parts of employment which is needed for mains also. I'll give a very simple example. What if UPSC will ask you discuss the factors that have led to jobless growth in India? That is a mains based question. And we will discuss those when we basically approach the mains based discussion. Now let's focus on, right, the prelims requirement. Aditya Singh is asking, is this the last section? No, my dear. Inflation is there. There is still inflation. There is still national income aggregates. Still certain concepts in the economic survey. So it is there. Have patience. We are going one after the other. Okay, employment. What are the important areas? And generally, I get one question whenever I talk about, let's say, working age population. Whenever I talk about working age population, what is the age? Because some books would have given 15 to 64 years. Some books would have given 14 to 59 years. Some books would have given, right, this to that, etc. I will go with economic survey. Economic survey. Economic survey says 15 to 59 years. Please understand. Economic survey simply says 15 to 59 years. Right? So which year economic survey? The most recent economic survey. The most recent one also. 15 to 59 years. So that is a working age group. Now, whenever you talk about unemployment, there are different types of unemployment. The most important traditional ones are these. One is called as a frictional unemployment. Second one is a structural. Third one is the cyclical. Fourth one is the seasonal. Frictional, structural, cyclical, and seasonal unemployment. What is the meaning of each one of them? Listen to me carefully. Whenever you say frictional unemployment, you will shift from one job to another job. You are there in a particular job, you will quit and you will join one more job. For a small period of time, you will remain unemployed. That is called as a frictional unemployment. Is it okay with all of you? This is called as a frictional. Second one is structural unemployment. And what do you mean by structural unemployment? Let's say there is an introduction of a technology. This technology will basically make your skills outdated. And there is an introduction of technology. And because of that, your skills will become outdated now. For example, let's say artificial intelligence. If artificial intelligence is introduced, lot of lower level skills, again, lower level skills, a lot of them will become obsolete. Reason being, these kind of jobs require repetitive work. Same kind of a work, repetitive, which doesn't require lot of thought process, lot of analytical skills, etc. So in such cases, introduction of AI will make certain skill sets useless, obsolete, and that will lead to unemployment, which is called as a structural unemployment. Is everybody okay with the structural and frictional? And please remember, structural plus frictional is called as natural rate of unemployment. Structural plus frictional is called as natural rate of unemployment. Let me ask you one question. Which one do you think is more dangerous? Structural or frictional? Let me see. Which one do you think will be long lasting in Indian market? Again, assuming that will happen in Indian market. Which one do you think is more dangerous, which is long lasting? It has to be structural. Right? I hope you understand. It has to be structural. It is long lasting. Frictional essentially means you're jumping from one job to another job. Whereas structural, now in order to come out of this particular unemployment, now you will have to acquire more skill sets. You'll have to get equipped with something else that is long lasting and it is much more dangerous. Everybody is okay? Please be very careful. Frictional plus structural. Let me go forward. Cyclical. What happens in cyclical? In cyclical unemployment, essentially, various movements such as changes in the weather will lead to unemployment. Change in the weather will lead, I'm sorry, changes in the weather will lead to unemployment in seasonal. Cyclical, I'll come. Cyclical is economic cycle. Okay. So changes in the weather, right? Changes in the season will lead to unemployment, which is called as a seasonal unemployment. Best example, sowing season is over. People will not be having wage opportunities now. Harvesting season is over. Wage opportunities are lost. Right? So changes in the season will essentially lead to unemployment rate. And lastly, the cyclical unemployment. Cyclical unemployment. In case of cyclical unemployment, all of you heard of the business cycle? Do let me know in the chat section. All of you heard of a business cycle or an economic cycle? What generally is observed in a business cycle or an economic cycle? Economy will increase the pace of the growth, experience very fast growth. It will hit the highest level. Again, the economy will start experiencing a slowdown. It will enter into recession. If the recession is not controlled, it will fall into depression. And then it will start recovering, again experience this kind of a sine wave movement. This is essentially called as a business cycle or an economic cycle. Everybody is okay? This is called as a business cycle or an economic cycle. Listen to me very carefully. Whenever economy falls into, let's say, a slowdown or a recession, it will lead to unemployment. It will essentially lead to unemployment. Why? Slowdown or let's say recession basically represents what? Let's say recession. What does it represent? Represents a demand for the goods and services is less. And when the demand for the goods and services is lesser, why will the companies continue to have the same number of employees? No, they will remove certain number of employees. Certain people will be losing jobs. That is essentially cyclical unemployment. Then that is essentially called as a cyclical unemployment. So these are the different types of, again, traditionally different types of unemployment that you need to remember. And suddenly UPSC will give you a statement like this. Listen to me carefully. If a person is not willing to work at the existing wages, can it be called as unemployment? Let me see. I'll repeat the statement. If the person is not getting a job at existing wages, can it be called as unemployment? Let me see how many of you will give me a correct answer. Answer is yes, by the way. Answer is yes. If a person is not getting a job at the existing wages, it is unemployment. It can be voluntary, it can be involuntary. I hope you understand. It can be voluntary or it can be right involuntary also. That is, you voluntarily say, I don't want to work at these wages, existing wages. That is voluntary unemployment. And the company says, I don't have any work to give to you. Go away now. You're right. You're not required anymore in the company. That is involuntary unemployment. But essentially, what is happening, whatever are the wage levels in the market, you are not getting work in the market. Either voluntary or involuntary, you are not able to get the right job or, right, let's say, work. That is essentially the concept of unemployment. Remember this. That is essentially the concept of unemployment. I know some of you will basically say, but sir, I don't want to work at the existing wages. I want to prepare for UPSC. Can you call me as unemployed? My dear, you are not considered as a part of labor force in the first place. Understand that. If somebody says, I do not want to search for a job in the first place, I want to prepare for UPSC 2 years, 3 years, 5 years. I want to make it as a 5-year plan, just like Government of India. In that case, you are not part of a labor force in the first place. You are part of non-labor force or non-workforce. Everybody is able to understand? Because please understand, whenever you divide the population, one will be those who are working. Those who are working, that is employed. That is employed population. Second one is those who are unemployed. But what is the specialty about the unemployed population? They are searching for the work. They are, right, seeking to work. They are not getting, that's a different point. But they are seeking work. But the third one is non-workers. Non-workers. Example of non-workers: children, pensioners, right? People who want to pursue higher studies. Those who will quit the job and join, let's say, PhD courses, right? Or for that matter, civil service aspirants. Don't write this in the exam. Civil service aspirants who will simply say, sir, handling both job as well as preparation is becoming very difficult for me. Let me take a bitter pill now. I will simply quit the job. Next 1 year, I'm not even searching for a job. I'm not looking to work. I'm not seeking work. I'm not willing to work. That, my dear, essentially will put you in the group of non-workers. Done? Everybody is okay? So please be very careful. These kind of things can be asked. Somebody said disguised unemployment. Yes, there is a problem of disguised unemployment also in case of India. Somebody is saying underemployment, right? Yes, there is a problem of underemployment also in case of India. Lot of problems are associated with employment and unemployment. Anyways, there is one term called as employment elasticity. Employment elasticity. What is essentially the concept of employment elasticity? It is the ratio of what is the percentage change in the employment rate divided by percentage change in the GDP. Is it okay? I'll repeat the statement. What is employment elasticity? What is the percentage employment rate divided by, right, percentage change in the GDP? Right, this measurement or this comparison, right, essentially is called as employment elasticity. It has been there in the discussion for a very long time period in the context of India. Please remember that. Why the argument of many of the experts is that employment elasticity is actually lowering in India. It is actually falling down in India. And why is it a problem? The problem is very simple. For a fact, we know denominator is increasing. Denominator is increasing. That is GDP growth rate we are achieving. Again, don't worry about the pandemic. Pandemic is a blip. Pandemic is not normal. It is abnormal, by the way. So forget about pandemic, but generally we are experiencing a very good growth rate, which is represented in the denominator. But if the growth rate in employment is not matching the pace, if the number of jobs which are created, right, are not sufficient in India, they are not increasing at a faster pace, then my dear, it will essentially be referred as an jobless growth phenomenon. And that is right being discussed in the context of the Indian economy. So what UPSC can do is UPSC can ask you which of the following will represent jobless growth phenomenon. Search for employment elasticity. Search for employment elasticity. If the employment elasticity is very, very low, it's an indicator that there is a jobless growth. Then everybody is okay. Right. So last point in case of employment I want to cover is the measurement. How do we measure employment or unemployment for that matter? Please remember this. The Ministry of Statistics and Program Implementation, MOSPI, Ministry of Statistics and Program Implementation is measuring unemployment in the Indian market. And for the measurement of employment and unemployment, we have a survey which is called as a PLFS, Periodic Labor Force Survey. Periodic Labor Force Survey. The PLFS is conducted once every quarter. Remember this. It is conducted once every quarter, right? And for the data for urban India is published every quarter. For rural India, we publish it once in a year. And the reason I'm talking about the PLFS is Government of India couple of months ago has announced that it is not yet implemented. It has announced that even this data which is published quarterly is not right fast enough. And the frequency is not right satisfactory for the government. So what they have proposed is rather than publishing the PLFS on quarterly basis, they want to publish the PLFS or let's say the unemployment and employment data every month. They want to publish it every month. When it will happen, you will have to wait and see. But this is a proposal. Right now, what is the point you need to remember? PLFS published by MOSPI, published for every quarter. Every quarter we publish the data for urban India or urban population. For the whole of India, that is, let's say, including rural population, it is published once in a year. And everybody is okay with this? Measurement, right? I hope you understand. Within the measurement also, there is one more part of the discussion. That is essentially, how do I collect the data? How do we collect the data? Right? There are different methods which using which we can collect the data. That is basically the concept of the activity status. I do not think the activity status will be asked for prelims. Has it been asked in the mains? Yes. Yes, in the mains, the question was asked a couple of years ago. How do we measure employment and unemployment data in India? Where you were expected to write all of the data collection methodology, the formulas, etc. But for prelims, I don't think so. They will ask you a question about the activity status when you want to measure employment and unemployment. Okay, so these are certain things I wanted to discuss in the context of the employment and unemployment. Can we shift to the next one now? Those who are wondering, sir, how many topics are left out? I'm already tired. I'll sleep now. You keep on shouting. I'll keep on sleeping. My dear, one is inflation. Second one is essentially national income aggregates. That's it. One is inflation, right? We will discuss. Second one is budgeting, and third one is national income. Somebody says agriculture. Bhanu Prakash, my dear, agriculture got over before the dinner break, right? It is done. Agriculture is already done before the right dinner break, right? You were not present. Okay, economic survey. I'll cover it. I'll cover it. Don't worry. Important points I'll tell you because trust me when I say this. Economic survey, is it important for prelims? Definitely yes. I'm not saying you ignore it. Should you read the complete economic survey? 480 plus pages, waste of your time. Hardly around 5 to 6 pages data is important. I will discuss the important points. I will give you the handout also, revise it, right? And I'll give you the important points in the session itself. Let me go forward now. Let's start. Ready for 24-hour marathon, sir? No issue. My dear Pavan, not an issue for you. But I hope you understand. For me, 24-hour marathon. If I keep on shouting like this for 24 hours, right? Imagine what will happen to my voice box. And there is no insurance also for my voice box. So that is a precise reason. You might be ready, my dear. I'm not ready. And by the way, that was a joke. Right? Pawan should not take an offense and say, sir, right, I was talking in your favor. Right? You are making a joke on me only. Go. I will not support you. Right? I'll stop the discussion now. I'll quit the discussion now. Okay. Let me start. Inflation. What is the definition of inflation? Definition is essentially if you take the price levels of the basket of, right, basket of commodities, basket of certain commodities, and if the price levels for the basket goes up, that is definition of inflation. Okay, right? So one definition of inflation, whenever the price levels for the basket of commodities will go up, that is inflation. Now, what is a classification of inflation? It is based on, right, two sets here. One is a simply factual, second one is more conceptual. We'll focus there, but factual information. One is called as a moderate rate of inflation. Second one is a galloping rate of inflation. Third one is a hyper rate of inflation or hyperinflation. Whenever you use the term moderate rate of inflation, generally in 1 year, if the rate of inflation is, right, let's say up to 10%, generally up to 10%, we'll simply say that that is a moderate rate of inflation. And within the moderate, again, they will cut it, right? They will say creeping rate of inflation, running rate of inflation, etc. But don't worry. Generally, when annually it is up to 10%, a single digit number, it is called as a moderate rate of inflation. Next one, galloping rate of inflation. If the rate of inflation is, let's say, above 10% and generally up to 30% like this, that is called as a, right, let's say, galloping rate of inflation. And hyperinflation, whenever the inflation rate is very high. How high? Let's say 50% per month. If the inflation rate per month is, let's say, around 50%, then that is essentially called as a hyper rate of inflation. Very, very high rate of inflation. Has India experienced a hyper rate of inflation in recent times? Absolutely no. India has been experiencing a moderate rate of inflation. We have been experiencing a moderate rate of inflation. Are there any examples in recent times which have experienced a hyper inflation rate? Right. For example, Turkey experienced a very high rate of inflation. Right. For that matter, Venezuela, where inflation rate was 80,000, 90,000%. Historically, one example that is provided, which was there in the newspaper very recently also, Zimbabwe. Zimbabwe. Right. Zimbabwe also has been experiencing historically very, very high rate of inflation. And that is a precise reason. Very recently, they changed the currency again. In Zimbabwe, they changed the currency again. For example, I have discussed this earlier also. If you come across the term ZIG, right, or ZIG, you pronounce it however you want to. If you come across the currency ZIG, please remember it is a new currency that has been announced by the country Zimbabwe, which is basically following the concept of a gold standard. It is essentially a currency which is backed by gold, valued based on the gold. That is essentially the currency name ZIG. Remember the name. Okay. Now, come back to the discussion here. One is essentially a factual information, moderate, galloping, and hyper. In addition to this, more important will be this. Based on the causes of inflation, demand pull inflation and a cost push inflation. Demand pull and cost push inflation. Right? What is the basic idea? Inflation simply means the price levels are going upwards. Correct? Inflation means what? The price levels are going upwards. Price levels for the basket is going upwards. But the price levels can go up either because there is a higher demand for these, or right, essentially there is a higher cost of production or higher taxation. So the market prices can increase because of the demand side factors or supply side factors, or it could be both. For example, in the context of India, if you ask me, sir, which factor is more dominant in India? Remember this, according to Reserve Bank of India, the inflation in the Indian market is mainly driven because of supply side factors. Is my statement clear to you? The inflation is mainly driven because of the supply side factors. And that is the argument that you'll have to put forward if there is a question for you, even in the interview. For example, they will ask you in the interview, inflation rate is higher. Why is RBI not increasing interest rate? The answer should be sir or madam. Right? Because when I say sir, you will suddenly argue, sir, why do you think always the interviewer will be a male? You're a male chauvinist. The interviewer can be female also. Of course, yes. So you can simply say sir slash madam. Even if RBI increases interest rate, this will help us in controlling demand. But the inflation is mainly driven in India because of supply side factors. If a price of the vegetable is very high because the supply is lesser, what can RBI do by increasing interest rate? Doesn't make sense also. Will not help also. So argument is very simple here. According to Reserve Bank of India, the inflation in the Indian market is mainly driven by supply side factors. That is a cost push inflation. Right? Cost push inflation. Everybody is okay? Right? Examples which can contribute to cost push inflation. Let's say higher wages for the labor, higher indirect taxes, higher, right? Let's say raw material cost. Right? So examples are these can contribute to a cost push inflation. What about demand pull inflation? Demand pull inflation. If the incomes of the people are increasing very fast, if the Reserve Bank of India has a policy where money supply is very high in the market at very cheap rate of interest, if the government of India will conduct a policy where lot of money supply is done by government of India, expenditure is very high, it will borrow money and spend a lot of money in the market. So there are multiple reasons because of which the demand can also increase, the cost also can increase. If the demand goes up and this causes inflation, is called as a demand pull inflation. If the cost goes up and that basically drags the inflation upwards, that is called as a cost push inflation. Everybody is okay with this? Everybody is okay? Done? So the demand side factors as well as the supply side factors both can right act together. Individually also they will cause. In case of India, both are acting, but it is mainly the cost push inflation. Mainly the cost push. Right. So one was the classification based on the rate. Another one is based on the causes. Now, how do we measure inflation in India? What are the two measures? This has been discussed earlier also. Listen to me carefully. The two measures, right, essentially to calculate inflation in India is a WPI and, right, let's say the CPI. WPI and CPI. And what is the WPI? Wholesale Price Index. WPI is a wholesale price index where we are basically taking a basket of 697 commodities. We are measuring the price level changes for all the 697 commodities. All of them are goods. All of them are goods. Please remember that. This is published for every month, published by Economic Advisor, and the base year for the calculation of WPI is 2011 and 2012. What about the other indicator? We have one more indicator by the name of CPI, Consumer Price Index. One is the measured in the wholesale market, where the buying and selling of large quantities will take place. Whereas the other one, that is the CPI, is measuring the change in the price levels in the retail market. All of you okay with the retail market? So what is the meaning of retail market? My dear, where you will purchase goods and services, where I will purchase goods and services. That is the retail market. So one is in the wholesale and the other one is in the retail market. So when you measure the changes in the price levels in the retail market, that is essentially called as a CPI, Consumer Price Index. Right? So Consumer Price Index, the base year is 2012 and this is published by NSO, National Statistics Office. And for every month this is published. Just like WPI, every month this is published. Done? Everybody is okay with this? Right? Everybody is okay? Before I go forward, as your classmate, there is a user by the name of as your classmate. My dear, don't even take this as a printout. I will give you one more PDF where I've put all of these in A4 sheets. Whatever the mind maps I've put in the PPT, all of them are there in one more document in A4 sheet. The PPT slides, I believe, are around 40 PPT slides with pictures. That is a mind map. The PDF document, which I'll share after my class is over, is around 15 pages. 15. Which means if you take back to back printouts, it will be 8 pages. Just 8 pages. So download that, take a printout of that. 8 pages, you will also feel happy. That is just before the exam, so 2 days or one day before the exam, 8 pages you can easily finish off, let's say in a matter of 1 or 2 hours. So I hope you understand that. And as we discuss, somebody is putting a comment, sir, you have missed a lot of things under agriculture, right? That is under WTO. You've missed this, etc. The reason why I've missed or skipped those particular points is I would have covered that in detail under current affairs. I hope you understand. I would have covered that in detail in current affairs. That's the only reason I would have skipped those particular points in today's session. Okay. Munna Sharma, how many products under CPI? My dear, under CPI. Under CPI, I'm talking about combined, by the way. How many products are there? 299. How many commodities? 299. That is goods plus services. 299 are goods plus services. Okay. Let me go forward now. Before I go forward, there are a couple of more points. One is called as a headline, and the second one is called as core. Right? One is called as a headline. Second one, you write basically as core, right? A core inflation. What is a headline inflation? If you take a basket of all the commodities, let's say for example in CPI, 299 commodities are there. If you take the basket of the 299 commodities and calculate inflation, that is called as headline. And that is essentially used, right? Headline CPI is essentially used for policy making in India, that is as a nominal anchor. Please remember that. For policy making, for example, Reserve Bank of India, or let's say the Monetary Policy Committee, what kind of indicator is used by the Monetary Policy Committee to decide whether should they increase the interest rate or decrease the interest rate? That, my dear, is right basically the headline CPI. Headline CPI. Remember that. Right? What about the core? Please understand, in 299 articles, there will be certain articles associated with the fuel. Under fuel, there will be certain number of articles. Under food, also certain number of articles will be there. Don't you think the fuel and food articles, the prices are fluctuating a lot? The prices are fluctuating a lot. The prices are volatile in nature. They will use the term short-lived in nature. Right? Fluctuating, volatile, short-lived, whatever term you want to use. For example, the price of the milk, if they increase it, it is almost permanent. Price will always be higher like this. But let's take an example of onion. Let's take example of tomatoes. Somebody will say, no, it is not tomato, it is tomato. Right? It's tomato, they'll say. Right? So either you want to pronounce it as a tomato, 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 leave it. It's a product. It's basically, right, a fruit. I was reading a particular book very recently, and there was a very nice statement in the book. Let me lighten the mood. Right? The writer simply says, again, this is given in multiple books. What is the difference between knowledge and wisdom? What is the difference between knowledge and wisdom? And the writer simply says, knowledge is knowing that tomato is a fruit. Right? Knowledge is knowing that tomato is a fruit. Wisdom is knowing that you should not put that in fruit salad. I hope you understand. Right? I hope you understand. What is the difference between a knowledge and wisdom? Knowledge is knowing tomato is a fruit. But wisdom is knowing that you should not put tomato in fruit salad. That is the difference between knowledge and wisdom. Next time somebody will ask you in the interview, throw this statement. They'll be so impressed. They'll say, okay, you will become IAS, go now. Okay, done. Let's go forward now. Let's go forward. And again, this is a very famous quote, very, very famous by the time, by this time. Okay, let's go forward. So let's take an example of tomato. The prices of the tomatoes are not permanently changing. 1 month it will be higher, and another month it will be very lesser. 1 month it will reach, let's say, 150, 160 rupees, etc. Another month it will fall down to 20 rupees. So there are certain commodities which are there in the basket whose prices are fluctuating a lot, whose prices are temporarily changing. These changes are short lived in nature. That, my dear, essentially will be excluded. Those commodities will be excluded from the basket, and you calculate for the remaining commodities. That is called as a core inflation. Everybody is okay? And everybody is okay. So, headline inflation and core inflation. Which of the two do you use for policy making in India? Headline CPI. Headline CPI is the one which you use for policy making, right? That is Monetary Policy Committee. Let me go forward now. What is the impact of inflation? One, it will basically reduce the purchasing power. It will reduce purchasing power. That is, with higher prices of the commodities, with the same amount of money, you'll be able to purchase lesser quantity now. Okay, right? That is reduce the purchasing power. Second one, it will have an impact on investment scenario. You tell me, all of you reading newspaper? With higher inflation in India, don't you think lot of your investments you will basically drive it somewhere else? That is a lot of, right, let's say investments in the Indian market has gone to gold now. Lot of investments have gone to other assets rather than keeping, right, let's say in a deposit, rather than investing there, etc. Where the inflation rate is very high, you will get very less return. Investments would be affected. Investments will start, right, going into other segments, other sectors as well. Then everybody is okay, right? That is the impact on investment. It will have an impact on exports. I explained to you. Where did I explain? Long time ago. Right now time is how much? 10 o'clock. Long time ago I had a discussion how inflation will have an impact on exports. And if you're wondering, sir, how long ago? Was it 1 month ago, 2 months ago, 3 months ago? No, my dear. When I was discussing factors having an impact on exchange rate today itself, the factors which will have an impact on exchange rate, I told you this how inflation will basically make the exports less competitive, how imports might become, right, comparatively cheaper, etc., etc. Right? So don't ask me, sir, you have skipped that. Right? Where did you explain it, etc., etc.? We have discussed that. Next one, returns are affected, again basically having an impact on, again connected to the investment pattern itself. That is, if I'm having, let's say, 8% returns, inflation is 5%, my actual returns after adjusting for inflation is not 8, it is simply 3%. So the real rate of returns will be adjusted with the inflation. So these are some of the effects of having inflation rate in the domestic market. Okay. Now, one more concept of Phillips curve. Somebody was mentioning Phillips curve when I was discussing Lawrence curve. When I was discussing something else, they were mentioning Phillips curve. What is the Phillips curve? Right? What is the explanation of a Phillips curve? What does it actually represent? Please understand, Phillips curve provides a relationship between unemployment rate and inflation rate. This is generally how, right? Let's say the Phillips curve is represented. It provides a connection between the unemployment rate and the inflation. That is, if the inflation rate is higher, unemployment rate will be lower. If the inflation rate is lower, unemployment rate will be higher. Is it okay? This kind of a inverse relationship that exists between inflation and unemployment rate is given in the context of the Phillips curve. Everybody is okay? That is essentially the Phillips curve. Now, what is the connection here? What is basically the argument here? Argument is very simple. Right? What does it say? Inflation rate is higher, unemployment rate is lower. Correct. This is what the graph says. What is a connection? Connection is simple. When the GDP growth rate is higher, don't you think automatically the inflation in the market will also start increasing? Yes or no? I want an answer from you. If the GDP growth rate for a country is higher, don't you think that will lead to, right, more demand in the market, more salaries being earned? More salaries means more demand. More demand means inflation. If the demand is higher, if the GDP itself, right, look at this, if the GDP itself is higher, that also means the production is higher. When the production is higher, what about the employment? Don't you think the company will hire more and more people to work? More people were, right, basically hired for working purposes, unemployment rate will be lower. So do let me know, can you establish, right, basically an inverse relationship between inflation and unemployment? Yes. And exactly opposite will happen. Exactly opposite will happen when inflation rate is lower, unemployment rate will be higher. That is, if the inflation rate is lower, that generally means demand is lesser. Correct? That means demand is lesser. When the demand is lesser, what about production? Production will also be lesser. If the production is lesser, companies will not be hiring for, right, more people. Companies will remove people from the job. More people will be losing the employment, and that will essentially increase unemployment rate. So you're able to see inflation and unemployment rate are moving in opposite direction. This is the inverse relationship. But listen to me carefully. Is it always that this kind of inverse relationship is existing? Is this universally correct? Can it be held in all the situations? Answer is no. For example, there is a situation called as a stagflation. Correct? Very recently, this was there in the newspaper also. There is a situation called as stagflation. In fact, former Prime Minister of India, Mr. Manmohan Singh, who was there in the news in the last couple of months, passed away. He basically said India is going through stagflation. And again, when he said that last year, right, during pandemic, he said India is going through stagflation. And what is a stagflation? Remember this. Stagflation is a combination of two terminologies. That is, the growth is stagnant. The growth is stagnant. Stagnant means not moving. And on the other hand, inflation rate is higher. Growth rate is stagnant. GDP is not changing, but the inflation rate is higher. Why does it happen? Supply side factors. Supply side factors. Take the example of pandemic, you'll understand. During pandemic, was there higher GDP growth rate of Indian economy? No. We were basically struggling to reach back to the pre-pandemic levels. GDP. But on the other hand, was there a disruption in the supply chain? Do let me know. Was there a complete disruption in the supply chain? Yes, complete disruption. Right? Labor was not available. Raw material was not available. right? Let's say the transportation was disrupted. As a result of that, the price levels were actually going upward, right? The price levels were actually going upwards. So inflation on one side, and on the other side, essentially, right? Let's say stagnant growth. So a situation where there's a stagnant growth, higher inflation rate, higher unemployment rate, that is called as a stagflation situation, which is an exception to the Phillips curve. Which is an exception to the Phillips curve. Okay. Next one is GDP deflator. What is the idea of a GDP deflator? Whenever you compare, whenever you basically use right two indicators, that is one nominal GDP and real GDP, right? Essentially, that will be used to calculate right inflation, which is called as a GDP deflator. GDP deflator is also measurement of inflation, by the way. Remember this. A lot of you will be confused as to why I've written GDP deflator here. Because understand this. There is a WPI, there is CPI, then there is a GDP deflator. I hope all of you understand this. There is, right, let's say WPI, there is CPI, there is a GDP deflator. What is the formula for GDP deflator? Nominal GDP divided by real GDP. Okay, nominal GDP divided by real GDP. What is the essential difference between nominal GDP and real GDP? Whenever you take the base year prices and calculate, that GDP is referred to as a nominal G. The real GDP. And when you take the current market prices, that is the when you take the prevailing market prices and then calculate GDP, that is essentially called as a nominal GDP. Everybody is okay with the term nominal and real GDP, right? So argument is when you compare, right? When you compare essentially the nominal GDP by real GDP, right? This will give you an idea from the base year to the current financial year by how much percentage the price levels have gone up. By how much percentage the price levels have gone up, that is essentially given by comparing GDP, that is nominal, by real. Now you tell me, WPI, CPI also are indicators of inflation. GDP deflator is also giving you an indication of inflation. Between all the three, can I say the best one is the GDP deflator? The most efficient one, the more comprehensive one is the GDP deflator. Why? In GDP deflator, you are covering the complete basket of goods and services produced in India. I hope you understand. Right? Essentially, we are looking at the complete basket. That is all the final goods and services which are produced in India, right, are covered under the GDP deflator calculation. Whereas in case of CPI, 299 articles. WPI, 697 articles. That's the reason GDP deflator is a comprehensive measure of inflation. So remember that. That can also be asked in the prelims examination. Okay. Next, certain more important concepts associated with inflation. First one, disinflation and deflation. Disinflation and deflation. Okay. What is a disinflation and deflation? Listen to me very carefully. Disinflation represents a change in the inflation rate. That is, the inflation rate is a slowing down. That is called as disinflation. For example, listen to me now. Imagine the price levels will change like this: 100, then to 90. I'm sorry, 100, then to 110, then to let's say 118, then to let's say 120. Now, is there inflation here? Think of it. Is there inflation? Yes, because the price levels are going upward. But if you calculate inflation, here it is 10%. Here it will be somewhere around 7%. Here it will be somewhere less than 2%. Less than. I know it will be much lower than 2%. Let's not worry about exact number. But is it okay if I say the inflation rate is actually slowing down. That is disinflation. That is disinflation. What about deflation? In deflation, the rates will not increase, the rates rather will fall. Example 100, 90. You tell me, if the price levels will fall down from 100 to 90, is there inflation here? No. Inflation means the prices will go upwards. Here, the price levels are falling down. Right? So, in case of deflation, there is a negative rate of inflation. Price levels will keep on falling down. In disinflation, price levels will keep on increasing, but at a slower rate. Right? That is essentially disinflation and deflation. Stagflation, already done. Open inflation. What do you mean by open and suppressed inflation? There are two terms. Somebody is saying buffering, Rekha. Buffering, no, my dear. From my side, there is absolutely no problem. Please check from your side. There is nothing wrong from my side. Right? Please check from your side. Okay. So, what is open and suppressed inflation? Listen to me. If the government doesn't interfere, it will allow the market to determine the inflation rate. Absolutely no support, no control, no policy of the government to change any prices in the market. That is essentially called as open inflation. That is essentially called as open inflation. What about suppressed inflation? Imagine the government will purchase onion at, let's say, right, 90 rupees per kg, but will give it to you at 30 rupees per kg. The government will purchase the fertilizers at a much higher price, give it to you at much lower price. Don't you think by government intervening, by government providing the support like this, the actual price levels are not detected? Because the actual price levels are not taken into consideration for calculation of inflation, you are suppressing the inflation. All of you able to understand? That is called as suppressed inflation. One is open, free market, no support whatsoever from the government. Every price is determined by the market, and whatever is the inflation, that's a true reflection. Whereas, right, for example, government of India, whenever the prices of vegetable goes up to a very high level, government procures and supplies the vegetables to you. For example, onion, for example, tomatoes, for example, even pulses. So thereby government is not allowing the prices in the market to freely be determined by the forces. Government is interfering. That is suppressed. It's suppressed inflation and open inflation. Then everybody is okay. That basically brings to the conclusion of inflation. That is a topic of inflation that is completed. Can we go forward now? Can we go forward? Okay. Budgeting. Certain concepts in budgeting that are needed for prelims examination. Please understand, whenever you talk about budgeting, whenever you talk about budgeting, budget is divided into two accounts. This was asked in the mains, can be asked in the prelims as well. Listen to me. Right? The budget will be divided into two accounts. One is essentially called as a revenue account, and the second one is called as a capital account. One is the revenue account, second one is capital account. How do I differentiate between what is a revenue account and a capital account? Very simple. Whenever the income or the expenditure, whenever the income or the expenditure done by the government will change the assets or liabilities of government of India, that will be capital account. A statement clear to everyone? Do let me know. Right? Whenever the government will collect money or spend money, as a result of this, the assets or liabilities will change. That is called as a capital account. For example, and what are the examples of it? For example, let's say government of India will spend money to develop roads. Government of India will borrow money from the market. Government of India will sell, right, a company and collect money from the buyer. The government of India will provide loans, let's say, to the state governments. Now you tell me, in all these examples that I've written here, can I simply say either assets of the government is changing or the liabilities of the government is changing? Correct? All of you able to understand? Either the assets are changing or the liabilities are changing. Right? How do you understand where the assets will change, where the liabilities will change? Very simple. Let me start with capital expenditure. Memorize this. Please memorize this. Capital expenditure, remember, will increase the asset, reduce liabilities. I'll repeat the statement. Under capex, assets will go up, liabilities will go down. So how? Give me example. The government of India will repay the loan. Will the liabilities go down? Yes. Is it expenditure? Yes. And the liabilities are changing, which means it is under the capital head. Right? I'll give you one more example. Government of India will spend money to construct airport. Will spend money to construct a national highway. That is essentially assets of the government are increasing. So remember this, capex will essentially means assets are going upwards, liabilities are going downwards. Right? And when you look at the capital receipts, when you look at capital receipts, right, exactly opposite what you have written in the first line. Exactly opposite. Assets will go down, liabilities will go up. How so? I'll give you one example. The government of India will sell the companies. For example, Air India. The government of India will sell the company. Will the government get money? Yes. Is the asset of government of India changing? Yes. Asset is going downwards. So it is a capital receipt. What about, right, let's say the liabilities? Government of India will issue a bond, borrow money from the market. Is it part of the receipt? Yes. Is the liability of the government changing? Yes. By borrowing, the liabilities of the government are going upwards. So everybody is okay with this? Please do let me know. Everybody is okay? Capital expenditure, assets will go upwards, liabilities will go downwards. Right, exactly opposite to that under capital receipts head. Exactly opposite to that. Right, now how do I understand what is revenue then? Simple. Any expenditure done by the government, any income earned by the government, if they do not change assets or liabilities of the government of India, that will be part of revenue. Is it okay? Absolutely no change in the assets, no change in liabilities, but the government is spending money, government is collecting income. That is essentially revenue account. Example, government of India will collect taxation. Taxes, income taxes, corporate taxes. Is it income of the government? Yes. Is it changing the liabilities of the government? Is government of India collecting income tax today from you and is it repaying this after 1 year along with the interest? Absolutely no. And if someone says, yes, sir, after 1 year, I'm getting all my GST back, I'm getting all my, right? Let's say, again, as a consumer, don't say, sir, companies will get ITC, etc. Again, as a consumer, because a direct tax or indirect tax burden will fall on you only. Burden will fall on you, right? So, income tax you have paid last year, has the government of India given it back along with interest to you? If so, please do let me know. Reach out to me. Give me your number. I will ask you how did you get it. I will do the same process. I also want to get my income taxes back. Argument is simple. The receipts which are collected, right? No, you will not get it back. There is no liability on the government. On the other side, government will spend money. Let's say government will launch a subsidy scheme. I hope you understand. Government, right, basically will launch a subsidy scheme for old age people, will provide subsidies for the old age people. right? I hope you understand. Do you think assets or liabilities of the government of India will change because of that? No, but expenditure is done. So revenue account, no change in assets or liabilities of the government. These are essentially part of day-to-day activities of the government. Whereas capital account, there will be, right? There will be a change in asset or liabilities of the government of India. Everybody's okay with the classification here? Please do let me know. Sripat Mishra, sir, user arm paining. No, my dear, there was a mosquito bite. So that's the reason I was doing that. Do let me know. Everybody is okay? Those who are awake, please do let me know. More than 250 people. Right? So please do let me know. Can I go forward? Okay, done. Now, one more concept that you need to understand in the context of, right, let's say the budget is the deficits. Deficits. Essentially, there are four types of deficits. One is the revenue deficit. Second one is the effective revenue deficit. Third one is the fiscal deficit. And the fourth one is the primary deficit. Okay? Revenue, effective revenue. Third one is, right, the fiscal deficit. And the fourth one is a primary deficit. What is the meaning of each one of them? Revenue deficit essentially represents the excess amount of expenditure incurred by the government under the revenue compared to income generated. How much expenditure you are making, it is higher under revenue account compared to the income you are earning under the revenue account. That is called as a revenue deficit. Then everybody is okay. What is effective revenue deficit? When you calculate revenue deficit, there is one problem. There is one concern. What is a concern? Under the revenue expenditure, there is one expenditure called as a GCCA. Right? That is grants which are provided by the central government, let's say to the state government. Let's say to the state government to develop infrastructure. GCCA stands for Grants for Creation of Capital Assets. Grants for creation of capital assets. But why am I writing this GCCA, which is associated with the asset creation, under the revenue head? Why not under the capital head? The reason is very simple. Listen to me very carefully. If any expenditure is done by the center to create asset which is under the central government, it will be classified under capital expenditure. Everybody is okay? For example, central government will spend money, construct an airport, which is under the central government. That will be part of capex. But what if I say central government will give this money to the state government? State government will spend this money to develop infrastructure. Don't you think this infrastructure will be owned by the state, not by the central government? And this, my dear, is essentially a grant which has been provided by the center to the state. State government will own the asset, not the central government. This is GCCA. Everybody is okay? So GCCA is not changing the assets of the central government. Hence, we will put that expenditure under the revenue head. But there was a committee. I've mentioned the name of the committee earlier also. Rangarajan Committee. C. Rangarajan Committee. This committee argued that this GCCA, although you are writing under the revenue expenditure, because it is an expenditure associated with the asset. Because it is an expenditure associated with the asset, it should not be counted when you calculate revenue deficit. Because after all, there is a creation of asset. No doubt it is not directly under the ownership of the center, but asset creation is being done here. What you should do is remove the GCCA when you calculate, right, basically revenue deficit. And that is the precise reason when you calculate or when you look at the formula for the effective revenue deficit. What is the formula? Effective revenue deficit is equal to revenue deficit minus grant for creation of capital asset. Because the GCCA will lead to asset creation, remove this component. Completely take it out of the calculation of revenue side. Everybody is okay? This is effective revenue deficit. Next one is fiscal deficit, the simplest out of all of them. What is the fiscal deficit? How much money you are borrowing is called as fiscal deficit. Simple. In this year, how much money you borrow, that is called as a fiscal deficit. That is, you have a expenditure, let's say of 100 cr. You have an expenditure of 100 cr and you have totally collected a income. I'm using the term income, but they will use the term receipts. Remember this. The context of, right, let's say budgeting, they will use the term receipt, not income there. Okay. You have collected the total receipts of, let's say, 70 cr. How can you spend 100 when you have earned only 70? Correct? All of you able to understand it? Doesn't make sense. How can you spend 100 when you are earning only 70? Which means you will have to borrow 30 cr from the market. You have to borrow 30 cr from the market, right? This 30 cr is nothing but the fiscal deficit. Everybody is okay with the fiscal deficit. Fiscal deficit represents how much borrowing you are doing in that particular financial year. That is essentially called as a fiscal deficit. Next, primary deficit. Right? What is a primary deficit? What is the meaning of a primary deficit? What is the importance of it? Now listen to me carefully. If you can earn a sufficient amount of money this year to take care of expenditures this year, I'll repeat the statement. If you earn a sufficient amount of money this year to take care of expenditures this year, I will simply say your resources or your receipts are efficient or sufficient enough. Your resource mobilization is efficient enough. But what generally happens is the government will borrow from the market. Listen to me carefully. The government will borrow from the market. I'll take the number that I've calculated earlier. Imagine the government will borrow 30 crore rupees from the market. But what if I say out of 30 crore rupees, certain amount out of this, that is the 10 crore rupees, is used for interest payment? And what is the importance of this? You tell me, if you're paying 10 crore rupees interest this year, don't you think that is because you have taken a loan in the past? Yes or no? I want an answer from you. Participate more now. Because right, small portions are left out. I want you people to participate more so that you will feel interested, you will feel involved, and you will remain awake. Right? If I simply say 10 crore, I will use it to pay for interest. Is it not because you have taken a loan in the past? So have a look at this. When you are borrowing, it itself shows that the amount of revenues that you are generating, the amount of receipts that you are generating are not efficient enough. Your financing is not efficient enough. But out of this, what if I say 10 crore is used for taking care of the past borrowing, only 20 crore is for the current year expenditure. Now imagine this. Whatever you borrowed, that is the 30 crore rupees that you borrowed, what if I say all of this money was for interest payment? Think of this. All of this money, that is the 30 crore that you have borrowed, it is for interest payment. Does it not mean, listen to me now, does it not mean whatever was the expenditure in this financial year for launching a scheme, for development of infrastructure, etc., you were able to generate money sufficient to take care of all these expenditures? Yes or no? I want an answer from you. I'll repeat it again. If you borrow 30 crore rupees in this year, that's a fiscal deficit. Okay. You borrowed 30 crore, but all the 30 crore was to pay for your past borrowings. Right? Whatever you used this 30 crore, you used it for taking care of past borrowings. This year, you wanted to launch a scheme. Did you borrow money to launch a scheme? No. This year, you wanted to construct a road. Did you borrow any amount this year to use for construction of the road? No. You wanted to develop an airport. Did you borrow any money to finance for airport? No. Which means, can I simply say now here, in this example, the amount of finances that I'm able to generate this year are sufficient to take care of expenditures this year. Everybody is able to understand the argument here. This is the importance of primary deficit. Right? This is the idea of a primary deficit. How do I calculate a primary deficit? Fiscal deficit minus interest payment. Right? They will use the term net interest payment. Fiscal deficit minus interest payment, which means whatever I've borrowed, out of that, how much money is for the past borrowings, to take care of past borrowings. Higher the amount I will use to take care of the past borrowings, it simply shows that this year the money that I'm borrowing is not to take care of this year expenditure. It is to basically satisfy for the past borrowing. That is essentially the idea of a primary deficit. Everybody is okay? So these are the different types of deficits which are part of at the calculation. These are the four things which are calculated. Next one, FRBM. Next concept is FRBM. What is this FRBM? Fiscal Responsibility Budget Management Act. FRBM stands for Fiscal Responsibility Budget Management Act. And what is this Fiscal Responsibility Budget Management Act? Under FRBM, the government essentially has set up a target for reducing fiscal deficit to how much? 3% of GDP. We want to reduce right, the revenue deficit to how much? 0% of GDP. Now we want to reduce the debt of the government also to how much? At central government, we want to bring it down to 40%. The state governments, we want to reduce the debt to 20%. So total amount of debt we want to keep for both the center as well as the state, it is 60%. It is essentially 60%. Everybody is okay, right? These are certain important points in the context of FRBM. Right? Other points are also there. These I've given in the handout. I've discussed this in the current affairs class also. Please be very careful. FRBM can be asked. Okay, there was a committee which was set up 2016 and 2017. When Mr. Arun Jaitley was the finance minister, they set up a committee, NK Singh committee. We are implementing many of the recommendations of NK Singh committee. That is FRBM review committee. FRBM review committee. Okay, so NK Singh committee or also FRBM review committee. For example, the recommendation of reducing the debt rather than targeting only the fiscal deficit, revenue deficit. How do we reduce the debt? That was recommended by FRBM review committee, and we are implementing that by them. Done. So deficits, FRBM, fiscal deficit. How much money you have borrowed in this financial year? Fiscal deficit. Right? What is a public debt? How much money the government of India owes, which it has directly borrowed, which government has to repay. That is a public debt. What about the total liabilities? The government of India will ask various agencies to borrow, which will be repaid by government of India. I hope you understand this. Right? That is, let's say, government of India borrows directly, let's say by issuing government security, the payment has to be done by government of India. That will be basically first one, it will be fiscal deficit. And over a period of time, all of these borrowings will get accumulated. That will become a public debt. That will essentially become a public debt. Everybody is able to understand the difference between a fiscal deficit and a public debt? Do let me know. Fiscal deficit represents how much you have borrowed this year. But how much is the total borrowing that you need to pay back, which you have borrowed? That is a public debt. But there is one more term, total liabilities. What is a total liability? Government of India will ask Food Corporation of India to borrow from the market, which will be repaid by Government of India. That is a part of the liabilities of the government. Government of India is directly borrowed, has to repay liabilities of the government. There is an account called as a public account. Polity will come across this. There is an account by the name of public account. That is, for example, the schemes such as Sukanya Samruddhi Yojana, Kisan Vikas Patra, Public Provident Fund. All these are essentially raised the name of the government, who is liable to make the payment for all the money that is collected under all of it. Central government. So the amount that is collected under the public account, the liability is again with the central government. Is it okay? The liability is again with the central government. So when you talk about the total liabilities of the central government, you have public account, you have, right, let's say the public debt, you have public debt to repay, you also have the off budget liabilities. So what is off budget liability? You did not discuss that, my dear. 2 minutes ago I said center will ask Food Corporation of India to borrow from the market. Center is not directly borrowing, FCI is borrowing. That is off budget borrow, off budget liability. Who is liable to make the repayment? Who is going to repay this? Central government. So off budget liability, public debt, public account, and off budget liabilities. All the three are part of the total liabilities of the central government. Okay, can be asked in the prelims. Please make a note of this. Right. So again, associated with encasing committee, I've told you the points already. So everybody is okay with the points in the budgeting concept. Everybody is okay with the points. Right. The last concept or last chapter, the last chapter under the idea of the static portion, deficit financing. What do you want to understand under deficit financing, my dear? Do let me know. What do you want to understand? That is essentially it is done through borrowings from the market. We've discussed that. Borrowings from the market. That is how deficit financing is done right now. Sir, can you explain in brief about state government borrowing limit? Right? No, my dear. Idea is this. That has been discussed earlier also. Central government under FRBM generally restricts it to 3%. Okay? Generally will restrict it to 3%. 3% of what? 3% of gross state domestic product. Essentially, under this, the central government now says if a state government is involved in off budget borrowings, if the state government is also involved in the off budget borrowings, that is, let's say there is a state X, this state government through the agency has borrowed in the market, that is again off budget borrowing. Now, ideally, it should be 3% of gross state domestic product. That should be the limit of borrowing. Let's take a number. Let's say gross state domestic product is 100 crore rupees. 3% of GSDP will become how much? 3 CR. So in this year, the state will be allowed to borrow 3 CR. But the center says, no, I will not allow you to borrow 3 CR. Why? You are also involved in the off budget borrowing. And let's say off budget borrowing is worth 1 CR. Now, central government says there will be a new concept called as a net borrowing ceiling limit, NBC. Net borrowing ceiling limit. Essentially, under that, instead of allowing you to borrow 3 CR according to the formula, right, of FRBM, now even the off budget borrowing will be reduced. They will reduce the amount by off budget borrowing. You will be allowed to borrow how much? 2 CR, not 3. Right? You will not be allowed to borrow 3 CR. It will be, right, allowing you to borrow only 2 CR. Okay, done. Now let me go to the last topic. Last topic. After this, certain points from economic survey. Now, what is the last topic? National income. What are the important points in the national income? Let's go one by one. Right? There was one student who was asking for break. My dear, do you people need a break? Time is 10:40, 10:50 by the way. You people need a break. Can we continue? After certain time period, everything will be over. Don't worry. Can we continue? Let's complete. No break. Carry on. Great. Okay. Let's continue then. So national income aggregates, right? Please understand important points. One is the concept of a GDP. Okay. What is GDP? GDP essentially stands for gross domestic product. It stands for gross domestic product. What is the idea for gross domestic product? When you take the market price of all the final goods and services, when you take the market price of all the final goods and services, get the sum total of it. If these are produced in India, that is within the territory of India, that will become GDP. Is it okay? That within India, the market price of all the final goods and services which are produced, if you take the sum total of it, that will be the gross domestic product. And please remember, the production can be done by a foreign company, production can be done by a domestic company, doesn't matter. As long as it is produced in India, that will be counted as a part of India's GDP. That's a reason GDP is a territorial concept. That is, the production is happening within the territory of India. Right? Who produces it? Not a matter. Produced in the territory of India, count it as a part of GDP. Okay? How do we calculate GDP? Three methods. Please have a look at the names of three methods. One is you will count all the goods and services. From that, you will subtract intermediary goods. Is it okay? You will count all the goods and services. From that, you will subtract the value of intermediary goods. And if you take out the value of intermediary goods, what is left out? Final goods and services. That is the output method or the production method. Second one is you will basically count the sum total. That is the total of all the factor incomes generated in India. All the factor incomes generated in India, right? Get the sum total of it. That will give you GDP through income. Finally, at the total expenditure done by the government, the household, and the companies. Total expenditure by the government, companies, and the household. From this, you remove the value of import. To this, you add the value of export. What is left out? Essentially, you will be finding the market price of all the final goods and services which are produced in India. That is expenditure method. So these are the three methods which are used to calculate the gross domestic product. Okay. Now, who calculates it? NSO. And in the earlier session that I took for current affairs, there was one student who was asking me, Sir, why do you keep on saying NSO? I heard that NSSO has been merged. I heard that NSO has been merged, etc. etc. I would simply say, please have a look at this particular picture. All of you, please have a look at this particular picture. Right? What is the picture representing? It represents a structure of MOSPI. I'm focused on one area, only one area. That is NSO, National Statistical Office. NSO has two divisions. One is the Central Statistical Office, and the second one is National Sample Survey Organization. NSSO. And if you're reading newspapers very, very carefully, you will realize NSSO has been there in the discussion for multiple reasons in the last 1 year. For example, all of you heard of Household Consumption Expenditure Survey. Please do let me know. Household Consumption Expenditure Survey. Household Consumption Expenditure Survey is calculated by NSSO only. Through NSSO. Right? So this can be asked in the preliminary examination. Please be very careful. NSSO is part of NSO. NSO is a part of MOSPI. CSO is a part of NSO. NSO is part of MOSPI. These are some of the, right, let's say surveys which are conducted by CSO as well as NSSO. Please make a note of this. It could be as straightforward as a question which can be asked in the preliminary examination. Because this was there in the newspaper HCES. And because this was also there in the newspaper TUS. Some of you will be saying, sir, what is TUS? Time Use Survey. TUS stands for Time Use Survey. And if you're wondering, sir, what is a time use survey? Right, I've discussed this in the current affairs session also. Time use survey is a survey which is conducted once every 5 years. The first survey was conducted in 2019. The second one very recently has been conducted in 2024. That's the reason this was there in the newspaper. In 2024, this has been conducted. It is conducted by NSSO. And what does the time use survey do? How much time do we take generally to conduct activities, to perform activities? How much time do we take? Right? For example, how much hours are spent by men in a household work? How much time is spent by women in a household work? How much time is spent by, right, let's say, men in the factories? That is economic activity, etc. All of that is found using the time use survey. So please remember that time use survey is conducted by NSSO. Right. So right, these are important points. Please remember that. So calculated by NSO, that is the GDP data. Base year is 2011 and 12. It is calculated for every quarter. It is calculated for half a financial year. It is calculated for full financial year as well. Okay. And in the new methodology, what are the important points? What are the important points in the new methodology? One, the base year is right. Earlier was 2004 and 5. Now it is 11 and 12. The market prices are used to calculate GDP now. Earlier factor cost was used. Now market prices. Right. We use gross value addition. That is calculate the total value addition. Remove the intermediary goods. That is essentially the concept of gross value addition. Production is done. Sorry, production data is calculated by Ministry of the Ministry of Corporate Affairs, MCA, Ministry of Corporate Affairs, to a system called as MCA 21 database. And finally, this is the formula. You first derive a factor cost, then use the factor cost to calculate the base prices, then use the base prices to calculate market price. This, do not worry. Why? Question, if at all it has to be asked, will be asked in the mains. It has been asked. Question on the GDP methodology, new methodology, it has already been asked in the mains examination 2 years ago. Okay. In addition to this, right, certain more indicators. That is GNP. The arrow mark is wrong here. Arrow mark is wrong. I'll correct it. Don't worry. GNP, right, is different. NDP is different. NNP is different. Arrow marks are wrong. I will change the arrow marks. Don't worry. That is, the connection is wrong like this. What is GNP? Gross National Product. Right? Gross National Product. What do you mean by gross national product? Essentially, in the context of gross national product, what we need to calculate is how much is how much is the total amount of let's say total market price of the goods, that is the final goods and services which are produced by residents of a country. Residents of a country. That is essentially, let's say, right, there is a Indian citizen in residing in India. Anyways, whatever is produced by this person within India will be counted as a part of GDP, and because they are residing in India, will be counted as GNP also. But if this person will go to USA for a period of, let's say, 3 months, for a period of 6 months, etc., then even though the production is being done outside India, please understand, until the end of 1 year, generally under the concept of the national systems accounting, it is 1 year, resident and non-resident. For taxation purposes, it is 183 days. So when you basically talk about residency in the context of the national income accounting, it is generally taken as 1 year. So this particular person, no doubt they are present in USA, but only for 3 months, only for 6 months, which simply means they are still counted as a resident of India, still counted as a part of resident of India. So though the production of goods and services is happening outside India, they will be counted as a resident, and that will be basically the calculation of GN. That is how much is the production done by foreign residents who are present in India. You subtract it from the GDP. And how much is the production done by Indian residents who are present outside India. That is, let's say, in USA, in UK, etc. You add that to GDP. That will essentially give you the gross national product. So GNP is a nationality concept. Focus is on the residency. GDP is a territorial concept. Focus is on where the production happens. Okay. So third one, this is the second one. Third one is NDP, right? So third one is NDP, right? What is NDP? Net domestic product. Net domestic product. What is a net domestic product? Simple. Whenever you produce goods or services, let's say GDP, out of the total market price of final goods and services, there will be certain goods which are going to replace existing machinery. Depreciation, by the way. Simple depreciation. Some of the machinery that you have produced this year will be counted as a part of GDP. But these machineries will be used to replace existing machineries. That is, old machineries will be replaced by these machineries. That is the value called as a depreciation. Now, out of total GDP, if you take out the value of the old machinery, that is depreciation, that will give you net domestic product. That will essentially provide you with net domestic product. Is the concept okay? It's a very simple concept. Some machinery is old, you remove that, throw it away, and a machinery that was produced this year, which is counted as a part of GDP, you use it to replace this. So when you calculate GDP, you do not know how much part of the GDP is being used for replacement. Don't have any idea. But when you use NDP and compare it with GDP, you will realize how much part of the total goods and services or final goods and services in this year was used for replacement. That information will be provided to you when you look at GDP and NDP. Then next one is NNP. Simple concept. NNP, net national product. What are we doing? We are basically counting the market price of all the final goods and services produced by residents of India. But out of the final goods and services, again we are adjusting for depreciation. We are essentially adjusting the market prices of all the final goods and services produced by the residents, but we are adjusting that with the depreciation. Reason being, again, some of it will be used for replacement. Simple. Some of it will be used for replacement of old worn out machinery that is not provided in GNP, will be provided in NNP. And finally, NNP at factor cost. NNP at factor cost. Listen to me very carefully. NNP at factor cost is referred to as a purest form of national income. Right? I'll repeat this. NNP at factor cost is referred to as a purest form of national income. Why? Listen to me very carefully. When you calculate GDP, it is at market prices. Correct? Listen to me now. When you calculate GDP, it is at market prices. And you use GDP to arrive at NNP. Can I simply say it is at market prices again? Now tell me, don't you think the market price is derived after including indirect taxes? Yes or no? You arrive at a market price after counting the indirect taxes, that is, after adding indirect taxes. So, don't you think if you calculate NNP at market price, it is not representing the incomes which are generated by residents of India? And I'll repeat the statement. If you calculate NNP at market price, it is not representing how much incomes have been generated by you, right? By me also. Why? There is a component of indirect taxes in the market prices. There is a component of subsidy also in the market prices. What do I do? How do I calculate only the incomes generated by you and me? That is the residents of India. What I will do is, instead of calculating NNP at market price, I will basically shift from NNP at market price to NNP at factor cost. Simple. I'll calculate NNP at factor cost. And how can I do that? The formula is like this. You basically take factor cost To that, you add indirect taxes and you reduce subsidies. The logic is very simple. Indirect taxes will increase the price, subsidies will reduce the price. Correct? All of you able to understand? At more than 200 people are present. I'm happy by the way, but you people tell me, indirect taxes will increase the price, subsidies will reduce the price. Can I use the formula like this? That will give you market price. Now, if I want to calculate at factor cost, what will I do? I will take these two indicators, transfer it on the other side. Well, okay. So factor cost will be equivalent to market prices minus indirect taxes plus subsidies. Now you tell me factor cost includes what? Right? Or cost price includes what? Essentially the factor incomes generated by us. That is a resident of India. So can I simply say, when you calculate NNP at factor cost, these are representing purely the incomes generated by us. Incomes generated by us. That is the reason NNP at factor cost represents purest form of national income. Everybody is okay with this? Please do let me know. Represents the purest form of national income. Right, and finally the per capita income. And those who will become happy don't become happy. There is one more chapter or one more topic that I've skipped. I'll cover it now. Right, so the per capita income is essentially the national income divided by population of a country. On an average, again on an average, how much is the income generated per person is called as per capita income. Okay, right. So these are certain things. The one topic that I've skipped is essentially this one: industries. Industries, I'll cover that. But before that, let me throw certain formulas at you people. Let me see how many of you will be able to understand at 11 p.m. these formulas. First one is personal income. At personal income, please look at the formula. Personal income essentially represents national income minus undistributed profits minus net interest payments made by the households minus corporate tax plus transfer payments made by the government to households. Now, many of you will say, sir, what is the formula? I'm not able to understand what is the formula. My dear, you calculated NNP at factor cost. Listen to me very carefully. Okay, please listen to me carefully. You calculated NNP at factor cost and you told what? NNP at factor cost represents the incomes earned by the residents. Agreed. But listen to me carefully. Do you think this represents how much money is there in the hands of all the residents of India? Think of it. I'll repeat the statement. You calculated NNP at factor cost. You arrived at a number. But do you think that represents how much money is there in the hands of all the residents of India? Answer will be no. Answer will be no. I'll prove it. I'll just give you one example. Listen to me very carefully. When you calculate a factor incomes, right? Factor cost is nothing but factor income, sum total of factor incomes. Can I simply say one of the factor incomes will be profits generated by the company? Correct? One of the incomes will be profits generated by the company. Everybody is okay? But now you tell me, do you think all the profits generated by the company, do you think that will come to residents of India? All the profits? Answer is no. Reason being, listen to me now, part of the profit will be taken away by the government. Correct? Right? Everybody is able to understand part of the profit will be taken away by the government. How? Corporate taxes. Correct. And part of the profit, the company will not give it to the owners. What they will do? They will hold the profits. They will withhold certain profits. All the profits will not be divided to the shareholders or the owners. Some of it will be held by the companies itself. Why? Company might simply say, next year I want to purchase one more company. Next year I want to expand manufacturing. For that, I want to keep part of the profit with myself. I will give you remaining profit. So just think of it. Do you think all the profits that are generated, which are part of the factor income, will come to us, will come to the residents of India? It will not come. Right? I'll give you one more example. I will earn certain amount of income. Let's say I'm earning 100 rupees. What if government of India will give me a subsidy of 50 rupees? Think of it. I'm earning 100 rupees, which is part of the national income. Okay, I'm earning 100 rupees, right? Counted as a part of factor income. That is wages, let's say. So I've earned a wage of 100 rupees. What does it mean? Exactly 100 rupees there in my hand right now? No. What if government of India will also say, take 50 rupees. This is the subsidy that I will give to you. Take 50 rupees. That is another amount of 50 rupees that I will have in my hand. I hope you understand. There are a lot of adjustments that we need to make. Right? I'll repeat, a lot of adjustments that we need to make to basically arrive at a number which represents how much income is earned by the city, how much income is actually generated by the residents of a country. And that, my dear, is called as a PI, personal incomes. Remember this, personal incomes. National income is different, personal income is different. How do I derive that? From the national income, whatever taxes have been taken by the government, I will subtract it. Listen to the calculation. From the national income, whatever taxes have been given to the government of India, corporate taxes, I will take it out. I'll subtract it. Whatever interest payments that have been made by the households, that is net interest payments which have been made by the households too, let's say, the banks, etc. I will subtract it because that is not there in my hand right now. Whatever profits have been held by the companies, certain part of the profit is held by the company, it has not given it to me, I will subtract it. But now what if government of India gives me a subsidy? I will add it. Transfer payments done by the government to the households, I will add it to the amount of earning that I've done. So some of the, right, let's say, items will have to be deducted, subtracted. Some of the items will have to get added. That will give me personal income. That is how much money is there in my hand. That is personal income. But now tell me, imagine after all of this calculation, imagine you will get a number of 170 rupees. You will get a number of 170. Do you think you'll be able to spend all the 170 rupees? Government of India will come to the picture now and say, I've collected taxes from the companies. You have not paid taxes, that is income taxes. Simple. I've collected the taxes from the companies, but you have not paid the taxes. You have not paid, right, other payments also. So start making all of these particular payments. You will basically deduct all the types of payments that you are obligated to basically make out of the personal income. For example, right, let's say property tax. For example, let's say for what is that? Income taxes. So all these particular taxes that you owe to the government, you will have to subtract it. And after all these obligations you have satisfied, whatever the amount that is left out in your hand, that, my dear, is called as a personal disposable income. Everybody is okay? That is essentially how much money is actually there which you can spend. How much money is there that you can spend is called as a personal disposable. Everybody is okay? National disposable income, that is whole of India. Until now we were looking at only individuals. What about the whole of India national disposable income? You will take NNP at market prices and you will add transfers from rest of the world. What do you mean by rest of the world? And what is this idea of a net national product at market prices? Please listen to me very carefully. Listen to me carefully. Right? Imagine, just to make you understand, I'm taking numbers here. Okay? Let's say the personal income was 170 rupees. Out of that, the payments, that you owed to the government, owed in other cases, etc. Let's say it was 50 rupees. Once you adjust 50 rupees out of 170, you will get how much? 120 rupees. But just think of this. Whatever calculation you have done to arrive at 120, don't you think all the amount that was considered was essentially from within India? Correct or not? It was all from within India. But don't you think, imagine your friend or let's say your relative is sitting in USA and they will send you remittance. They will send you remittance, right? They are citizen of USA, they are there in UK, they are there in Australia. They will send you certain amount of money. Let's say they will ask you to purchase something from your for your birthday, right? Let's say which is coming up. Now tell me, until now the disposable income that you derived was 120 rupees. But don't you think now, because you are receiving remittances from the rest of the world, disposable income at the national level will be much higher than 120 rupees? Yes or no? Your actual disposable income, the actual amount of money that you will be able to spend will be more than 120 rupees. That is, let's say you get remittance of 80 rupees. You have 120 rupees to spend. You'll purchase goods and services, and that will be at market price. Now, you will be able to spend another 80 rupees because you have received payments from the rest of the world. You have received payments from the rest of the world, that will also be accounted for. That is called as a national disposable income. I know these indicators are slightly difficult. I know all of these are provided in NCERT books. For which standard? Class 12th. Class 12th macroeconomics NCERT book. These formulas have been provided. Just be careful. UPSC can test you. Be careful. Don't fall for it. You require practice. You need revision. That's it. Okay. And finally, private income. Right? Private income, much bigger formula. Factor income from net domestic product accruing to the private sector, national debt interest, net factor income from abroad, current transfers from the government, other net transfers from the rest of the world. Before you ask me, sir, what is this private income? Listen to me carefully. Until now, right? Until now, we were discussing the government, the private sector, right? That is the firms as well as the households. We were basically considering all of them when you talked about, let's say, right, the incomes. Now, I hope you understand. Remove government. I hope you understand. Remove government. Remove government from the calculation. Whatever is left out, can I call it as a private income? Do let me know. I know 11:20. A lot of you are tired. A lot of you are basically saying, no, nothing is entering my head, etc. Don't worry, but you tell me now. If it is too much, we'll stop the discussion. Please don't worry. Don't panic. Don't panic. You require revision for this. You require practice. That's it. Because you have been hearing to economy from 12 o'clock. Right now, I know a lot of your mind will be rejecting whatever I tell you. Right? A lot of you will be rejecting whatever I basically say. No, I will not accept it. Whatever you say, I'll not accept it, you'll say. Agreed. I can understand. But last point, maybe after this, I'll give you a background to industry, then we can stop. Economic survey, I'll arrange for a separate class. Don't worry. Right? Listen to me very carefully. Private income, right? Let's say until now, whatever we were discussing, essentially we were covering the government, we were covering the households, we were covering, right? Let's say the private sector companies, right? Household, private sector companies, as well as the government. But when we talk about private income, essentially what we will do is we will remove government from the picture. That is, whatever is income generated, earned by the government, simply remove from the picture. What is the total income generated by the households? That is you and me, as well as the private sector companies. Count only that. Simply count only that. How do I derive that? Right, have a look at this. Factor income from net domestic product. Factor incomes, right, from the net domestic product. Again, I'm talking about net domestic product. Why net? Why not gross domestic product? plus part of it will be used for the replacement of the existing machinery. So that is the reason I will count the factor income from the net domestic product which is generated by the private sector companies. I will add the debt interest. What do you mean by debt interest? Imagine you have purchased a bond from the government. Right? Imagine you have purchased bond from the government. Government will give you interest. Government will give you coupon. Same thing if the private sector has done, they will also earn certain interest. Have a look at this. National debt interest plus factor income from abroad. Let's say you have gone to USA for a period of 3 months. You have gone to, right, let's say UK for a period of 3 months. You have earned income from there. You have brought it. It is still the private sector income that is earned by you. That will also be counted. Now you have a current transfer from the government also. Government will give you certain subsidies. Count that. And right, let's say your relatives, somebody is there outside India. They will send a certain amount of remittances for you. Count that. Other transfers from the rest of the world. All of this, if you take the sum total, adjust all of this, essentially what you get is the total income generated by private individual, private sector companies. That will be called as a private income. And so these are the four indicators. I would recommend you please go revise this once again. Please revise this once again. Not today. Not today. You will not be able to understand even if you revise it today. Maybe tomorrow afternoon, tomorrow evening, sit. Tomorrow is Sunday. Take rest first, then start revise. Okay. Everybody is okay with this? Everybody is okay. So, what is the time? 11:30. Okay. uh, Saurabh Raghuvanshi, sir, in national disposable income, why don't we take NNPF factor cost? Why don't we take it NNPF factor cost? Okay. Disposable income means what? How much money you have to spend. Correct. Disposable means what? How much money you have in your hand to spend. Now tell me, whatever the amount of money you have, can I simply say, if I purchase this particular bottle from the market, can I simply say disposable income is equal to market price of the bottle? Very simple question. Right? Participate, all of you will understand. Right? I hope you understand. Disposable income, that is the amount of money that you have to spend. And imagine you have spent it to purchase this particular bottle. So can I simply say market price of the bottle is equal to disposable income? My dear, that is what exactly the formula is. Have a look at this. At the market price, net national product at market prices plus other current transfers. That is how much money you have spent to purchase goods and services plus how much money you receive from the rest of the world. That is the argument here. Okay, done. So, I'm just wondering, time is already 11:30. Anyways, I'll not be able to complete economic survey today. It is very difficult. Economic survey, I'll require at least 1 hour. Uh, okay, let's do one thing then. Let's do one thing. I'll cover industries. Last part, I'll cover industries. Economic survey, I'll take a special class. I'll take a special class for economic survey. Most probably, it might happen on Tuesday or Wednesday. The information regarding that will be there in my Telegram channel. Okay, let me cover this. Let me cover this. Okay, industries. Right, in industries, what you need to cover? One, MSME. Please cover MSME. Why? Especially under MSME, I feel there will be a question asked on new definition. There will be a question most probably asked on the definition of MSME. Right, have a look at the new definition of MSME. I've covered this in the current affairs session also. But again, just to reiterate, I'm covering here. That is, right now, the revised guidelines, essentially investment and turnover, 2.5 CR, 10 CR, and then, right, basically 10 times 25 CR and 100 CR, sorry, 100 CR, and right, multiply this 5 times now, 125 CR and 500 CR. Memorize this. 2.5, 10, 25, 100, 125, 500. Please memorize this. I feel a question will be asked on the definition of MSME. And have a look at this. In reforms also questions can be asked. And what do you mean by reforms here? For example, associated with MSME, for example, there is a scheme by the name of Mudra Yojana. I've covered this in the right, let's say current affairs. Mudra Yojana. There is an initiative by the name of TREADS. I'll discuss TREADS when I take up economic survey session. Right, I'll discuss that in the economic survey session. Don't worry. Right. So in the current affairs, in the static portion, lot of discussion has been there in the concept of reforms for MSME. I believe one question, if at all UPSC wants to ask you, a statement can be asked, right, from the reforms itself. Okay. Next, in the industries, please have a look at disinvestment concept. Disinvestment. What do you mean by disinvestment? Disinvestment essentially refers to a policy followed by the government where the percentage of ownership percentage is sold by the government and the money is collected. Simple. The percentage of ownership is sold either 5% of the company, 10% of the company, 50% of the company, or 100% of the company. It could be any. Okay. So either minority ownership, majority ownership, right? Either the ownership is sold and the government will collect the money. That process is called as a disinvestment. What are the different types of disinvestment? For example, government will conduct an IPO. Right? This was done very recently in the context of LIC. LIC. What if the government of India will conduct an IPO? Right? That is, the company was not listed. Now government will list the company. 5% of the ownership, that is shares, are sold. 10% of the ownership shares are sold. That is disinvestment. But please understand, whenever the government will sell small percentage of ownership, when I say small percentage, government will continue to own at least 51%. And why this number 51% is important? This will give you majority ownership. Is it okay? This will give you majority ownership. Anybody who has a 51% or more will control, right? Let's say the management of the company. So when the government will have at least 51% ownership, this is essentially majority ownership. So whenever government will sell ownership, but will continue to have at least 51%, this essentially is called as a minority stake sale. This is called as a minority stake sale. Lot of times when the government will go for an IPO, it will be minority stake sale. A lot of times when the government will go for ETF, exchange traded fund, it will be minority stake sale. A lot of times when the government will go for, right, let's say these types, government is not selling, right, above 49%, it will continue to hold a huge percentage of ownership, generally more than 51. But at the same point of time, what if government will sell 76%, sorry, 74% of a company? What if government will sell 100% of the company? Right? That is complete privatization. Please understand that is also done by the government. There have been examples in the past, but generally this is called as a strategic disinvestment. Right? Whenever the government will give away the majority control, that is the management control is given away by the government, that is essentially called as, right, strategic disinvestment. Strategic disinvestment. Example, Air India. Air India. In the context of Air India, Government of India sold 100%. Modern Foods, 100%. Maruti, 100%. So there have been multiple examples in the past where government has either proposed to sell 74% so that it will control 26%, or it has proposed to sell 51%, it has proposed to sell 100%, and in many cases, it has ended up selling 100% of the companies. Done. So this is essentially called as a strategic disinvestment. That is, right, let's say government losing the control, that is a board control of these companies. Everybody's okay? A lot of you will be confused regarding share buyback. What is this idea of a share buyback? Listen to me carefully. There is a company by the name of Steel Authority of India Limited. Correct? I'm taking one example. Steel Authority of India Limited. More than 51% of the ownership of Steel Authority of India Limited is with the government of India. More than 51%. Just to make you understand, let's take a hypothetical number. Hypothetical number. Let's say it has 60% ownership. 60% of the shares are with government of India. What do you mean by share buyback? Share buyback essentially means the company, that is a Steel Authority of India Limited, will pay money to the government of India and will purchase the shares of its own company. Everybody is able to understand? The sale company, it has profits, it has money, it will use this money to pay to government of India and buy back the shares. Buyback means purchase back. So the company whose shares are there with the government will be receiving money and it will give shares to the company. That is called as a share buyback. Right? Generally, even under the share buyback, we go for minority stake sale. Government doesn't sell up 100% or 90% like this. 4%, 3%, 2%, etc. Minority stake sale. So these are the different types of disinvestment routes which are used by the government. Okay. Now there is a term called as a National Investment Fund, NIF. What is the importance of a National Investment Fund? Listen to me carefully. If the government will conduct a disinvestment, it will collect money. Simple. Correct. It will collect money. Now, where will the money go? Will the money simply go to Consolidated Fund of India? Or will the money go to Contingency Fund of India? Or will the money go to, let's say, public account? The answer to that is the money through disinvestment proceeds will go into an account called as NIF, National Investment Fund. And please remember this, NIF is not part of consolidated fund. Is it okay? NIF is not a part of consolidated fund. It is not a part of consolidated fund. Then you will ask me, sir, where it is then? It is generally counted as a part of public account. It is generally counted as a part of public account. That is, through the executive authority, money is deposited, money is withdrawn. Is it okay? Now, when the money will be collected in the National Infrastructure Fund, sorry, National Investment Fund, for what purpose money can be used? Can it be used to launch a scheme? Can it be used to repay the existing loan? Can it be used, right, let's say, to develop an infrastructure? For what purpose? That is also defined. That is also clearly defined. Unlike earlier situation where money can be used for launching welfare schemes also, that will not be allowed now. It will not be allowed. Then question arises, for what purposes NIF can be utilized? Listen to me carefully. The funds in the NIF can be utilized to infuse capital into public sector banks. Right? In the public sector banks, the money, that is a capital, can be infused. Recapitalization. That is called as recapitalization. The money can be used to invest in metro projects. Different metro projects are there. In that, the money can be invested. The money can be invested for rights issues. It can be invested in the rights issues. Right? Now you will ask me, sir, what do you mean by rights issues? Listen to me very carefully. Okay, please listen. Let's say there is a company ABC in which government of India right now has 51% ownership. Point number one. Is it clear? I'll repeat it. There is a entity ABC, listed company, in which government of India has a 51% ownership. Means government of India has the management control. Now, if the company ABC issues more shares, imagine this. If the company will issue more shares and the government of India doesn't purchase shares, don't you think ownership of government of India might go down below 51%? Correct? It will automatically go down below 51%. Then government of India will not have majority ownership. It will have lesser ownership. So what is the essential argument here? In order to ensure that the government will continue to have the management control, these entities generally go for rights issues. They go for rights issues. What do you mean by rights issues? To the existing shareholders. I repeat, to the existing shareholders, same percentage of the shares which are being issued will be offered. I'll repeat the statement. To the existing shareholders, whatever is the percentage of ownership right now, in the same percentage out of the new shares, they will be offered to purchase. Just to give you one idea, imagine the company ABC is issuing 100 shares now, 100 new shares. The company ABC will offer out of 100 shares how much to government of India? To the government of India, they will offer 51 shares. So that the government will purchase this 51, whatever is the total number of shares, government will continue to hold the same percentage. The percentage ownership will not change. This is called as rights issue. Everybody is okay with this? Please do let me know. Everybody is okay? So even to invest in rights issues, the government of India can use the proceeds of disinvestment. Then, right, let's say there are atomic energy companies in India. There are atomic energy companies, right? So in atomic energy companies, for example, Rashtriya Nabikiya Vidyut Nigam Limited. So in these atomic energy companies, if the government of India wants to invest money, they can use the proceeds of disinvestment. They can use simply the proceeds of disinvestment. So these are the purposes for which the proceeds from the disinvestment can be utilized, right? Nowhere else. They are very limited. They cannot simply use it willy-nilly for any other purposes. Okay, so that is National Investment Fund. Now, next point, a new disinvestment policy. What is this new disinvestment policy? The government of India has announced that all the sectors in which government has ownership of the companies now will be divided into two parts. All the areas where government of India owns companies will be divided into two parts. One is called as a strategic sector, and the second one non-strategic sector. Strategic and non-strategic. Why the division has been done as per the new, right, let's say disinvestment policy? Reason that the government of India says is simple. If there is any entity owned by the government in the non-strategic, the government of India will not continue to own it. It will simply sell it off. It will simply sell it off. Right? If they can't sell it off, they will close it. They do not want to have any kind of presence in the non-strategic sector whatsoever. They do not want to be present. And example, before you start asking, sir, example, textile sector, agriculture, allied sector, etc. They do not want to be present in the non-strategic sector whatsoever. Sir, example of strategic, defense, right? Financial services, right? Atomic energy. All these are examples of strategic. Within strategic, the government simply says maximum in each of the sector, we will have four companies. I'll give you best example to make you understand. Banking. Do let me know. In case of banking sector, all of you will agree the number of entities owned by government of India are reducing. Yes or no? Just one example, you will understand it. In case of banking, the government of India's owned entities, owned banking, public sector banks, the number is reducing. Right? At one point of time, there were 21 public sector banks. Today, there are 11 public sector banks. And government of India further wants to reduce it. What is the argument? Government says, I do not want to have too many companies. I do not want to have too many entities under the ownership of government of. So what I'll do, I will reduce it to maximum up to 4 entities. Up to 4. Right? What if it is more than 4? We will merge them. We'll amalgamate them. We will reduce it to up to 4. Right? That is basically the new policy of Government of India regarding disinvestment. Right? In strategic, up to 4. In non-strategic, absolutely no presence. They do not want to be present, right, in case of non-strategic. And finally, the last point for today, after which I'll take up your questions, the Insolvency and Bankruptcy Code. Right? What is the basic idea for IBC? IBC has been implemented in 2016. Right? September 2016, the Insolvency and Bankruptcy Code was implemented. And what is the model of Insolvency and Bankruptcy Code? Essentially, under the earlier system, we had multiple legal frameworks. We had Companies Act, we had the NCLT, we had NCLAT, we had BIFR, we had SICA, SICA. So there were different pieces of legislation. What happened was there was a fragmented framework. Government of India simply said no. Rather than having fragmented framework, let's consolidate the whole structure. We will have only one structure now. That is essentially the model of Insolvency and Bankruptcy Code that has been implemented. Under Insolvency and Bankruptcy Code, the authority, right, which you will approach and file a petition, file an application, is essentially NCLT, National Company Law Tribunal. You'll go to NCLT, file an application, and there is a particular process under the NCLT where the borrower, which has been classified as an NPA, you'll be able to recover money from this particular year. Everybody is okay with this? Right, so these are certain points associated with the concept of insolvency and bankruptcy code. Right, somebody says, and DRT, yes, my dear. DRT is for individual borrowers. That is the retail borrowers who have defaulted, right? Which have defaulted. Whereas in case of corporate borrowers, it is NCLT. Focus more on essentially NCLT because that is there very often in the newspaper. Okay, so everybody is okay with the discussion that we have had so far? TT says, if you're not tired, keep continuing, sir. My dear, I should be worried about the students also. That is those who have been attending from 12 o'clock. I'll cover it, don't worry. Couple of more concepts are left out. That is the economic survey is left out. I will cover that also. Please do not worry. In the next 2 to 3 days, I'll cover that also. That will also be over. So essentially for you, whatever is required from the Indian economic, current affairs, static portion, etc. Economic survey is left out. I'll cover that. That will essentially take care of all the portions, current affairs as well as the, right, let's say static for you. Ha! Any questions from your side? Aditya Singh, please upload this annotated PDF by tomorrow before economic survey. Okay, Sirji, that will be done. Ah, others, any doubts? Please do let me know. What is refinancing companies? And please give some example, my dear. Refinancing companies, etc. All of those are part of NBFCs. Under the NBFC, there are multiple types of entities. Multiple types of entities. Essentially, what refinancing does is, uh, let's say there is a company which will provide financing to you. They are taking certain exposure. They will basically take the financing from somebody else. So that is the process of refinancing. Okay. What is rights issues? Rights issues is a process wherein the company will issue the shares to the existing shareholders in the same proportion of their existing ownership, in the same percentage of the existing ownership. That is, imagine my ownership is 5%. Out of total new shares which are being issued, 5% will be offered to me. That is essentially the concept of rights issues. Okay, now I know a lot of you have questions regarding other things also. Right? Before I wind up, I want to tell you a couple of things. If you have questions, please don't worry. Maybe next week I'll take a doubt resolution session as well. That is on the platform. I'll take a doubt resolution session. Right? Keep your doubts ready. I'll address in that particular session also. Do not worry. I'll be available to you people. Do not worry about getting your doubts resolved. So, what I'll be doing is, listen to me carefully. You have completed all the static portion of Indian economy. Okay, if complete, I'll take last 2 minutes. Don't worry. You have completed all the static portion of Indian economy. You have also completed all the current affairs of Indian economy. And all the current affairs from January 2024 to April 2025. You will cover even the economic survey in the next couple of days. My argument for the next 15 days, please do not read any new material. Please do not read any new material, no new book, nothing. All you need to do is simply is consolidate. And how do you consolidate? Revise, revise, revise. In the next 15 to 16 days regarding Indian economy, you need to simply revise. Do not take up new book. Do not take up new current affairs. You are going to only confuse yourself rather than learning anything from all of these things. So simply do the revision. Please do not take up any new things. You do not have sufficient time. You do not have sufficient capacity also right now to absorb all the current affairs. So just stick to whatever has been covered in current affairs as well as the static portion so far. Keep on revising, revising, revising. Regarding economic survey, have patience. I'll cover that in the next 2 to 3 days. Regarding the PPT, just give me some time. It will be uploaded in my Telegram channel. And for the last time today, this is the link. This is basically the address of my Telegram channel. If you're yet to join to download PPT, this is where you will get you will get the PPT as well as the PDF of the mind maps. Okay. So before I wind the session, if you have got the benefit of learning something from this particular session, do show your appreciation. We would appreciate that by clicking on the link, that is the like button. And if you are yet to join our YouTube channel, kindly do it right now. Done. So that's it from my side. Take care. All the best. See you in some more time. No, some more days, not time, some more days. I'll cover even the economic survey in a special class. I'll cover that as well. So that's it from my side. Take care. Have a great day. Good night. See you next time.